Hello, welcome to today's Singapore Market on Close update from the officials. So today, the story in Dubai was one of a more diverse buy side, yet Mercuria is still the main presence. So the physical premium continued to come off pretty rapidly. We're down to 74 cents today. That's down from the high that you can see up here of 295 very, very briefly. So the sanctions boom has come off very sharply. But the big story is that we have more variety on the buy side. So previously we've had Mercuria and Mitsui, mainly Mercuria in the last week. However, today we had Vitol buying, we had Exxon coming in and lifting some offers as well, and we had Trafi bidding. So it's become a much more diverse buy side. We also had Reliance again playing both buy side and sell side bidding and offering. So the result of that is that we got another convergence. This time it was PetroChina to Mercuria again. But what you can see when you look at the physical premium for each day that they've converged, today we're much, much lower. We've cut off effectively the noise from the sanctions and we've gone back to where we were more or less before a couple of weeks ago. Now, that's the Dubai picture. However, in the overall market, what we've got is really a significant sell-off in terms of both flat price and spreads to go along with that Dubai structure weakening. So what we've got when we look at Brent futures here is you can see obviously the significant kick up based on the sanctions from when we were down in the kind of mid to low 60s up to the mid 60s, above even 66.50 briefly late last week. And then we've come back this morning. You can see with this large candle here that we've got a significant sell-off in this morning's trading. Down to 64, we're barely holding on to that level. And likewise, the spreads have come off significantly as well. If you look at the Dubai spread, similarly to the physical premium, these are daily candles, and you can see the volatility we got yesterday on the Barometer M1 spread, where we dropped significantly down towards like 50 cents, and then even lower again in today's trading. So the story is really the structure is getting weaker based off the calming of the sanctions. There's increasing noise about potentially India reducing or cutting off Russian buying. However, there are workarounds being found. For example, we've heard from Indian Oil Corporation that the oil itself, they point out, is not sanctioned. It's buying it from the sanctioned entities. So really the question is how to get that oil to India via non-sanctioned entities and below the price cap in order to remain compliant with these sanctions. But the Brent Dubai box, also November, December, that has come off a bit today. It has been strengthening. However, you know, is really an ebb and flow at the moment in terms of the Brent Dubai on the whole. And yeah, the story today for Dubai window, more diverse buy side, some perhaps opportunistic lifting from a variety of buyers, and also weakening structure as the physical premium comes back down to the levels it was in before the sanctions.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined once again by Harry and Julian. This week we're going to take a slightly different approach. We're going to look at benchmarking and why it's important and how you can use the Flux platform to make better informed hedging and procurement decisions. I think last week we were talking a lot about diesel and I think it's particularly important for that market, but probably even more so for the biofuels market, where it's particularly opaque and difficult to get an idea of where spot and forward prices are trading. So just if we kind of recap last week, Julian, you gave us a bit of a breakdown of what makes up the price of diesel at the pump. Mm-hmm. Maybe we'll recap that briefly and then we'll go on to talk about HVO as well. And
absolutely, Tom. So this pie chart actually you can find on our website if you navigate to Flux Markets /diesel. We're taking government data here and then blending and decomposing that government data to give you this pie chart. And I think one thing that's really important, if you subscribe to Flux Markets, you can dig in and see this value changing in the future, which is really important. Some people are aware and other people aren't aware that the pump price is one thing, that's today's price or the spot price, i.e. for immediate delivery, but actually this price evolves over time, and at the moment actually it's getting cheaper the further forward we look. And in this time of where everyone's very acutely aware of affordability, it's really important. As you say, that's much more difficult to do with biofuels. And actually on this pie chart, there is a sliver there. Let me just see, it's the RTFO costs. That's the cost to be compliant to blend in biofuels. So that yellow sliver there, it looks very thin. It's about 7-8p. It varies. It's been as low as 0 and it's been as high as 12-13p. So it's very variable. It's a substantial amount of the fuel price at the pump. And that is driven by the cost of blending fuels into diesel. And we're going to look a little bit more at that today. So just looking at that pie chart in a different way, in terms of thinking about affordability, that dark blue part is the raw cost of diesel. Then the green part's that renewable transport fuel obligation, the RTFO compliance cost, the cost of blending in the amount of biofuel to meet the RTFO mandate. And it's really important here, B7, when you're filling up your car with diesel, you might have noticed that it says B7. Diesel cannot be more than 7% bio, physically. So the actual RTFO mandate, if you look at it, it's today around about 14-15%, and it's increasing over time. So in terms of affordability, that cost is that yellow sliver is going to increase, right? And that is being driven by pressure, various different pressures, feedstock pressures. We can cover that a little later. It's pushing that cost up.
So that's an important point, actually, just to kind of reiterate. So you're paying for 14% biofuel component, but actually only 7%
is actually going into your car. Yeah, it is a really important point. You're absolutely right to pick that out. But it actually, the grid is decomposing. What I view, the network, I should say, is that's the entire sort of fuel pump network, whether it's physically large bulk fuel being delivered into a bus company's depot, or whether it's a retail person filling up their car, ultimately is decarbonising by about 14%. RTFO, keep those statistics. You can look on their website to see that if you want to, and the history of what actually has been blended in. And we'll come back to that because 7% is the max here. So how on earth do we get to 14%? That's through a different type of biofuel, HVO, which we'll have a look at in a second. And on the previous slide and on this slide here, we've got these two red bars. Affordability is a key thing at the moment. And if we look at those red bars for the previous slide and for HVO, this is the government tax. This is duty, 53, almost 53p. That bigger bar there on the right-hand side and the bar above it, that's VAT. So VAT and duty together are a substantial amount of the diesel cost. And what we can see here is the UK's UCO, used cooking oil, that stands for HVO. And this HVO has apparently a significant greenhouse gas savings. That is, it's more, a plant was planted over a year ago. It sucks CO2 out of the atmosphere. That plant was planted to produce cooking oil. That cooking oil was used to cook. It's then been collected after being used and fed into a refinery to produce HVO. HVO is very expensive because you imagine picking up a lot of 1 litre bits of used cooking oil everywhere and then bringing it back to a refinery and redistributing is expensive. And what you can see here immediately on that blue bar, the raw cost of HVO, used cooking oil based HVO, is 3 times more expensive than diesel. Okay. Now, this has got an orange bar on it, and that's because this market is subsidised by the RTFO scheme. So when you buy diesel, that little green sliver, we were looking at green sliver on the previous slide, that 7-8p has been collected. There's billions of litres of diesel being consumed in this country. That's going into a pool at the DFT, and then the DFT are redistributing that pool for people bringing in 100% HVO and other biofuels too, and they are then getting subsidised. And I always say a subsidised market's not ideal. It suggests fundamentally it doesn't really work, possibly, right? Thinking about affordability, this is not a great situation to be in, but however, HVO is the easiest fuel to try and change over to a greener fuel. And I'll say that in inverted commas because I'm not sure how green HVO really is myself. But anyway, so this is expensive. Tom, you want to say?
That was, a valid point. I just want to say about HVO versus sort of other biofuels like FAME and Ucomi is that HVO is fully interchangeable with diesel, isn't it? So
yes, it is.
You can run it in a normal diesel car. There's no kind of cap on how much you can blend. Absolutely. And it can also kind of sit there in a reserve tank indefinitely almost without breaking down. So it's quite
absolutely right.
Desirable for things like data centers and things like that for their backup generators.
Back to affordability, you don't need to change any of your pipelines, don't need to warm your tank. So some biofuels like fatty acid methyl ester, you need to, if you went with a 100% fatty acid methyl ester, it's cheaper, but actually you have to heat your tank, heat the line, and make changes to the vehicle. With this fuel, there's no change. So it's an immediate replacement with no capex, no capital expenditure. So this is considered the fuel to decarbonise this network at scale. And when I say at scale, we're at 14% now. Come 2030, we're at 30% for the EU, and the UK is following that trajectory. So we're going to see more and more of this coming to the pump. And I put this in inverted commas, pump price, because you generally can't buy HVO at the pump at the moment.
Yeah, I was going to say, in terms of demand for HVO, it's still kind of industry, right?
Yes. Yeah.
It's not like a kind of commercially available fuel for retail consumers.
One reason for that is, as we look at this chart, is the expense. It's 3 times more expensive.
That's who would actually buy it?
And it's really companies coming out of COVID that were really, they've got a lot of, they've got their customer base were very focused on decarbonising. So, just imagine a pizza box from pizza supplier down your road with "we've gone green" on it. This would be one way they'd achieve that ESG focus. But of course, with affordability being so apparent in this country at the moment, tax burden and everything else, this is a real issue, and this is an expensive fuel to change. So pump price here, this builds up to £1.83 with VAT and duty on, with no supplier margin embedded into that. Whereas today I can buy diesel at £1.40. So it's significantly 50-60p more expensive. It really is. And again, in the context of 50 litres, that may not feel unachievable. It's on affordability on a personal basis, of course. But if your Domino's Pizza is consuming 30 million litres of diesel a year, 60p is now a very big change in cost. Yeah. But you were saying, Tom, we've had a lot of people coming and asking us about benchmarking.
Yes,
absolutely.
Yeah, because lots of these companies are using these fuels. They're kind of they're significant purchase of it, but it's very difficult for them to get any transparency over where the market's trading, and particularly particularly to gain access to a forward curve. Because they want to hedge their demand going out 1 year, 2 years, and there's whole market's completely opaque, really, isn't it?
Yes, it really is. And maybe that's a good point to go to the next slide here quickly. So if you were a subscriber, and you can get a free trial, so you can check these numbers out, you can log on and see these numbers changing every day. We're marking them every day and live during the course of the day. And, HVO is still a developing, fuel physically and also on a forward market basis. We've striven to put it on here. And what you can see here is this now doesn't include VAT, okay, but we do have duty on these numbers, okay? So you need to add it, and it doesn't include VAT, it doesn't include supplier margin either. So this is the fuel with duty without VAT and supplier margin.
So it's effectively like a kind of wholesale price, isn't it?
Thank you. Yeah, exactly right. Well, yeah, good addition. And what we can see here is actually the BALMO or spot forward numbers were £1.52 for HVO. And we've had a few people going, that number's completely wrong. I can buy at £1.30. Why? You're completely wrong on your number. This number is good. And as what we can see with the forward curve here is it's very what we call backwardated. It's getting cheaper and cheaper as we go further forward. And it drops off into 2026 to almost £1.30, £1.31, £1.32-ish. And if we took an average of 26, it'd be around about £1.32 and a half, approximately, right? Comparison to diesel, right? Diesel, ex-rack diesel with duty, no VAT, no supplier margin. That is around about £1.2. So we got £1.32 and we got £1.02. So we've got about a 30p difference. And if people are often looking at HVO and diesel, both fixed price, this is a really good platform to benchmark what your supplier's offering you, first off. So real live example, we've had 3 or 4 people in the last week coming into us, your spot number's wrong. We can buy at £1.32 on diesel, £1.33 on HVO. Okay, and we can also buy diesel plus a fixed premium. Just for example, £1.25p. So how would you use this platform to compare floating diesel price plus 25p for HVO? So the HVO is priced on diesel. You'd look at the diesel line on the right hand side here. Look at the 2026 value, about £1.02. Add on your premium 25p, that works out to be £1.27. So you could range your physical floating plus that differential, come on here and hedge on diesel to lock in your HVO supply cost at £1.27. Or you could buy from your physical supplier at £1.32p for the HVO. So the platform's really useful for benchmarking and actually asset checking. Am I getting good value with this fixed price offer from a supplier, or should I build it by floating and actually hedge independently?
In both of those examples, I think that the platform just makes it really clear there, isn't it? That's a great deal and you should absolutely go to your supplier and lock that in. And I think it's worth mentioning as well that the supplier might not be pricing based on spot or where they see forward. They might still be pricing on where they bought the inventory.
And that might have been 2 or 3 months ago. It might have been that they aren't holding inventory, but they've got a contracted price that they arranged 2-3 months ago, at the beginning of the year even, because the volumes of HVO are around about, from memory, it's around about. I need to think this through. It's about 400 million litres. Last time I checked, it's probably higher than that now. And it will increase because of the changes you mentioned. And we'll come back to this in a minute. We're going to see more and more HVO coming online, more and more need for people to control and benchmark costs. We think the platform's brilliant for it. And as you say, your supplier's volume turnover, it's not the same as diesel, where they're literally turning their tank over 1 or 2 times a day, right? That's not the same case for HVO at the moment, because the uptick it's a fraction, it's 1% of diesel turnover, right? So it's much smaller turnover, but it's going to increase massively, I think.
Yeah. And then I think, Harry, you were going to give us a bit of an overview of what's been going on in the diesel and HVO markets, actually, which kind of might help to explain a little bit how those suppliers are able to sell HVO so cheaply, because we've been in a bit of a bull market.
HVO has been in a bull market this whole year, basically. I mean, we'll see some charts in a bit, but there's this chart actually on the screen at the moment is this is the gas oil swap, and since we filmed the show last week, there was sort of there was a global rally in gas oil prices, which is the benchmark for diesel prices, and this was caused by a number of things. So there were some announcements on kind of further sanctions on Russian companies who supply a lot of the refineries in the east still. So that kind of squeezes the margin on these refineries in the east to procure crude from elsewhere. So we saw gas oil versus, we've touched on cracks last week, but the difference between the gas oil product from the refinery and the feedstock crude oil, that differential blew out completely for gas oil this week. And we just saw outright gas oil prices. I think they outperformed Brent by about $8 a barrel.
Yeah, had a huge day on Wednesday, didn't it? But it was also kind of, I think Tuesday had already started rallying and
yeah,
almost did about $100 a ton, didn't it?
Yeah, it did. Yeah, and again, you never really know. The Russian sanctions, they get announced. It's all a kind of bit of a perception thing because you never really know how they can actually materialize. But whatever, the price action was strong. There also was some news of some refinery outages, one in Kuwait, I think one in India as well, where some of the secondary units were offline and took a significant capacity offline. And again, these refineries were big middle distillate producing refineries. So coming into winter, and you've got kind of cold weather as well, coming into winter, it's, the stocks were quite low around the world and the market was kind of primed for shocks to the upside. So when you have this kind of news, it just completely goes hyperbolic.
Because we've been talking about tightness in this market, like even since the summer, right? And I guess the kind of moving into winter, then that you've got this additional like seasonality dimension as well.
Yeah, and it was maybe waiting for a bit of an impetus to move. And when you've got a market kind of primed like that, when you have like a shock, multiple shocks, this kind of thing can happen.
It might be worth saying to some of the listeners just why would India and the Middle East impact the UK? And some people may not realise we hardly refine any diesel in the middle distillate here at all. We import everything, right? More or less.
Europe's an enormous diesel consuming continent, but it's not an enormous diesel producing continent. So it relies heavily on imports. And since the whole Russia war's been going on, the kind of global, Russia was a huge exporter of diesel
to the UK. It was kind of coming in through other countries, but effectively all of this stuff, any kind of shock to global supply is going to shock Europe as well. So even though it seemed like it was the Singapore contracts and the kind of Asia contracts that were driving it, because they are the kind of purchasers of this Russian crude, and that's where that Q80 refinery supply would likely go as well. But Europe's not immune to it. It's a very import reliant continent. So any of this kind of global supply disruptions is going to massively affect Europe. And we've seen kind of in June as well, when we saw like tightness in like the Middle East and tightness in the US. It was the Europe contract that did a lot of the work. The Europe contract blew out again just because of the reliability on imports. Yeah, thanks, Jim. It's good point. And then this chart was just to visualize. So this is the wholesale HVO. This is the dollars per ton price of HVO cargo. And this is just to illustrate kind of since the summer, but we've seen kind of more broadly throughout the whole year, just a really kind of steady, sometimes aggressive bull market. And various reasons, but recently, and I'm going to put you on the spot a bit here, Julian, but that's fine.
But recently, the narrative has been around some of this new EU legislation,
absolutely,
which is kind of squeezing the kind of putting a perceived squeeze on biofuels.
It certainly has. What struck me before I answer that is just what I want to point out. That raw HVO cost here is $2,600 a ton. Mm-hmm. Raw diesel cost is $700 a ton. So it's more than 3 times more expensive, this fuel. Hugely expensive. To your point, your question you were asking me, Harry, there's been a confluence of issues. Close to home, we have, actually went live in May this year, is the RED, Renewable Energy Directive 3. It's the 3rd generation of the RED directive. And this is an EU directive, and a directive means we're directing countries to adopt this and bring it into legislation, and it's up to the countries in the EU how they adopt it. So which makes biofuel trading very complicated as a result, because they all adopt it in different ways. And some have adopted it and some haven't, at different stages, although it was supposed to come in full force in May this year. The key thing about Red 3 is that it is getting rid of double counting. So if you cast your mind, let's quickly go back to that slide for HVO for a second. And see the orange bar there? That's the subsidy. It's discounting the price. And that subsidy is double counted. It's 2 times the subsidy. That double counting is going to disappear. And we're going to use GHG, greenhouse gas savings. The amount of carbon this fuel actually saves will subsidize this fuel cost. So it won't be double counted based on used cooking oil. And subsidies themselves can, I always think, I might have said this before, the Indian copper effect. There was this, 200-300 years ago, too many coppers, people getting bitten. So the local sort of councillor said, you know what, I'll put a 1 rupee on every copper's head. And suddenly noticed that more coppers were coming, heads were coming over because he had an incentive, right? People were now farming coppers to collect the incentive. So there's this perversion of subsidies, and this can absolutely happen with used cooking oil. Used cooking oil can be more expensive than virgin cooking oil. And when that's the case, virgin cooking oil gets classed as used cooking oil, right? So yeah, anyway, the point really to answer your question, Red 3 is getting rid of double counting, and counting will be on a greenhouse gas basis. We could do a whole topic on that. Let's come out of that for a second. So that is going to drive up feedstock demand. So instead of 1 litre of feedstock getting 2 times the subsidy, I now need to bring double the amount of feedstock in, almost effectively, right? So it's put demand on feedstocks. The other thing Red 3 has got rid of is POME. So palm oil mill effluent. It's a really nasty thing, but it's a derivative of palm oil. And lots of people are anti-palm oil in the ESG movement because cut down lots of rainforests to put this in place. Arguments for and against it. Let's not go into that right now. Getting rid of POME, there's a lot of it around. And this now means there's more demand on feedstock. So feedstock prices have gone up, HVO prices have gone up. The other 2 key pieces, actually the other piece that we're missing from this is in the States, the EPA, the Environmental Protection Agency, have just massively expanded their amount of renewable diesel requirement in their to decarbonize their network. So that means no exports from Russia, from the United States, excuse the faux pas, from the United States, leaving the United States because of Trump's tariffs and also the EPA. So there's been a whole confluence of things that have really put massive pressure. And then the other thing is that we've got legislation for SAF coming in for CORSIA, for airlines to decarbonise, for marine to decarbonise.
And that's SAF is sustainable aviation fuel.
Yes, exactly.
There's a lot of acronyms in there.
Lots of acronyms. Yeah. So it's equivalent, it's the jet fuel equivalent of HVO. So SAF, sustainable aviation fuel, is produced at the same time from the same refinery, part of the refinery that produces HVO, but it comes out lighter end. Okay, and it's blended into jet fuel, maximum 50%. That's gone through the roof as well, along with HVO, because now that we've got this huge focus. So legislation's driving change, driving feedstock change, feedstock cost. There's not enough of these feedstocks around. So in terms of affordability, I can see diesel at the pump getting more expensive. Another reason to come on and look at the platform to fix in your costs, right? And this is not today, tomorrow, but gradually, almost imperceptibly over time, over the course of the next 2-3 years, we'll see diesel going up and that yellow wedge increasing in cost. Bigger element. Okay, the flat price might change, go up, down, but that's going to increase effectively, and we're going to see these costs escalate, I think, as well. Anyway, that's it in a nutshell, I guess.
Cool.
So yeah, I guess then in summary, I think it's just so important, isn't it, having that visibility into the future, being able to see that forward curve, and I guess being able to use that to inform your procurement decisions today, but also secondly having the ability to kind of lock in prices in the future.
Yeah, talking about the backwardation of the HVOs, I think what a lot of people don't understand is, well, if you don't have the visibility on the forward curve, you don't understand how different those values can be in terms of, your spot versus your 12 months out, say. So when you're budgeting or even getting quotes to lock prices in, a lot of people are your providers are going to be relying on the sort of opaqueness of the market to to really kind of capitalize on you not knowing how kind of backwardated this market was. You just taking one price and extrapolating it for the rest of the 12-month period.
100%.
But also if you're budgeting, quite often in backwardated markets, there's a lot more kind of favorable prices to be locked in the future than you might think, being like, well, if the prompt price is £1.50 a litre, just the wholesale price, why would it be like £1.10 a year out? That doesn't make sense. But when you look at the curve, that's kind of like how these markets work, right?
And those prices do tend to roll up, don't they, as they become more prompt?
Yeah, absolutely they do. And I think it's about, you want to compare apples with apples, pears with pears. So you might get one supplier showing you for the same thing, a pear price, an apple price, a pumpkin price, right? But you need to be able to decompose that. So you want tools. You may not be financially hedging, but this will give you those tools to be able to assess value better. And the feedback we've had from 3 major logistic companies is that this was very handy for them to make a decision how they would contract that physical fuel purchase. So not coming here to financially hedge, but to actually engage and work out best value, where to go.
For sure.
Yeah, and I think probably as we've sort of illustrated here, this is a very complicated market to navigate. There's a ton of rules and regulations, a ton of subsidies. Those subsidies are changing all the time. So anything you can use to help give you better visibility is just incredibly valuable. And obviously we're here as well to help our clients as well, and to sort of guide them through the best way to use the platform and kind of how to get the most out of it.
Yeah, absolutely.
Great. Well, I think that's about all for this week. Thank you very much for joining us again. And we look forward to speaking again soon. Once again, I think as we mentioned last time, if you do have any burning questions or there's any subjects you'd like us to drill into in a bit more detail, please email in, tweet us, and we'd be more than happy to discuss it on the show.
100%.
Great. See you next time.
Nice one.
Thank you.
Hi, Jordan. Thanks for coming on. So this weird situation where like probably some people watching this in the industry know exactly who you are. Infamous, some might say, others no clue, right? So just to give a bit of context, you are a recruitment owner, you're a recruitment firm, sorry, you're a recruiter owner, you're a recruitment firm, and you've actually in a weird way been on the same journey as the Onyx guys, the Mandara guys, the market makers, and going from, you know, small young businesses and players to growing with it. You know, very much AEJ has grown, and you've been helping, you know, hire grads and now senior people. Now you're doing, you know, loads of stuff in different areas and hedge funds and all the rest of it. But I thought that's why it'd be interesting to bring you in, because there's a lot of context you have in the industry. You've literally lived and breathed it in the trenches almost, right? You meet with brokers all the time. You're in there with the traders. You've watched them grow and watched them become managers. You know, 10 years roughly. It's a long time. A lot can change. So that's the context for the viewers. But I guess like starting out, like maybe we could just hit straight away with like maybe the major things you've seen change, or maybe we could just dial all the way back, comparing right now to the very beginning, how the whole landscape has changed for traders. Let's start with that.
Yeah, for sure. I mean, obviously, when I first started working with you guys, we did a big push on trader analysts and
which is grad trader, junior trader, kind of grad scheme stuff.
100%, yeah. Like assessment center. What do we think would be creating a good characteristic and background for a successful trader, right? And so fast forward then 5-10 years, you see these some of these excel and become heads of desks or leaders in their own right of asset classes, etc. So I think that the journey that a trader has to go on massively is one of, I would say, first you've got to think about yourself, how am I actually, of course, employers have to be attractive to the candidates, but from a candidate perspective, how am I attractive to an employer, right? And so firstly, when you're gathering those types of people into a business, you know, grit, resilience, and relentless self-improvement.
All these like classic trader traits. But I think, yeah, now you've just triggered memories. Like, you know, you were there when we were saying, okay, there was this way that we hired in Mandara, and that we got hired in, myself and Omar and others who are now, you know, trading as managers and owning businesses.
Yeah.
But it was not as simple as to say, let's just do what we've done, because times change, right? You need to evolve the recruitment and what you want with the times. So it's very much that, like, when someone says what makes a good trader, that's what you just said. It's like, you find it hard to define, like, because it's so intricate depending on the business, depending on like then and there, what the business needs, right? And I guess that's probably the first thing. It's like when people out there see grad schemes, like a BP was a huge one. I think Glencore are doing more of it now. Trafigura have like a kind of semi one, and we're very much like fresh grads, but like we think we can mold people. But it did like change quite a bit. We've gone like super sporty, super like voice trading style people, gregarious, all that, to suddenly like super quantitative, and then in and around those, because it's what we think we need at the time. And that must be from the outside in quite weird in a way. But I guess, how do you manage that?
Massively, and also a lot of people had a few big decisions to make. You know, like BP and Shell. I mean, correct me if I'm wrong, but it's as a graduate going in, it's probably a 3-year shift, you know, a desk shift rotation. I know that people, when they first come out of university, were getting bigger salary offerings at the time, and then you say to yourself, but you know, do I believe in myself to work for like an Onyx, a market maker, where I'm going to get a lot more opportunity, and then in 3 years' time, turning around looking at my peers, and I'm far further ahead, and actually adding more value and making more money.
Well, that was always the promise, again, like for the market making side of things. It's like, come join us. And if you go and research, people say these are small players, these are the bottom of the rung, or whatever. And as you say, you're going to get more money at bigger places, but you're going to be on this, and you've got a big brand, but it's going to be 3-4 years before you even get a look at a seat. So that was the spiel back about banks versus and the big majors. That's the dichotomy, right? You go there, 100%. You get there, you go there, and then they kind of had to believe that would happen, which is quite hard to believe, because just because a few other people did it, why should I believe it? So that was always the challenge. You got to take a lower salary and take a chance, but you do get a lot of autonomy and
to
all
begin
that.
with, though, as well. Like, it's okay, so I'll earn more money now. It's that black hole belief I've always thought about. It's like, and it's in anything, sales, trading, technology. Do I believe in the vision and the mission of the business I'm joining, as well as my own skill set and confidence in my abilities, that I can be ahead of the curve than the others, knowing that I wouldn't get as big as opportunity there, but I get paid at the beginning earlier.
Yeah, so you've had to get inside these guys' minds, like guys and girls, like intimately, right? So endless. The amount of calls you must have had with people that I've never met because they never make
Literally
it, right?
thousands.
And it's just getting into that psyche, and like, I guess there's so much to unravel here, but like, to begin with, I think it'd be interesting to say, it is challenging for a grad, and actually for anyone in a career. You're thinking, what route do I actually take? And I think as owners and as managers, you're always tempted to have a kind of closed off mind, being like, why can't you see, if you join here, you've got this massive opportunity to learn and to have autonomy and all these obvious things to you because you've seen it and how, but they don't know. And you're told not to trust employers. You're told to, like, obviously,
or recruitment people either.
or
search
recruitment
you
people.
know.
So you've got to make this judgment decision. So then you go out and talk to people in the market. They've got their own biases, though. It is a very hard position to be in, isn't it? So, like, I guess I sympathise with people starting out, but
that's why I find it super interesting and actually exciting about it, because so someone comes in with all of their background, family, expectation, right? So we want you to go to a big name brand. You've gone to a top university. I mean, look at people that we placed, right? People that were at Cambridge and worked their way through university, like, you know, working at anywhere, like McDonald's, for example, making sure they do that. But then their expectation potentially could be go to the big name. The risk you have to take as an individual and the backing in yourself to go, no, I'm going to go with this company because I'm going to have a faster track of my career, getting the next future, you know, players of tomorrow to see that and actually hear it and understand it.
for traders, it's your first trade.
100%.
Do I take the job which gives me a more guaranteed route, if you like? And I think the other thing is that, and it's certainly how I thought, and I think people are starting to think more and more, is like, am I in the right area? Forgetting even the role to some degree, will this still be here? And we know that in 2021, that was kind of that peak, like, anti-oil, that was the peak, like, you know, whatever you want to call it, woke, like, all that kind of stuff was going mad, right? And we were losing people and not being able to hire people because of that. We can talk more about that. But again, it's like, you can forgive these people because they're looking at it going, look at what the media's saying, look at what people are saying. Why would I want to join a place or join an industry that might not be here in 5 to 10 years? It might change, it might be a pariah and all that. And how ironic that then 2 years later, everyone wanted to be in oil and energy because the prices went so high and everyone made so much money in the industry. And they're now going, well, actually, I wouldn't mind being part of an industry that's huge. And even like tech people we've hired are like moved from Amazon and Google and these places to join trade houses and people in oil and energy because they see that as the new thing. And the narrative has switched to, wait, all the AI and all that, it's going to be a fight for the world's resources. I need to be in the energy trade. And, you know, and that's so important. And remember, sorry, just to finish off, because I think you got some good insights on all this collectively, it's the parents as well. And before people say, oh yeah, you're older, you should be listening to your parents, people do even into their like 30s, right?
100%.
And you got parents who have their biases and their views of where things are going, and they obviously read the same media and listen to the same kind of biases and all that kind of stuff. So you've got all that to kind of go, well, this is my first huge trade as a person. How do I weigh that up? And I guess for me, back to you, it's like, well, find the people who are looking at that landscape that can, I think at the very least, think independently. Because if they don't, then they're just going to get swayed, and we're never going to be the shop they join because it's smaller relative to a BP or whatever. That's the first thing. But the second thing, it's like, are you going to be able to handle all the uncertainty and then you get into all the resilience and all that kind of stuff. But to lay you up, that's a lot of stuff. But that whole landscape, what's going on in the mind of these guys are saying, I guess I'm saying.
Well, firstly, I'll go back to your point about the whole sport background or the archetypal person that used to be a trader or is still a trader, but also then like the quantamental stuff, right? It's so brilliant now that you get that way up of characteristics and backgrounds and people, right? So you've got people that are computer science back, then going into the sporty people that come in. There's no actual one type of person that is successful as a trader. Then number two, coming about the wokeism or whatever was happening. So interesting. Before we had that smash of COVID where like everyone was getting a bit just obsessed with being so anti-commodities markets, and obviously specifically oil, which I understand, we literally used to lose candidates at the very preliminary conversations just from that defense mechanism of no, I don't want to work in that industry. It would look
Yeah.
bad on my CV.
Yeah.
I had that time and time again. That's totally okay. So you are looking for people, because if Onyx is the type of business that thinks differently, goes against the status quo to some extent, and challenges for all the right reasons, you've got to find the types of people that are like that also. Because otherwise, you have to bring the right people into the right business. It's a marriage of the way people think. And if you're not a critical thinker and you don't, and of course, by the way, your friends, your family, you have to listen to them. But hearing them and listening to them and just being told what to do are two massively different things. And I unearthed very quickly, the search team, just ways of being able to get to the heart of that very quickly, because at the end of the day, if you're not even going to see and get into a market and understand exactly what it's all about, and all you're listening to is the scaremongering news that was projecting at the time, you're not going to survive in this environment.
So I guess flipping that on its head then, you might have a candidate who you think has got some strong attributes, generic attributes, but they might not be geared towards Onyx because of what you just said. But on the flip side, you might be geared towards more of a major. BP spent a long time riding the trend of net zero, and they spent a lot of money on it, and they lost their CEO because of it, right? And the Shell was the same. So the point is that you could have quite easily joined them then, and I guess you would be, if you were recruiting for those guys, I guess you would have pointed them that way. But I don't think you really deal with the majors so much, but you do deal with hedge funds, banks. Yeah, banks, I guess similar, right? They do tend to follow narratives and stuff like that. But then brokers was the other one.
Yeah.
So do you find that ever with brokering on the grad side of things?
You know what, actually? No. It's so interesting. From a sales perspective, obviously, because it's sales and trading. Not at all, because I think, and this is just my personal opinion, of course people will see it differently, but I think sales is such a relentless, awful environment sometimes that I don't think you really...
You don't have time to think about these other things. You don't have time.
You've got to love sales. And by the way, same with trading. That's why real traders through markets, whatever asset class or market you do, you're obsessed with markets, nothing's impact. And the commodities markets affects financial markets to its entirety. But on the sales perspective, they don't really care as much, because it's like, I want to be a salesperson, I want to build networks, I want to make good money, and so they just want to work insane hours, entertain, build relationships, and also as well, by the way, from a broking perspective, what people actually forget is they're a service provider. You're there, like I am in the search industry, recruitment. You're there to provide a service, and so you've got to have a service first attitude. And so when you're looking for a trader, it's got to be like ambition, ridiculously driven, but also you've got to try and have difficult conversations to unearth what type of person they are under pressure. And of course you do that through assessment centers or the way that you interview, but actually my job at the beginning is to see what their triggers are and to see how they're going to adapt to huge...
Try and unearth it the best you can. Because everyone puts a story on, like Leger, the guy who runs Sing, always says that, like a CV and a story is designed for gloss, right? It's a presentation of their best version of themselves.
100%.
And when you ask them certain awkward questions, they obviously think it's a question that they need to rebuttal and answer well. They don't actually think they need to genuinely tell the truth.
No, it's like justify it and almost like robotically come back and give you the answer you think you
might as
want.
well say straight away, like there's the recent hire who said exactly that, right? It was in like completely fine with oil, and then when it came to the interview, it was actually, I'm not going to interview because...
because what it would look like for the rest of the person's CV.
Yeah.
Yeah, but that's what I love about... so, let's look at it, right? So in terms of against like the oil majors and the other people in the industries that when you were building what you were doing, that I would say didn't think it could happen, so to speak, right? When you look at people like that, where you've got your media and marketing, your podcast and your production, that's exactly what it's for. So, because I really mean candidates do, even to recruiters, they present this version of themselves where they just say yes to stuff, people pleasing. Of course, I'll go through the process.
Give myself optionality. I might as well get the job and then decide.
100%, because whenever if I'm in a job, I can move to a different job. That's and by the way, selfishly, they're entitled to.
No, exactly. Then it becomes the company's job to be able to assess, but are they telling the truth?
Yes, but the beauty about podcasts or online literature.
At least you presented.
You present exactly who you are.
Yeah.
And then they can decide. And
Yeah, but again, you say that, but not all companies do. They use media to just pretend. Like you see the trade houses, like they do all their LinkedIn stuff is pure virtue signaling.
That's
I just
true.
find it so odd because I'm like, but then people are going to join you. They're going to realize you're a boys' club mostly, or at least like a club in general. You do funky stuff in the markets, like it's a trader, mentality a lot of the time. They're just going to think you just gaslighted me, basically. Like I always find that strange. You're gonna get the type of people that think that's what they want, and then they go into an environment where it's not like that. That's way worse. At least when someone's presented the realities and said some hard things and answered some hard questions, and then they self-police, don't they? Well, I'm not going to join because whatever.
But that's why it's super interesting working with people like you, Legier, John, because there's this like no bullshit mentality with it, right? Whereas
it's just a waste of time, I think.
Totally. But and that only I'm drawn to clients that have the same ethos, because the smoke and mirrors stuff and putting on a show is no disrespect for that's for BBC News. It's not for businesses that when you get under the hood of it and you've been missold a role.
But I'm trying to think why they do it, because again, I've been speaking to traders at trade houses like obviously all the time, but recently the most consistent thing that comes up is we've got recruitment issues for the next generation.
Yeah.
And you're like, it's so weird to hear them say it and then go, why don't you look at what you're presenting to grads though? You don't talk about they don't want to talk about the money they make. Okay, fine. But grads want to know how much money they can make.
It's the number one thing.
Yeah, it's the number one thing. The other thing is like you're presenting all this virtue signal stuff. They don't want to work for a virtue signal company. They want to be a trader, and they want to cut the bullshit a lot of the time. So that's what you're presenting. So why do you think you're getting people who are just like, and then they see roles that aren't specifically about trading. They're like these like words that are a bit like, you don't know what they mean. I think Vital got commercial analyst. Like, what's a commercial analyst? Like, that's fine for you guys, but I think it's confusing for a recruiter. And we found that with trader analysts. That's why I corrected you at the beginning.
Oh, sure.
Because trader analysts were like, it sounds like you're going to be an analyst. It's like, no, you're a junior trader.
Yeah.
We're going to train you to be a trader. We kind of made that was a mistake, I think, all these years, really. I mean, whatever. But I think it's a useful point. It's almost like advice, whether they take it or not. But do you see what I'm getting at? As in, like, I find that, I guess we're just agreeing with each other about that whole why present a version of you that's not you and then complain when you don't get the people that you want. So that's what I'm trying to say.
What do they think it is though? So from your perspective, it's your virtue signaling and presenting an environment that's not really true.
You're just not getting the pool in to assess to find the good people because you've presented yourself in a way that's not.
Okay, but also what they've done is because they're bigger companies, they're also being sloppy though. So in the sense of like, they're not really headhunting the next future leaders or the next grads.
They're also not thinking about it, I guess.
No, but because they're branding, they have thousands of applicants.
It's also very difficult for a trade house and even majors because when you're in trading seats, the incentives are all over the place. It's like they're not incentivized to get the next generation. And how can you get them to be incentivized? You have to be it has to be an internal business thing. Like, we're actually going to reward you for training traders, and like we give people percentage of the money that other traders they train make, because otherwise why would they care? Like, that's the thing that you've got to, if you want something, you have to incentivize.
But that's super well known in the broking world though. No disrespect to that, but everyone goes in and no one gets trained. Like, I know they go through like 5 to 10 juniors before they find the guy that or the girl that can cope in that environment. So like the fact that you address that, and when we're going to actually have because there's going to be a big vacuum of leadership issues if those companies don't.
But that's exactly what
that.
they say. The next generation, we're screwed. It's like, that doesn't really surprise me.
Let's drill down on it because growing up as a fresh grad now, right? Of course, it's not like war, famine that you go through, no problem. But you are in an environment where everything's at a click of a button, right? Uber, Deliveroo, everything. So to try and find those people that are actually creators and not consumers becomes harder and harder. So if they're not working hard at their recruitment strategy in that respect, then they are going to get the people that aren't going to excel, in my humble opinion.
Yeah. On the flip side, though, there are some very successful people that come through the BP scheme in particular.
Sure.
That was like for a long time, just like let them do their years at BP, get trained, and then we'll just hire them. Like half of Vital, Trafigura, and Mercury, these guys were just like all BP people.
Yeah.
But these days you are seeing more like the Glencores, like, and again, going back to the banks, we need to talk more about the banks. So they still have these schemes, and they do create some people, but I just think they're not playing. Personally, I think they're not playing the probability game well enough. They're not obsessing about it as much as us. But maybe we've got the time to. we do live and die by our people. Like we don't have as big of a system as these banks and these trade houses.
Yeah.
So it's just an interesting reflection. But anyway, I think this is going to be a new thing for them, right? The new landscape of how to recruit the best talent. And even when I started, and I'm sure you remember, it was weird to have junior traders like at 22. That was seen as like, I know that might be a thing at banks and these days it's whatever, but it was like, no, you need to be 5 years experience on a desk, worked your way up, and then you get a chance because you're lucky. And that's how it was.
Yeah.
So
Like earn your stripes, I get that.
yeah, it has changed. Like you can be a 25-year-old trade house trader now. That was a very unusual thing, I think, 10 years ago. So that would be one big change. So I think it's already evolving, but anyway.
Sure.
So, to kind of pivot then, I guess, what do you think some of the things that people struggle with in this industry, like to, coming in and then making something of themselves? Because the context there is like, why shouldn't I make this work if I have this CV? And, I might even just be quite talented, proven in different things. What makes energy, oil trading, sales, broking, what makes it unique to something else? Because isn't it weird that one person can fail in this industry and do phenomenally well in another industry and vice versa?
Yeah.
So what have you seen? What would you comment on that point?
I generally think it's an individual by individual basis, and that's an obvious statement. But what I mean by that is like, if you pull it back to the foundations and the simplicity of it, it's still always going to be work very long hours, understand and log into the system as quick as possible, and then bring exceptional, hardworking, and try and be creative with your ideas. Is it that those things are never going to change? And so the reason why people are drawn to the oil and commodity markets is because it's lucrative and you can make good money in it. And I'm sorry, but like if I'm I speak to brokers all the time. If I'm a broker in a different asset class compared to oil or commodities, everyone's trying to get into oil and commodities. With
That's where the money is right now. Yeah.
Correct. And I don't mean that disrespectfully to the other ones, but like I speak all the time to people. They're like, listen, if you have an opportunity for me in oil, like get me in. Yeah, massively. So if you can apply the same principles as an individual, if you're already hardworking, already do the hours, already going above and beyond, as a broker, if you're entertaining till early hours at night and you can do it and make more money from doing it and add more value to that company, why wouldn't you do that?
So it's basically like, can you bring the best version of yourself to this specific industry in the way it presents itself? And sometimes that's not feasible because you might have a fundamental problem with the way there are identifiable characteristics in this market of how people behave.
Yeah.
Well, the younger generation in particular, as they're coming in, we've got more females, we've got more people in general who just, you can tell they just think slightly differently. They're definitely in a new generation. You have those like, the difference between a 30 to 35-year-old, 25 to 30-year-old. It kind of blends. It's not so aggressive. But then now we're starting to see like a big aggressive shift from our senior traders at 35-ish down to like 22-year-olds that think very differently. And they're not even tempted, some of these, to go and get entertained by brokers. Like I social anxiety or like, these things. They're like pretty open about it, like, fuck that. And, or whatever it is. And it's quite interesting to me because they obviously will be the generation that the more that they are cohesive and the more that they are, they think collectively in a certain way, that will overwhelm any industry, right? You can't just like retain a way of thinking if it goes completely against the grain of a collective mindset. Do you know what I'm trying to say?
100%.
So I think that is coming. I know everyone says these things, but it does feel like a pretty decent shift. But it doesn't take it away from they are like super hungry and want to make money, of course, always about making money in this game, I guess. But they're not even tempted by, as I say, the classic things that would hook you in. But my point I was trying to make was, if you're not into that, like if I take like Ramona, right? She's like one of our top salespeople. She's in Dubai right now. She pick up the phone. She's disciplined. She's methodical. She's like made herself as much of an expert as she can without being a trader or whatever in trading. But she never really liked the London scene and the broking scene and the club scene. She's it's just not. She's like, I don't like it. Like, it's just not. And you could say, well, if you were a broker, you don't have a choice though. You better like that game or forget it, right? You're just not going to be successful. So she's taken a path within the sales arena that suits her, and then it's definitely the future. She'll be absolutely fine. But you see what I'm trying to get at in a way that you got to, if you're amazing, got the three things that you said, and then you apply it to this world that doesn't really, but then you don't really like it, well, then you're screwed, isn't it? So you've got to find that industry environment that you want to bring out those three things. Do you see what I'm getting at?
Totally, but how interesting and exciting for her that she just adapted it and overcame it and went to an environment where that's not necessarily the culture, right? And then you applied those in a different way.
100%. Yeah. And as you said, though, like, you're back to your three things. She's got those, but wants to apply it in an area that it gets rewarded and suits her, rather than being like, okay, well, I'll adapt myself.
Exactly. I won't go with the status quo.
Yeah.
I'm challenging that. By the way, I see it all the time. I totally agree with you, Nick. Like, it's less of a, it's of course networking and get to know people and stuff, but less of probably like a drinking and that sort of like, and being entertained culture as well. And that's great for it, because with the digital and AI advances that are happening, you need to constantly, if you are in a service industry, you should be thinking about adapting and thinking, how much can I add more value? Not just from building a relationship and going for a beer. It's got to be like, the people like Ramona, that mindset of like, acting really fast, getting herself out there, moving to a different environment where her skill sets add more value. That's exactly the way that you should be thinking, especially if that's the way that the trading mindset's going.
But if you were a father, which you are, and you've got a child and they're going into the industry, you want to give them advice if that's the way the relationship goes. You got to admit, most parents would just be like, look, just find a way, just find something. They just want you to be safe and secure, right? Like, just get it working no matter how. And a lot of the time, the advice is like, so find a mentor or find someone that you want to work with or work for, and then like basically follow that person, which has definitely got its merits, 100%, right? But the flip side, what I was trying to get at was like, it's a risk, because if you follow a certain mindset that's dying, that's another trade you've got to make. Like, what type of thinking do I want to have? Because I'll take myself, I can even really talk for myself, really. And I just didn't like, maybe it was a sign of like where I was versus, I wasn't in a trade house or whatever, but it was very much like, if you're in this game and you want to be successful, you have to earn your stripes, like you said. You have to, the big guys are the big guys. It was just like boarding school. Like, you have to respect us because we're 3 years older than you, and it's that kind of vibe. Fair, it's just like almost like the army or whatever. But it was like, I was just a bit like, nah. Like, it's a very protectionist mindset, and I think all the things that you guys are threatened by, well, I'm starting to realize the things that you don't like is what you're threatened by, and I can see the trajectory of the market making and the markets becoming more digitized, becoming more fast paced, and all your kind of like bully boy, shoot from the hip, oil kings is dying, but they're trying to hold on to it. So there are people that have done phenomenally well at my age, or even way older, even now, who have gone, no, I want to go along with that. And they get a good seat at a trading house and a desk, and they smash it. They make a ton of money. So you can't knock it, right? But there's other people, as I say, like for me, I was like, no, I just don't want to do that. Like, I just don't see it. Like, my trade's going to be, and I'm going to go against the grain. And most people, like, fucking hate that idea, right?
I think it's because they're making a decision out of fear, is the most thing I would say.
Right.
They're afraid to challenge the status quo. They'll just go along with it, because if they're getting advice from their friends or family, especially parents, about being safe and getting into a job and security and all that stuff, you're not going to necessarily. And by the way, then that's why you've got to be totally adamant about who I am in terms of when you're going into the world of work. What's my character? What's my attitude? What's my principles? How am I addressing that? And actually, when you really look at it, like, you don't want to get sucked into a career or an environment where
15 years later,
you're literally, you've got to go into it and go, okay, I'm going to work on myself massively. Because, by the way, in terms of like, because let's not bullshit. Brokers and traders and technologists in this environment, it's relentless. It's constant. And you have days where you're exhausted because you got on at 6 a.m. Or you have days that when the war breaks out and you're here on Sunday night sleeping in to make sure you get it all sorted, right? Or if you're a recruiter and your client in Singapore asks you to go on a call at 3 a.m., like those things, that's what it takes for you. So if you're not that type of person where it's like, right, drop a button, I'll be there tomorrow, don't worry. We'll leave the office when it's done. I think that's what people have to be more actually.
But I said that wouldn't surprise people to hear that, right? Everyone kind of knows. But I think what might surprise people, we'd be very curious to get your opinion on. Having been, you're now 35, don't want to age you.
Old.
But, that is a shift from always being the young guys, right? Yeah. Suddenly, like, in the decent chunk of your career. And okay, I would say my point of view is this is around the time where you look back at those decisions and you go, day one, 10 out of 10 about money, 10 out of 10 about, not security, but as in like opportunity, basically. Sacrifice everything for the opportunity or whatever. For me personally, I'm sure a lot of people. But as you go through years and you build yourself a career, assuming you get a baseline level of security with pay or whatever, the priorities do shift. And it's things like, again, I actually can't speak for anyone, but it's things like, what am I actually doing? Like, it was so funny. One guy we had from a trade house here, he was only here for a year, but he said the thing about where I was like, they used to beat you into submission with compensation. He's like, I hated the concept of what I was doing. Like, basically, you know, like Le Chiffre in Casino Royale, like doing all these dodgy deals, whatever. He's like, it's fine, whatever, no judgment, but I didn't like my role in that. And
but he couldn't walk away from it.
Couldn't walk away from it because you're making all this money and the potential's so high. And you know, what are you going to say, you know, your wife and your kids, whatever, you could have a much better life if you just shut up and keep going. And so it is about priorities, but what's your view on that, basically?
When you get to it, so obviously we're both now 35, so when you get to a level where you've got dependents and a lot of things count on you in your life to a certain level, of course you've got to take less risky moves. But when you're entering into the market and growing your thing, all I was interested in was allow me to, if I work as hard as possible and I am successful in a way, allow me to develop and don't hold me back and all that sort of stuff. Of course, then if your mindset shifts when you become, and you have more things to worry about, for sure. But I think what do people move and leave for in terms of companies?
What starts to matter in their head, you see what I'm getting at? Like, so for example, another guy who's actually back with us, funny enough, he left in 21 because his daughter was making him feel bad, essentially. I'm obviously paraphrasing, but like, didn't feel comfortable coming home saying I worked in oil. And now it's kind of done full circle, like whatever. But the point is like, these things are powerful. These things do affect your mindset. And I guess you do have to have a little bit of thought about it, even at the beginning when you're so ruthlessly like, no, I just need to get myself on the ladder. I need to whatever. But you know, you want to be a little bit careful because in 15 years time, it may sound like, you know, it's miles, and it is miles away, but as soon as it gets there, be careful what you're good at. Because then that's it, yeah? Like, that's in True Detective, Matthew McConaughey was saying that. He's like, basically, we spent the last 20 years obsessing about like child rapists and stuff like that. He's like, Jesus, be careful what you're good at, because this is all I think about, and it's horrible, right? But that's the thing. I think people should think about it like, and I'll answer. I think most people don't think about it, but they start to, when people say like, why do you even do this anymore? Like, what are you doing it for? It's like, because I've got an internal narrative that keeps me going beyond just the money, right? There's loads of things that like I feel like there is a mission here. There is something that can be beneficial to the world. There's something that challenges me. There's all these things that they do actually start to matter. But
I think that's what people actually respond to.
Yeah.
Like if you're going to have a lot of opportunity and there's a clear mission and that speaks to you, that's naturally why. If you're a high performer and you can.
But people's listening there or seeing what you say or recruits, they'll be like, it's just the standard spiel.
But the thing is, I don't think it is though, because
I don't think it is either. But that's what they say.
Because there's loads of other industries. Look at all the successful digital marketing businesses. I'm obviously stereotyping there, but let's look at any sort of like modern day technology business, for example. That I have clients like that, and they're completely different makeups. They're it's the old adage of like sleep pods and all that sort of stuff. And it's a completely different set of principles where people really adhere to that, and it's totally, and they can work anywhere in the world, and they can. There's no hours, there's no annual leave set. There's no real necessarily like there's the perception of you've got more freedom, but that also comes as a trade-off and a price, because you don't necessarily.
But that's again trends and narratives. Like you're seeing. Remember the COVID work from home thing?
Yeah.
It was like you will never have to work from home. Work from the office ever again. Remember Twitter said that, or some other company said that. And then you have to renege on that and be like, everyone has to be on the office. Basically, it's very risky for a company to go out too much with these stuff. Like I think Google with their I think they've had to rein back. Actually, I can't prove that, but I think a lot of their sleep pod stuff and all that has toned down. But it all comes back to what you said like 20 minutes ago, which is like oil and energy is making money right now. or it was 2 years ago. So suddenly you can afford to do certain things, but as soon as the money becomes tight again, you can't do these other things. Like, you know, if you've got a work office space and you spend $1 million a year on the rent, you can't not have people in the office. Like, these things start to matter once the margins go down. I think in technology and all that, you're starting to see that squeeze. And will they still be like, well, the great thing about working in tech is you get flexibility, you get this, you get that. It's like, will you though? Because once the money starts squeezing, how will those businesses afford to do that? Do you see what I mean?
I read the other day that operating expenses are up like 45% for businesses. So what do you do with that?
Well, that's what I'm saying. You have to tighten all these things.
Totally.
But again, it's another trade for an employee to make, either grad or any, to be like, are these perks, let's call it, my rights, or are they what is out there because of the money? So if you really want certain things, flexibility, whatever, then you need to find an industry that can afford it. That would be how I summarize it, and that needs to factor into your thinking. You see what I mean?
Well, 2 points. So a friend of mine actually experimented with his business, and he did unlimited annual leave. The best employees barely ever took it.
Yeah, that's a classic.
Yeah, best employees barely ever took it. And then the 5-day in the office thing versus hybrid versus fully remote. I speak to so many different types of people, and it's all circumstantial. So I work with a tech business, a tech group, where they are fully remote, and they literally, and they'll have slightly lesser budget bandings for their roles, but people will literally move for a job, say like 10, 20 grand less, because it completely sets up their life for fully remote.
Yeah.
Whereas some people need social inclusion. They have to be around an environment of working for. Like, I personally can't work from home because I would deal with
You're
far
watching
too
these
many
narratives shift and evolve in real time, right?
all the time.
Wasn't there a recent one, no, maybe more like 2 years ago, when it was like a lot of this money was getting squeezed in tech companies in particular in 22 when the kind of things burst or whatever. And the thing was, can we stop this pizza nights and Christmas parties and stuff like that and just pay me more? Do you remember that was the thing?
Well, also that, do you know what they did? So whether they did it subconsciously or consciously, I'm never going to speak and say the business did it on purpose, but they were essentially just creating like prisons, but like they were essentially creating environments where you didn't want to leave, like games room at the bottom, sleep, all these things. Like you create an environment.
That's nice. Is that not nice?
So
Yeah.
for sure.
But you have to be able to afford it though.
Exactly, to be sure for it. And then what happens? What's the first thing that goes? Well,
Those
you know,
things, yeah.
anything that's appears to be not business critical roles, they all get cut.
So again, but the reason why I bring it up is because I know we've talked about this so much, but you'll be having a conversation with someone who will say things like, I really value these things are really important. And you know it's not really true. Like, remember the amount of times we've been like, they've said all these things and they've ummed and ahed and da-da-da-da-da-da, and then you offer them 5 more grand and they go, yeah, I'll take it. Do you see what I mean? So people have this, and we all do it, but it's in like, it's this projection versus like, what is the reality? What's the underlying thing? Do you see what I'm getting at?
Totally.
So would you actually like, I mean, say the tech hires in particular, or say the non-trading hires, like, what's the current narrative right now? I mean, would you see people saying, well, I really want these, what's the most valuable? I want the perks, I want this, I want that, or is it money? Like, people in England are starting to be squeezed a little bit, right? Cost of living, all this kind of stuff.
So look, it's the top 2 things when you're speaking to candidates, and let's just say if we are paraphrasing a group of 100 people, it's being able to, number one, from a company perspective, definitely clarity of communication, right? And in terms of mission and clarity of communication.
That's important.
1000%.
Why? Because they've been screwed by
No,
it?
well, because it's like, just like, as you say, ambiguity.
But loads of businesses were ambiguous a few years back. They got away with it then.
So for sure, but so if you are being ambiguous in terms of expectations, in terms of role title, in terms of anything, like if you're going to do that, I truly believe that you will have people that will leave. And then of course it's monetarily, because, but it's also, it is monetarily from a perspective of under their personal circumstances. So I've got clients, as I said, so I've got people that have to drop their kids off to school, for example, and they need that freedom. So they will sacrifice financially to be able to do that, because obviously childcare in the UK is ridiculous, right? So, but on the other hand, some people are just, are obsessed with what they do. And if I have a company that has a clear mission and communication up front of exactly what I'm, almost talk me out of the position. That is a massive thing for people now, I think.
See,
just being on the level.
I think, again, the clarity point is so good, because I love those things. When someone says, look, this is what, and you can tell some people mean it, right? And it tends to be the older people, I think, generally, because they've had more time to figure out what's important to them as you said, they have their commitments, their responsibilities. They say, I can do this job, but I need this one thing. I need to, I don't know, be able to pick my kid up from this time to this time, and I need, I don't know, 1 day a week from home or whatever. Super clear, super precise. It's hard to argue with those people because if I get that, I'm yours. Whereas people who I find difficult from an employee's perspective is ambiguous the other way, right? And I think that's what I would encourage people to do is like find out or have a good think about what is your top 3 priorities, negotiate for them, and then kind of let everything kind of go, because
I really try and extract that early on, by the way, because it's threefold. It's number one, environmental, as in what environment do I want to work in, right? Hustle 5 days a week in the office, work is my life, like there's nothing wrong with that, okay? Or you have the total opposite where you're remote and you get all the flexibility done. Then the next one is financial, of course, and then the other one it's like professional legacy in terms of title, in terms of what is this going to look like on my CV? Because I say to people all the time, you can keep going from large bank to oil major to wherever you want to be. And there's nothing wrong with that. It's a hugely successful environment and CV. However, if you are a creator and you want to build something and you want to look back and go, I helped scale this business from X to Y, that speaks to you. That's why I love getting to the heart of those 3 things. The problem is sometimes, and employers do it too, but from an employee perspective, from a candidate perspective, I love the people that just don't bullshit. Because the ones that
you've got such a fascinating job the way you approach it, because you're on some discovery, both sides.
I literally call myself Inspector Gadget.
No, because you're working with the client, call it, or the future employee, to figure out the truth of what drives them, the truth of where they'll fit and whatever. And the flip side, you're kind of doing that with the employer as well, right? You start out with a role and you're like, we want this, we want that, and it evolves, doesn't it, a lot of the time? You interview people and you're like, actually, no, that isn't what we want. And you've got to sit in between and fit that kind of psyche.
Anybody that says that hiring is exact science is lying to themselves.
No one does.
Nobody gets it 100% right.
No, I would flip it on its head and be like, this is the people that don't want to treat it scientifically. They want to be like, like I said, like the trade houses being like, there's a recruitment problem, right? But you could look at the process of what you're doing.
It's 100%. And also understand that the employer, the client, the company will have a set of expectations that change, and so will the candidate. And neither of them, I believe, is actually...
I just believe so. I'm not sorry to cut you off, but it's just, you're basically an agent. But for both sides. And it's such an underrated job, actually, because it's like if you're being an effective agent for us, an effective agent for them, you kind of have to be a double agent in effect, but like everyone's aware of that.
Of course.
It doesn't work any other way, because I bring someone in an interview and they are speaking to get the job, and there is no one to go and like speak with them and get the real truth and bring it out of them and then like gain their trust. And again, you're not trying to screw them over, but you need to get under the layers in order to then allow the employee to do a good job. And basically, we take this phenomenally seriously. We shouldn't really hire you, right? We should be doing it ourselves, given how seriously we take it. But given how seriously we take it, and given how I see all the evidence, I've had to hire because I know the truth. It doesn't work unless you have this distance and this agent and all that kind of stuff. And to be fair, you see this like in the senior side of things. Someone will be like, I want to hire this person. They could easily pick up the phone, get their number from a broker and go, yo, do you want to join? Then they never do it. You go to a recruiter and you go and seek this person. And there's something about that. It changes everything, doesn't it? And I guess we could talk a bit about that now, like the senior side of these things, the senior moves. It's a completely different journey, isn't it? And I guess that, what I just said, probably speaks to their sense of pride, isn't it? It's like, if you're not going to headhunt me, if you're not going to have a proper discussion with me and have a third party to take it in stages, then this is just a shit show. I guess that's...
I find that part of it super fascinating, actually, because I've done name hires with you, I've done name hires with other clients, and obviously also sometimes you're headhunting certain people for a C-suite role or senior leadership or director role, and people forget when somebody comes into an interview, it's sometimes the first time you've met. And there's an element of getting to know as well, right? And it should be about the company and the expertise and getting to know. And people like the certain distance of not having to speak in a confrontational way or confront certain bits of the conversation. And in retrospect, they're able to go out, and it's not about even confiding, but it's about talking about stuff that didn't come up in the room, or being able to speak openly about.
Oh, it's amazing, isn't it?
Do you know what I
They
mean?
should put on a. Remember, we can talk about one of the board hires. You know, present a certain you have a very seemingly transparent discussion. Yeah, I acknowledge what you say with this particular point. Yeah, got it. Then 2 hours later, they say to you the complete opposite.
Totally, it can change, and so it's a difficult one, because is that a certain element of human nature where you don't want to challenge or confront certain things in the room, but I think having that environment where somebody is, as long as they're doing it for the right reasons. I don't understand search businesses or recruiters that can work with every market maker, every bank, every trade house. I don't understand it.
Right.
Because who are you actually serving? Who are you actually adding value to? You can't be on everyone's side. But as an agent and as a recruiter, you have a very important...
That's interesting, actually.
You have a super important part to play, where you have to manage the client's expectations and the candidate's expectations to the best of your ability and get the best deal for both parties.
Well, I guess really knowing people intimately and the businesses intimately, like, it does save a lot of time as well, right? Like, you can say certain things like, yeah, they're happy to talk about that, talk about this, but if you kind of going to go down this line, this is not going to be taken well. I think that's good, but sometimes not ideal. If someone's trying to sell their way into a business, then it's bad to tell them the niche stuff, right? Because they'll use it, like, and not necessarily care. On the flip side, if someone genuinely just wants to know if it's a good fit, which you tend to get with seniors, because usually the people you're trying to hire don't need to join you. It's you're trying to sell them more than they're trying to sell you. So really it's about, like, well, this is kind of like their red flags, or even like the opposite, like their massive green flags. And that's useful to know going in, because you can kind of see if you can create some harmony in the discussion, right? And like see if you are ultimately a fit. It's like matchmaking, isn't it?
Well, there's two parts of that. You know, you mentioned earlier about people will either know me in the industry or they won't. But in terms of we do a lot of confidential searches and moves where there's a huge benefit to that, where when I've approached people and moved them to a certain business, for example, at some point, if you are headhunting a certain person to come into a business at a higher level, there has to be an element of, because the best people some of the best people aren't looking. Yeah, some of the best people aren't looking. Some of the best hires
almost
are
all the way, all the time. Yeah,
correct,
almost by definition.
For sure. So then, it's a
Because
very...
if they were looking, they would have found it already, right?
Totally.
Yeah.
And they don't apply and all that stuff. So it's a very difficult environment, because you are saying you were excelling at your current company, you are adding value there, you're clearly being looked after, because otherwise you'd be looking elsewhere, right? You'd have spoken to your chosen agent that you know and build a relationship with. So you're bringing someone an opportunity like an Onyx or anyone else, and then once they fall in love with it, you've got to say, well, now you've got to make a decision. It's definitely not an exact science. It's a very difficult thing.
I think you must find it the complete reverse in a way. Like, graduates can probably be quite infuriating for you, because they're less, involved in the game of, like, just the basics, like replying back and like being like committal to interviews or whatever, or being flaky with their thinking, and when it not being too transparent. That's a very natural thing at, like, young 20s. So the frustration tends to be that way and whatever, but you completely flip it on its head when you get senior level, because usually it's the employer messing around, right? It's in, like, again, I think it's always something that's been good to be like, let's get the feedback from your perspective. Like, sometimes, like, you're not being realistic here. They don't have to join you. They're going to get probably 15% more here or whatever, and let's be honest, you might be on a downward trajectory. Your reputation is taking a hit right now. They're needing to take a chance on you. There's I imagine, I'm talking for you, but I just, from my own experience and seeing other companies very stubbornly being like, well, why wouldn't you want to join and take, it's almost like they're like, come join me and take a pay cut because we're such a big brand, and why wouldn't you do that? It's so obvious. And you're like, you don't know how to, it must be frustrating for you, like, you get real.
and not only that, but you also have to articulate to the client as well. It's like that rhetoric of, when you're having a discussion, interviewing, of why wouldn't you join us, there is an element of, you have to sell to them too, right? Of course, the company...
A lot of big brands don't want to do that, right?
No, they definitely don't. But it's also part of the downfall, I would say, because think about it. You forget about counteroffers, you forget about sit-outs, you forget about non-competes. There's a huge element of risk, and you go back to graduates where they listen to their parents. Well, male or female moves will listen to their partners, and so if they're a risk-averse person and they're really happy and they're safe and they've just got to the element, and if they've been uncertain for the last 15 years and they've got 20 years now, they're in their 40s and they're suddenly comfortable, and then a rocket comes and like, oh my goodness, it's so big for my career.
Such a good point about the partners, man.
It's massive. It's one of the first things I get under the hood of. Tell me your current circumstances. We chat. Obviously now I have a baby as well. Like I love it because you talk about kids and all that sort of stuff.
Yeah.
And so it's that's a massive part of it. I always say, number one, have you spoken to your boss? What's your relationship like with him or her? Yeah, how close are you? What would they say to you if you said I'm leaving? Right? Have you had that conversation yet? No. Then I say, what would your partner say? What would your wife?
Because you've got to work with them as much. So I've even had this with people I know-ish, and I want them to join, and it's much more of you can imagine it to being like a football manager speaking to a young footballer and their family and their agents. It's like, so this is what we're proposing in general. They want to know you're joining this thing and this is the life you're going to have.
By the way, it's the same stakes. We said this before, it's the same stakes. So, but football traders and certain brokers earn footballers' money at that age.
Yeah.
You've got traders in your team that.
No, but what I was going to say I personally think, and I hope you agree, like this is where it becomes incredibly important to have had a track record with how you approach things and how you treat people. However you want to treat people, consistency is important, because at least it's like you're joining Onyx. This is how it is. Like this is a fit for you. This is what will happen. That to me, like when I've had calls, people being like, "Look, the company's just gone under, or company has just screwed me on this.
Yeah.
Do I have a job with you because, I don't want to be left here, screwed here?" And you're like, well, they know exactly why they're making that call. They know exactly who I am.
It's
what
clarity
the
of
business
expectations.
is, clarity of expectations, and they've made a decision. Okay, no, it's time. And will you take me? Because I've already sold. We've already been through this dance, and I already know what you're all about. Whereas, again, I guess going back, I would argue that it's an industry thing at the moment that they're going through, which is 2021 to 2023 made more money than they've ever made before in this industry, and incredible extortionate amounts. And it's actually one of those poison chalices, because you have all this money that's then needed to pay people out. There's people leaving, everyone's made their money, they retire, and succession becomes this incredibly important thing. But in order to have proper succession, you have proper ethos and philosophy to pass on. If you haven't spent time thinking about those things and knowing what you're going to do next, you're kind of screwed, right? Like it's a fascinating time for that. Like, what is the pitch for a 22-year-old in this industry now, not thinking, cool, I want to do what you did in the last few years. It's the next 15, 20 years. Where are you going to be in the new landscape of the world? And that, you have to have some vision for that, right? You have to have some philosophies.
It's also very difficult to ask someone fresh out of university for every single individual to know that answer as well. So
no, I'm saying the employers.
No, for sure. I'm agreeing with you. So the employers that don't have the clarity of vision, the clear narratives and communication, they're just you're not going to attract the best people because they don't.
Yeah, if I had something I would want for, and we've talked about this, is like I'd want you to say to clients, like, at the end of the day, there's going to be some rough edges with working with Onyx in particular, and whatever. But we'll be honest about what those things are and what we're trying to achieve, and we'd like to be at least acknowledged for that, right? We don't make up shit. We'll tell you what's hard about this. We'll tell you where it's going to be struggle, and there will be these expectations. I think if I was to flip it on his head, look, if I was a kid right now and they were out in the job world, I'd be like, look for the businesses that, or try and avoid the businesses that can't answer like basic structural questions. Like, what are we trying to do here? I mean, that's honestly why I left my last job. I remember he yelled at me massively because I was like, I don't really want to start next year like as if we're just starting again. Like, I'm a bit bored. You were nuts. I'm like, yeah, but it's not bored like, oh, you've done something wrong. It's like, I don't know what we're trying to do next, and I need to be sold on this. And it was a question the collective management just couldn't answer. They didn't have a vision beyond what they'd just done. And I don't think there's a problem with that. But it was good for me to know that, to then make a decision. Do I want to limp along here with kind of like a vagueness, or do I want to do the next big thing? And I think there's a priority for leaders, which again, I guess must be frustrating for you, because you need to convey that to employees or future employees. And if your client as the employer can't answer those questions, how are you meant to convey it? You see what I mean? I imagine that's a very hard thing for you to do.
It is, but then I actually wouldn't even look at it as negative. I know you weren't really meaning that, but it's just it's leveling the bubbles on the expectations, right? And then being so brutally honest about what they will be and what it's going to expect of you. And then as long as you're constantly iterating, because you as a business leader yourself have to think about the next 5, 10, 15, 20 years, right? I mean, you were asking your previous employer exactly that question. What is our outlook looking like?
But I would say 90%, what I've learned in the last few years in particular, is 90% of leaders, managers, owners, they are actually only looking 3 years forward themselves. And they're looking for how they can exit. So again, all the trade houses and majors, they're getting their money, they're collecting it, and they're buggering off.
Selfishly, from an individual perspective.
From an individual, I wouldn't call it selfish. This is what they join the industry for. They've reached their peak, and then you've got business owners who want to sell their business a lot of the time. They're just looking for that bid so that they can crystallize.
The leaders aren't incentivized on the succession plans then, are they?
But that's what I'm trying to say is I completely sympathize all round because being in all these different areas. And I would criticize, which is not really fair for me to do, but I would criticize what I think I see with a lot of mid-level companies, small to mid-level companies especially, who've done well, but they're so obviously looking to cash out. It's like, and I've got it all the time, every other quarter, someone says, oh, you're trying to sell Onyx. I'm like, where is the evidence for that?
By the way, it literally, I've had candidates tell me that. I've had candidates about, oh yeah, but why would I go there? I know they're looking to sell. I'm like, who are you speaking to?
I think that's more of a protective narrative from maybe competitors and brokers. But in general, I actually think it's a really good point. Yeah. Is the business you're about to join, the manager that you're going to work for or the owner, are they just trying to sell and go, IPO and go, or have they actually got a plan? And that's where you got to start as an employee. And that's where you got to start as an employer. I think if you're coming to the table to hire someone, you've got to be able to answer those questions. And if you're coming to the table as an employee, you've got to be able to look for those questions. But then, are you ready to join that and take that super seriously? That's the kind of dynamic going on, isn't it?
Well, it also changes the total landscape of how you're going to be working, because if companies are gearing up to sell, they operate and they act completely differently.
Yeah.
Don't they? Completely differently. So if you're going in as an employee, and an employer, you've got to understand that that's the relationship you're about to have, that you're going into. I totally agree with you. You've got to, people have to answer that. But honestly, most people getting in for the first 1, 2, 3 jobs, I haven't had one person. No, very rare do those questions come up to me anyway, at least from a recruiter's perspective. Digging to that level of depth, and the ones that do are just exceptional.
Most important attribute that you've seen work for a trader?
Self-reflection.
And why?
Because there are, so say, take the last 2 years, for example, take the last year with sanctions and geopolitics, whatever. There's people that have blown up. There's people that have lost their desks. The people that have, and that is definitely, I had lunch with a trader the other day who said he's seeing numbers he's never seen before in his reality, right? So,
up or down, or?
Oh, just in general. He's not the same way that other people have made money in this industry, in certain markets are collectively they believe are changing, right? From what I am speaking to the experts, I'm not, right? I'm not a trader. I speak to them, but so he was literally saying to me, he was like, so I've got friends that desks are blown up, for example, and it's definitely ego driven too. It's going to bounce back. It's going to come back. And
we've been in. I love that answer, because this period of like so much money being made by a lot of people, and then suddenly so much money not being made or by everyone. Those people that thought it was all about them are the ones that get hit the hardest. And that's why you say self-reflection, right? Exactly. Stay humble.
Because grit, sure, but you can be gritty and not be self-reflective and your desk blows up. And by the way, when you're not, when it's not your private book and you're doing it with the company's money, like you should have huge accountability on that. And it can't be like, oh, but I made you loads of money previously. It's got to be consistent self-reflection and being like, oh my goodness, I've not seen this certain way currently, because I've got broker friends where they've lost clients because they just disappeared as well. So it all connects.
Love it. Another question. So in the first 10 seconds of a conversation with a future potential client, potential employee for a client, what is the leading thing that makes you go yes or no within those first 10 seconds?
Oh, I love that. Can hear it in their voice. And for me, I can hear it in somebody's voice. As in, do they take themselves seriously? Do they have... It's one of those things where in the first 10 seconds, because all my job is to bring out the best in them. It's got nothing to do with me. My only job is to ask the best questions to bring out their talent, right? So you can hear it in their voice. And so I ask them something very non-sequential, and then I hear how they answer it, and I'll know in the first 10 seconds. Doesn't mean you get every hire right, by the way. Don't hold me to that, because that's what I do.
Apart from money, what is the leading, most consistent thing in a business? A genuine thing, not an anecdotal thing people say, but a genuine thing that you think employees in general are most seeking.
Hard one to answer, because I don't want to answer as myself, because myself would be, and the people that I hire for the majority of the clients that I work with, because there's I don't work with everyone, obviously, and so I'm passionate in working with people that are disruptive and are changing the status quo. So I truly believe it's actually, after money, it's being part of something. What is mission critical to this business? And being enthused by that. Passionate leadership, exceptionally passionate leadership, which is why I cannot stand working with companies that have weak leaders, because they hire weak people.
What is the leading worst attribute that you think turns future employees off?
From candidates. I was going to say laziness, but it's actually not it. Do you know, I'd number one thing, consistently it's they didn't ask me any questions, like proper questions, not how many annual leave days do you have, or like, do you know what I mean? Like, not being disrespectful, but someone comes into an interview with a client, and if they haven't done their research, it's so obvious in their questioning. Active listening and knowing then what to ask based on that, truly being interested.
That always annoys a future employer.
Yeah, 100%.
So ask the question reverse then. What is the leading thing that employees get put off by? Take your time.
I would say inconsistencies. Generally inconsistency. So, for example, and it's important for clients to have more than one round of interviews, whether it's teams, on site, different leaders, obviously at different levels, but it's inconsistency of communication, kind of not knowing where they stand, to the point of like, why would I join this business if I don't know exactly what I'm about to enter? Even to the point where you're almost like wanting them to reject the opportunity. This is exactly what it's going to take for you to come into this business. So I think inconsistency of information and communication.
Okay, last two. Quick fire, what is your advice, leading advice for employees or future employees joining somewhere?
Advice for employees. You've got to have a service-first attitude to begin with. I don't understand why this is... so from my experience, it changes sometimes a little bit. It's almost like I speak to some candidates and it's all about what the company can do for them. And by the way, they're entirely right to think that, but it can't... the best people have a service-first attitude of, I will do more, I'll go above and beyond. And by the way, I'll do it more than my current paycheck, because you definitely will be rewarded meritocratically by the right people. If you've chosen that company and you're going to join them, advice to an employee would be go above and beyond, way beyond your paycheck, because you will be a future leader in that business if you want to be.
Or even somewhere else. If
Oh no, but we've seen that. So not everyone that's joined Onyx has stayed. They go and join other businesses. So, but because they accelerated their career here or wherever, you constantly go above and beyond whatever you believe is hard work.
So final then, advice for clients as in hiring, the leading advice for them.
Spend more time really analysing the need for the hire. I feel that sometimes some clients are like just filling archetypal positions that aren't actually needed. And then so what happens with that? Then it's like there's generic job descriptions, or they're not clear on why they're doing it. They don't. And when you really cut down to the core of it, it's and by the way, that's why the candidate and the employee is like, I'm not really sure, because the person hiring doesn't really know why they need the seat. It's really drilling down to the understanding of what impact will this person have in our company. And if it's growing, we really need this because of X, no problem. But I would think that sometimes, from my perspective and the candidate's perspective, some clients aren't clear on why they need roles, and they end up either they're not hiring the right people, or they pull the role altogether.
Thanks, Jordan. We'll leave it there. We're talking about being in the front and center of the market, how it prices and taking on the market and dictating it. It's never happened that there's a woman, I can say very confidently. Do you think any of that's important, or have you used the femininity to your advantage in some scenarios? Or I don't know, how have you adjusted?
I mean, the way I used it when I first joined was, you know, even things like you have a different pitch, so you actually can be heard. You know, if you have 10 people...
The pit trading mentality, like the open outcry, you can hear Manny's voice.
Exactly, it's just like it's a different frequency.
Okay, Manny, you are between 30 and 55% of the dated Brent CFD market at any one time. And together with Ashley now, who starts on Axis, get to about 85% of the dated Brent market. So that's obviously huge, that's significant, and dated Brent in turn, and what you trade in particular, very much impacts the settlement of a contract that settles in turn 70% of the world's oil. So you're essentially probably one of the biggest crude traders in the world in the most important benchmark. So that with the context, you know, how do you feel about that?
Yeah, I guess, I mean, it's a big statement, but the reality is it is true. I think something that I probably wasn't aware of before I joined the market or started this job was how specific contracts can be, but then out in the real world, how they're used to price so much of the world's oil or so much of, you know, one asset, etc. But yeah, exactly that. I've been trading it for almost 9 years, and it has been a steady increase in market share, in, you know, the risks that we take, how we like to position it, etc. But I think the point is we've found how we can service the market, and how we can do that is by providing CFD liquidity.
Yeah. So just on that point then, so because this gets discussed and people always assume you trade with Manny or anyone at Onyx, but let's just focus on you. And Nick Ballack, who was your broker and now works here, was very vocal about that recently as well. You know, if you trade with Manny, she must be taking some money. You're getting ripped off somehow. You must have done something wrong. And you're even trading like next week's prices, which, or even this week's prices, which are impossible to hedge, right? So how do you give that, like, what's your answer to that immediately? Like you're talking about it as a service in terms of providing liquidity. So you try to be there when you can and try to give the best price you can for anyone who asks for anything really. But how are you able to do it then if you're not hedging straight away, or not able to lock in a counter price straight away?
Yeah, I think, I mean, a lot of the people in the market that like to make these comments, they started in the industry, you know, 10, 20 years ago, where it was just a totally different environment. That probably was the case, where you'd have intermediaries like banks. To be honest, market makers went around, but so predominantly banks, and they would...
Well, I was the first stripper in dated Brent, and yeah, I can tell you I wouldn't have traded it unless there was an arbitrage. So you're right, it was definitely that to begin with.
No, exactly. So, you know, they came from that kind of time where, yeah, exactly, you were kind of getting risk neutral using different contracts, essentially, and you collect the bid offer. Immediately.
But the market gets so tight, so efficient, you can't do that. So generally now, as of now, not so much the journey, like how do you answer it right now?
Now, I would say the market is so smart, it does not allow for you to trade in that manner. And so really what's happened is over the last probably 5, 6, 7 years, I would say that, you know, we've slowly developed internal risk strategies, hedging tools, etc. And also, you know, we do trade on a medium-term basis. So when I say medium-term, usually anything from like 3 to 4 days to probably a month. That's how long I typically hold positions. And a lot of the market is like anything else, you know, it's not just one-dimensional or two-dimensional. It's having a view on forward prices. It's putting it together with fundamentals, recent price action, positioning in the market. There are so many things at play that tell me where the price I should be buying or
should be
selling
a politician.
essentially.
But I think now that we had this conversation with Omar, and I'm trying to ask in these things like some consistency in the questions so people can see like the similarities but also the differences. Would you agree that ultimately, because your job is to provide liquidity when someone wants it, in effect you have to predict what they're going to want? You
do, and also I think the market just assumes that we make money all the time. That's not the case. You know, last year I had a couple of months where, from taking down these contracts from trade houses, etc., I lost a lot of money very quickly. Sometimes I make a lot of money very quickly as well. So on balance, you know, it's all about how you manage the risk yourself. I have certain protocols in place which help me. Yeah, but let's say, is it fair to say you're trying to read the market's narrative, preempt what it could do in certain scenarios, but ultimately I think the crux of it is finding ways to put on risk that gives the industry what they need, and you can even have similar risk to them, but done in a very different way. So you're kind of finding an alternative way to put on the same risk as the market. Yeah. And there's loads of, I'm not going to go into that too much because obviously that's your IP, but there's of course a lot of work with correlations, and there's like the work on what the physical market's really doing. And one thing I would do, because I was a dated Brent trader as well, we always got accused of, how can you have a view? What do you know about the physical? Like of all the markets that trade in oil, dated Brent in particular is definitely the most old school, definitely the most governed by the smallest number of players who dictate real physical barrels in the North Sea. Is that our job is to know what's happening with those physical cargoes, and it's information's king. If you have information and if you can actually buy and sell those actual physical cargoes, those specific ones, then you're done. That's your game closed. Whereas you come in with absolutely none of that, yet you're still able to have a view. And they go, how is that possible? Yeah, I think you're totally right. I think, you know, for physical traders or trade houses, etc., their number one most important piece of information is what's going on with the cargoes. But you would say that's fair in some respects, right? Compared to, say, gasoline, which can move like a lot on RBOB, which is like a very paper-driven contract. Dated Brent contracts, in particular CFDs, these niche weekly dated Brent contracts, it moves with the physical. It does move with the physical, and often what you'll find is, because of that, you know, bids and offers get stacked really aggressively. So the you know, ranges in a lot of these contracts we trade are really tight. But for me, it'd be quite frankly stupid to use the physical as the number one driver on my decision making, because I don't only hear it third hand. Sometimes I hear it fifth, sixth, or seventh hand. Sometimes when it's actually currently, you know, come into pricing and I'm at the mercy of it. So, well, I'm surprised you said that, because my counter was always, you guys count your cargoes, you guys think what you think is going to happen with the physical, and you have your models. I see you react. So as in that you buy, that's the material impact of all your analysis, and I get to see that. So early on it was like, okay, well, Greg, what have you seen? Why are you so concentrated on this week? And what's going on here? What's going on there? And effectively, what they're asking is, what's everyone else doing and why? And they expect you to know, because you're doing so much of the trading. So you do have the physical information, and it's not secondhand. That's kind of my take on it. To some degree, but then also, you know, a lot of these desks that trade data, as you said, it prices out 70% of the market. So sometimes you don't know if they're hedging their LATAM, they're hedging their WAF, or they're hedging North Sea. So you don't want to place too much emphasis on what everyone else in the market is doing, because it could just be a false signal. That's very interesting, actually, because there is generally, again, I can only relate it back to my times, but we traded together for a long time as well. And it was like, well, if you are a big player, like at the time it was Glencore, Vitol in particular, Trafigura, actually BP, Shell were a lot more active than they are now, from my understanding, than they are now. Yeah. You assumed, or I assumed, that every single one of their trades was because of their view on pricing. But you're absolutely right. The false signals, when it's hedging, it must have been a huge evolution in your strategy. Because I remember when the market moved like from a deep contango structure for years to a deep backwardation, which has been for the last 6 years. I think all I've really known is backward. There's a lot of hedging, right? There's hedging coming in from WTI Midland. There's hedging coming in from, obviously, you know, the refinery hedging is typically there. But this whole, like, do you remember when we talked about the amount of volume going through as DFLs? Is actually a good indication that people are hedging ahead of time their Brent spreads, and that's where their risk is.
And it took us a while to get a handle on that, because we're like, oh, they're selling DFLs, this must be bearish. There's so much volume going on. And you're like, actually, no, it's got nothing to do with it.
Exactly.
So that's a big
and you have
evolution.
no idea what they're doing, you know, on the screen or in contracts like spreads.
So I guess that's your point. You don't know, so you can't hold too much weight on it.
Yeah, and you learn it the hard way, obviously, like with everything. But and also the importance of, you know, particular refiners or majors, etc. It has also evolved over time. So like you said, Vitol, Glencore, they were big, you know, powerhouses.
In
10
pricing,
years,
whatever.
Yeah, 10 years ago. It's now shifted to the majors because of this TI outlet. So they're in control of like the global ARBs, which has totally changed the framework of the market, to be honest.
There's also the appetite to be in pricing. Like again, like if we could talk about the years, Shell in 2016, when you first started, and certainly a couple of years before that, before you traded, was the guy, right?
Yeah.
Like Huan Dong at Shell, he had a mandate, it seemed, and he traded very differently to the people before him. And he was the first one to explore this Chinese arbitrage for 40s. It didn't exist. It was all about South Koreans before that. And suddenly the Chinese were this big outlet that just impacted everything. And he had a seemingly endless risk appetite.
Yeah,
So,
and
but
he
then
was
that
the first
suddenly
one.
went away.
Exactly, and he was the first one to do it, though. So with anything, you know, I think he deserves the success he got. He's first mover. He kind of paved that arb for a lot of people. Made the connections. You know, it's not that easy to put everything into a certain refinery. So yeah, since then, I mean, I think they got in a bit of trouble as well for.
Did they?
Yeah, I think it was.
No, it's reported, but you can
Plastered
report.
all over the news,
So
yeah.
what?
But anyway, since then, you know, Shell have really pulled back on how aggressive they are in trading.
And that's always a different player at any one time. And so when basically what we're talking about is profiling flow, profiling trade houses and how they act. But that changes. It's the person, it's the model that they have internally.
Yeah.
And you've got to keep evolving, right? You've seen maybe what, like 3 major evolutions, I would say.
Yeah, but to be frank, like this is the reason why I enjoy trading dated Brent over any other product. I don't think that aspect of profiling exists in any other market.
Yeah. It's not as much of a poker game, is it?
No, exactly. And, you know, a lot of people just, you know, they don't want to show their hand. They want their names quiet. You know, there's a big thing of being front run in our market as well. You know, if you catch wind of a big trade house doing something, it's very easy that, you know, brokers can leak a name and then everyone buys ahead of them and they get nothing done. So it's a big problem for them. Whereas in product markets, it's a bit different. You're doing small clip sizes. The market's a lot more volatile. You've got 50 million curves that you can potentially trade. It's just a whole different landscape.
I think the front running thing is something we should definitely talk about, because it's not a word that people like to hear, and the FCA certainly don't like to hear, but it's what people generally accuse market makers of doing. But let's discuss it a bit, because there's one thing that comes to mind straight away is, the reason why I think people move in herds in dated Brent as opposed to other markets still, as in like it's maybe a bit less in other markets, is because you're trading such prompt contracts, and the anticipation is that you will price it. That's not like other markets. They will put stuff into pricing, but generally speaking, they prefer to be in the deferred months. When you're in the weekly contracts, you have to have an appetite to price it. So if you price something out and let it expire, you don't need to get out of it. So it's this weird thing, like if something big's going to happen on the physical, you want the liquidity to get exposure to it, and you want to let it expire. So it's a fight for liquidity, is what I'm saying.
Yeah, and also.
So the second part of my point was, and if you distort the market like that, and it doesn't function well, and people can't get their liquidity, they won't then do the thing and the pricing.
Exactly. So it's so true. You know, you do that. Let's say you move the price of contract or something, or some structure, 25 cents or 30 cents from this, you know, short-term momentum thing. The economics don't work anymore. They'll turn the ship around. They'll literally turn the ship around.
Yeah.
So this is why actually it's a great market to range trade as well. You know, it's not like the product markets where you can sometimes literally not have enough gasoline or whatever it is, and you know the cracks can go to the moon. For us, it's very well defined, and another reason for that is because now all the crudes are so interchangeable. The refinery industry has just totally changed. It was a very, you know, geographically kind of
structured, defined
Yeah,
market.
now everywhere is complex, so they
it's
can
been
take any.
Would you agree it's been democratized with the WTI Midland edition?
I think there's been a lot of change in the power has moved from different hands. I don't think it's necessarily democratized, because it just means now that the people that have US contacts or US flow or whatever it is, they can move the market more than before it was just people in North Sea.
I guess where I was coming from was the barrel counting that existed before WTI Midland. So just to explain that quickly for people who don't know, there's a finite number of parcels or cargoes that are due to be loaded every month. People count them up and know who's got whatever, and they say, oh, where have you booked it? And they get their all information. They go, well, the market's going to go up or down. When they added WTI Midland, there was a variable. Suddenly there was all this oil that could come in and set the price, almost making, in some cases, the other grades irrelevant, and no one actually knew when it was going to happen. So what becomes important? The arbitrage economics, which are kind of visible, right? TI Brent, TI Houston versus dated. And basically, it's not as inside information anymore.
No,
so
it's
what
true,
I'm saying is your best guess on what the future imports of Midland are going to be are actually as good as anyone else's. That's maybe the generic read I've got on it, and that's kind of what I meant by democratized. Before, do you remember, like someone would book some VLCC out of nowhere, and suddenly everyone's buying, and you're like, what the hell happened?
Yeah.
When was the last time that happened?
No, it's true, yeah. I mean, you do still get a bit of it, but it's no way as aggressive.
But you're predicting those these days, because you can say it's gotten to a certain level. I'm very confident when it's like this, someone's going to come out and do a bull play.
Yeah.
I don't think you would have been able to say that before, because you just didn't know. It was very random. It was always based on someone's kind of random appetite or someone's random mandate. It was more random. I'm not trying to put words in your mouth. That's my read on it from the outside.
Yeah, I mean, by literally doubling the amount of cargoes, by default is, exactly, a lot harder to do those kind of big bull plays or bear plays.
Or localized bull plays. You know what I mean? Like in one particular week.
It's true, but now what we've had is actually a huge increase in volatility in the pricing contracts. One day you could be pricing plus 20, the next day minus 20.
Oh, really?
The day after plus 40. We didn't see that before.
Okay.
So perhaps it is more democratized, but it's actually a bit more dangerous into pricing.
I know. It's funny. These two, they stack off because you've taken increasingly more pricing risk and more of your understanding. So it's either like the market's got more level playing field, or you've just risen in your experience and used it. But either way, it's like, I just can't think of a scenario in 2018 where it would have been like someone's buying next week and I go, get lost, I'm selling that. You'd be crazy to do that, right?
Yeah.
But now you would do that.
No, it's true. Yeah.
That is pretty. I mean, come on, you don't have any physical. That's
yeah.
It's interesting.
No, it's true. Yeah. I mean, sometimes I talk to some trade houses for finance, etc., and they're always interested.
Oh, who are you fronting for?
Yeah.
What are you
that's
doing?
one exactly. But the reality is, my swing on pricing position is huge. I can be like within plus or minus 1,000 kb, which
Well, at least, right?
at least no, as in that's residual risk.
Yeah.
If I want to put something on, it might be 2-3 times that. But they're always quite surprised. I think I was talking to Glencore last year, and they went, most weeks you probably have the biggest pricing position on in the market. But it is, to me, sometimes obviously it works in my favor. Sometimes it is just a cost to my business.
Yeah. You factor in the positive expected value of getting it right and wrong sometimes.
Exactly.
Yeah.
Like I said, it just means
the price you pay for providing liquidity.
the price. Exactly. Yeah.
So I think the next part of this is, again, I feel very intertwined with this market is where I started, and certainly when I started, it was definitely the last one to go even slightly screen based, right? Even now, CFDs aren't on the screen. You need to know the players, and it was closed off, right? And you need to know about Brent expiry, and it just felt like there was this thing going on that literally no one knew about, apart from like 5 proper companies, people at companies, and even within those companies, only the people on the North Sea desk knew, and it's kind of still a little bit like that, but it was the people. Now, again, very macho, all that kind of stuff, and we went through that period. Since you've joined, you're definitely the first female to trade, right, as a market maker, and certainly in the volume. I think there's 1 or 2. I think there was someone at Shell back in the day. I think it was just an execution trader. I think there's someone execution trader right now. But come on, we're talking about being in the front and center of the market, how it prices and taking on the market and dictating it. It's never happened that there's a woman. I can say very confidently, and certainly doesn't look like there ever will be. I mean, there's no one else like that. So I guess it's like exploring that a bit. The cliche people want to hear, like, girl power, yeah. It's like, no, as in like, it's impressive, obviously, and people know why it's impressive, because male dominated and a voice market and whatever, and a club mentality. How does a woman deal with that? And let's be honest, when you came in, you were tepid, right? It's not like you weren't some like bolshy female. Like,
No.
You weren't like yeah, and you can get those types of females, and you say, oh, you'll do all right in the oil market, because no, you weren't like that. So let's talk a bit about that transition. So do you think any of that's important, or have you used the femininity to your advantage in some scenarios? Or I don't know, how have you adjusted?
Yeah, I mean, God, going back, when I first started, I mean, the way I used it when I first joined was, you know, even things like you have a different pitch, so you actually can be heard. You know, if you have 10 people...
The pit trading mentality, like the open outcry, you can hear Manny's voice.
Exactly.
It's
It's just like it's a different frequency.
Again, I think it's interesting to explain that, because for other markets, it's like, it's just a voice, it's a broker and his voice. In the North Sea window, there's an open outcry with PVM still, they're the main ones. Everyone tunes in for that window, and you just hear mayhem.
Yeah.
And all the brokers are getting orders from their traders, and everyone can hear every other trader. So you're right, if they hear a high-pitched voice, that's definitely Manny. Okay, go on, that's a good one, yeah.
So there was that initially, and then also, you know, you go to these events, people would host for our market specifically, and you'd have 30, 40 men in suits in a room, and I'd be the only female. So it's quite easy to spot me, understand where I'm from, my name, etc. So
but, you know,
my
good
identity
and
was quick.
Bad parts. You're saying that's a good thing because you've owned it. Some people hate being in the spotlight, right?
No, I also was very uncomfortable. You know, even things like, you know, a lot of the hosting would be in venues that I hadn't been to or I wasn't necessarily comfortable in.
Yeah.
You know, I think I've got used to being in pubs a bit more, but I'm definitely not a beer drinker. So it's just somewhere that I'm not that comfortable.
What's your go-to drink? I should know really, but gin and tonic.
Probably, yeah, depends what day it is, but definitely not beer. That's
okay, but don't act like you don't drink, right? I mean,
No, I
you
do
definitely
drink,
keep up with the guys drinking. And if you didn't, would that have been an issue, do you think?
No, I don't think so.
Okay.
I think you have to go to these events to put a face to your name. I think it's really good for your own personal brand. So I did do as much of that as I could, and a lot of it, you know, obviously I started under your desk, so you helped introduce me to that world. I wasn't necessarily used to it, but I'm from a big family. I played a lot of sports, so I was comfortable being around a lot of people and
you didn't get threatened by the aggression and I'll be honest, I know I was a very aggressive trader, and I see the open out.
I say boss then, but yeah.
No, I'm very calm and relaxed as a boss. No, so basically when in the open outcry, I just loved it. I would have loved to be in the pit trading days. You're screaming down the box, like, I want
so
that
I would
trade.
have hated it. I know I would have got trampled all over.
You say that, but you're now doing that, and I think it was developed. So as you said, you've got a distinctive voice.
But I probably would have not lasted up until now.
Well, what I was going to say was, for me, my strategy was small player, big personalities, big market, meet fire with fire. I'll shout louder than you, but I'm not getting bullied. You want to do something, you know, I'll give it to you. And I was always that way, right? You didn't apply that strategy, but just as if not more effective, which I was kind of trying to allude to. And this is one of those things that maybe you're not aware you do it, but you remember some of the brokers have said, you know, Greg will just rip me one if I do something, and it's getting screamed out, whatever. Manny won't do that, but it's worse.
Yeah.
She's like, she's disappointed in me, and it's like your mum has told you off. And you're playing into these guys like mummy issues, do you know what I mean? And I think that works like a dream, right?
Yeah, no, it's true. I think when I first started, it was very much like that. Yeah, if, you know, I remember this specific incident when I said, you know, I'm just a bit disappointed, this is how it played out. And I had heard silence back. So yeah, it definitely hit a nerve.
Yeah.
But no, to be honest, you know, a lot of it is...
But let's not act like these aren't important. This is people. This is an OTC industry. And it's aggression, and it's people, how a woman handles that. I guess you could say it's the motherly approach, in a way.
I guess so.
Not from a caring, but authoritative mother type approach.
Yeah, but it's hard. It's difficult to do that when you're new in a job and you don't really know anything. So with time, I've become a lot more confident, and I'm happy to give it back now.
But now you're very authoritative. I would say that's how
but
people see you. Yeah.
It's because
What's your
I
nickname?
think
What's your nickname in the market?
Oh, it's gonna sound ridiculous.
Yeah, you didn't even know what it was the other day.
No, apparently it's the Queen,
Yeah.
which
makes sense, right?
yeah. No,
Does that make me the king? Right. That's perfect.
You've been dethroned, actually.
I've been dethroned, yeah. Yeah, more like the Queen Victoria, and I'm like the non-king, yeah. But either way, like that I don't think you didn't do that. That wasn't calculated. That was something you figured out in this kind of market, and it's worked wonders for you. And I think people would find that interesting, but I would caution that doesn't mean it's a good place for women and it's very balanced. And
no, I was going to say, for me, a lot of why I think I personally am successful in this job is because of my background. So yeah, sports, but not just being good at sports, it's being able to compete when there's a lot going on around you. I've come from a big family, as I said. I played a lot of football with, my cousins. I joined a team.
I understand what you're trying to portray, but that you are feminine though.
I am feminine, but what I mean is I was competitive enough when I was young that's where you want to be. That's what's more important.
But you're not acting like a man, are you, in a traditional sense? You're acting like a woman, but it's in a what is just a male environment. Nothing you can do about it. But what I'm trying to allude to is a strength of character there, basically. And the great thing about trading is meritocratic. We all know that. There's you're right or wrong or whatever. You're heard, you're unheard. And so that is just the way it is. So I guess what I'm getting at is, we've talked about how you deal with stress before. You cry, you do things, you are effeminate and all that kind of stuff, but it has no impact on your job. So if you then take that out and you stop that excuse being that's what makes someone good or bad at trading, because that's I can never do it because it's all male dominated. Well, how about my wife who's 5 foot tall and feminine, and she has no issues. It's a way of thinking.
Yeah.
You don't get sensitive with certain things. You don't, you've never been offended. It's like, I choose to be in this industry and I choose to set my boundaries and play by what I think are the governing rules, and you've had no problem. But there are people who just couldn't handle that because they'd be reading too much into things and they'd want the excuses. And the big thing about trading is the accountability element, right? And you do sometimes struggle with accountability in your work life. I think as a junior, it's obviously gotten better, but you clearly don't have that issue on a macro sense because the trading would just spit you out. You don't lose money and go, it's such a male-dominated industry, right? It's got nothing to do with that in your mind. You never let that come into play.
No, I think...
And people should respect that.
But this is what I mean about being competitive. Yeah. I think to be honest, I'm too stubborn for this to have not worked. And then you get to a point where you've done it for so long and you've become such an expert that, quite frankly, it's stupid to give it up. So I've been trading for 9 years. Arguably, I'm the best trader I've ever been.
Of course, yeah.
And my input is the lowest.
Yeah, which makes sense. Yeah.
Makes sense. So, a lot of the things I've learned over repetition, etc. But I could have stopped at many different points. I didn't have the easiest start. Mm-hmm. Even last year I said I lost a bit of money. I was not in a great place. I kept going, but ultimately I think it's because I'm stubborn. I enjoy succeeding, and I think I got a lot of that from being young, being competitive, and learning what it means to win. So.
But would you agree with me then? Would you say to someone like Anya, a female trader on gasoline, we've got Taros on naphtha, we've got more and more females. I don't think they'd ever even say this, but would you say to another people, don't let the female thing be an excuse? Would you say that?
100%. Okay. I think it's just so irrelevant now. I think maybe 10 years ago it was different, as you were literally the only person there.
You were trading 10 years ago.
Yeah, but as in I had no role models at Onyx, female role models at Onyx. Now, I would hope they have me, they have a lot of other people around them, a lot of other women around them that can help support them. Yeah. But it's true, the first time, I definitely do cry when I get frustrated. The first time I cried in the office, not the last, it was a bit embarrassing. I was like, these men around me aren't used to me behaving this way or anyone behaving this way.
But they are though.
Now they are.
Yeah,
but
I've seen men cry as well.
No, but it's a bit awkward in a working environment, you don't want to show that vulnerability.
Yeah. Well, I don't think you were the type to just cry on the train floor. You would go away and
No,
cry.
Exactly. But, it was still a lot to understand about myself, and also here, people weren't used to having women around.
I think another thing is, like, just to play on that, I guess we've kind of talked about this a lot, so I'll move on, but just that, how do people express frustration? It's a big thing. You're sitting behind a screen, and any gamer would understand this as well. You smash a control, or you just get angry, right? This is such a frustrating thing to do, screen-based anything, right? Or like high frequency, whatever, high stimulus things. But you don't do that, or do you? I mean, what is your like frustrated kind of mode, if you know what I mean?
Yeah, I think it is really important to get rid of that kind of energy surge, cortisol, whatever it is. But yeah, for me, I don't really let it out physically, I would say. Like even now, like I wouldn't say that I necessarily am as sensitive anymore. I've done so many reps now, so there's very little
but
I
things get you
haven't
frustrated.
seen. Things
you
get
miss
me
a number or
frustrated.
whatever, so what do you
Yeah,
do?
so for example, earlier today, I missed a number on the screen. I went, oh, for God's sake. Okay. And then you move on. Like for me, there's no, I've never been that outwardly aggressive though, or like needed to hit anything or
I
whatever.
would ask the brokers if they agree.
Oh yeah, I'm sure a few names have been called, but I do actually pride myself on being able to let go of things very easily as well. So as I said, you get frustrated and you're like, okay, it's done, move on. Otherwise, it's just like this toxin that stays in you.
Oh yeah, big time.
It's a horrible feeling.
So I guess it's a good segue into philosophy of risk, right? Because, what is your thinking? And again, not necessarily set in stone like you always knew it, but having had the experience, and again, you said last year and things like that. Let me ask you this: Would you say that frustration and that stress, where does it really come from? Is it because you don't feel in control? So, for example, have you found that you've been most stressed or most found it hard when you've been out of control of your risk, and you believe in very tight risk management, or are you more of a you need to experiment, you need to kind of, what I'm getting at? What's your philosophy?
Yeah,
there?
I definitely think you need to push your boundaries. And so if I just traded in the same way I did from year 5 to now, I think it'd be pointless. I shouldn't be in this job.
By the way, there
that.
are a lot of traders who do that. What works, they repeat, and they get slowly arbitraged out in some way.
Exactly.
Yeah.
So you will get priced out, especially with a lot smarter new talent coming in.
And technologies and systems and whatever.
Yeah, exactly. So for me, I mean, the main thing is what really gets me annoyed. It's when my thinking is slower than it should be. So the risks that I put on, that's something different. It's more often than not, it's within my model. As I say, if I've made a bad decision, it still means I've made a decision. I've thought about it. I've weighed up the pros and cons, etc. So I can take it. It's thoughtful, so I don't mind. When I miss deals or do something that I guess the opposite, haven't thought through. Not so much, but it's more when I'm slow. So it just puts you on a back foot.
Mm-hmm. So how do you try and stay sharp
mentally,
then?
but also in your risk? I'm a routine gal, for sure. For me, that's the number one thing. I go to sleep at the same time every night. Usually I wake up at the same time every day, pretty much eat at the same time of day. I have this, rely on my team for certain things. I have this pattern of behavior, which I rely on very heavily. So if something gets pushed out of whack,
does that screw you up?
Yeah, for sure. Sometimes I don't even need to have a drink the night before. If I go to sleep too late, I feel hungover the next day. And so obviously your decision making, your fatigue, all these things fall in, and it will impact your trading.
But inevitably you can't avoid that all the time. So what do you try and do to stay sharp when you're hungover or something like impacted?
Luckily now a lot of it is subconscious, but to be honest, I probably just lean on my team a lot more. So
okay, so you take yourself out of it. You don't want to be in the moment and say, look, throw cold water on you, let's get stuck in, or you want to look, it's not there.
No, that usually doesn't work for me. Luckily as well, our market is a bit slower, so I don't need to be on the desk all the time every day. I'll tell my desk, this is generally what I want to do. I trust your execution a bit better than mine at the minute, so happy to do it.
Okay.
But it's not always been like that. I'm very lucky now I have a good team. It's taken me 5-6 years to find a good secondary trader. And
There's so much that goes into that, isn't there?
yeah, this time 2 years ago, I would have been micromanaging it. So it's definitely a new thing.
And that in turn probably makes you less stressed because you have genuinely good support. So also something because obviously I've overseen your development in particular with the Data Brent desk. And if I go way back to 2019, which is when you really were kind of had to take over the desk, because I was pulling out to be chief executive, it's like you just have to, basically. And you took a while to get into it, right? But do you remember the moment, do you remember the moment that I feel that you suddenly kind of made that step change and then it moved on from there? How do you remember it?
Yeah, I mean, for me, it was, again, I'd made a thoughtful decision to put on a particular risk on a Friday evening, probably not the best time. And over the weekend, we had the Saudi bomb attacks. Saudi oil fields, they got bombed. Of course, my position was short, which was not great in that scenario. But we came in on a Sunday night to trade it, and I was really nervous. I remember saying to you, if I have to stop out of these spreads, can you just stand behind me? So I have that kind of comfort of, this is, how you're stopping out is
but you didn't, I don't think.
No, I did. So, for me, it was a big deal to put on that short position on that Friday. We came in and we day traded on the Monday. Everyone was in a very similar environment where they just needed to get things done, so they needed to execute. So it's a great market making space for us.
How I remember it is, similar to that, but it was an important moment because you were struggling to put on your view, to be like, this is my conviction and this is what I'm going to do. So you'd finally done it. And then the first time you'd done it with genuinely owning it, you had literally the worst case scenario. Because someone could say, a war is the worst case scenario. It's like, but is it? Because a war is like, modern day wars, it's some kind of attack and you don't know, and it's all about the escalation. It doesn't really necessarily impact the physical. This was the biggest producing country in the world at the time, or close to, with the US. The biggest swing producer, let's say, or owner of OPEC's decision making, had been bombed and 10 million barrels were taken offline. It's like, if you had to think of a scenario like Cushing blows up, it's like, that was pretty much what happened, right? So imagine that psychology. It happens over the weekend. You think, oh God, this is it, whatever. But you were only down a couple $100,000.
Yeah,
right?
I think it was.
Which for us was manageable at the time. And it was like, I remember thinking, like, you've now lived the experience of high conviction, it going as wrong as it could go wrong. And it's not that bad.
Yeah.
The position sizing was okay. Mm-hmm. And I could tell you didn't tell at the time. I could tell you, this is typical. But it was a completely different thing. I was like, from now on, it can't get worse than that. You can't have how much tail of a risk can you get? You were at the tip of the tail, right? So therefore you'd had that calibration. And from then on, you were able to calibrate within that. And the rest was history. Yeah,
no, it's true, exactly. Like, everyone always, a lot of the juniors, etc., they always ask, like, what is the top day that you remember? Typically they expect you to say when you'd made the most money. Yeah. But for me, it's always that day.
Yeah, great. So, okay, what is the trade you're most proud of?
Oh, God, that's a hard one.
Is it that one?
It'd have to be... No, I wouldn't say it's that one. It would have to be when I was a junior. So I was
this is a good one.
You. Yeah. So obviously, I mean, I do for dated, there's sometimes not enough room for multiple people to trade and learn at the same time, etc. So you tasked me with trading Brent futures essentially, and gave me a 10k drawdown. And I was playing around a list.
It was all about the risk management framework, right? Forming a trade craft, and you embraced that a lot, right?
Yeah, for sure. And no, I remember, I think you went away to New York for the weekend or for a couple of days when we were trading. Yeah. And I'd created this risk framework. So I'd put on, I think it was something like June deck or June SEP deck.
It was sorry, yeah. Okay, I thought it was June deck, but go on.
I think it might have been June SEP deck. I think it was a fly, but it was quite deferred. So it moved quite a lot with flat price. And over this 2 weeks before, I'd slowly scaled in. So I think by this point we had around 500 KB of a fly on. No. I think it was something like this.
The funny thing about that trade was you had 10K to risk. On that trade, you as a contrarian trade, you split it up into 1.5K risk, and you were going to do it 3 or 4 times. That was the plan, and then scale in.
Yeah.
You only risked 1.5 grand, and the trade went in the money. You scaled in, stuck to the plan, you had this big move. You made 150 grand.
Yeah.
Yeah. On 1.5 grand.
I know, it was crazy.
So, and the thing is like when people say, oh, what do you expect me to do with Brent futures? What do you expect? It's like, stick to this process, believe in it, embrace it, try and get stuck in. There you go.
Yeah.
Because if someone, you could have traded that now and make, let's just say it was deck, you risk 100 grand and make 200, and you'd be like, what a trade. What about making, what was it, 150x? You can only do that through clever risk management, right?
No, exactly. And I remember, you know, we were working a lot of weekends, etc. And I would agonize over these trade graphs.
Which is amazing. But why did you do
in.
that and no one else did? Like, on the team, like, this complete refusal to do it. And even now, do you think people do that enough? Do they obsess about the trade craft?
I don't think so, to be honest. I think for me at that point in time, it was the only place I felt I could add value. So I kind of had no choice. It is what it felt like. And I've always been quite studious, so I didn't mind putting in the work. It was actually a lot more nerve-wracking to execute and put it on and see how I moved. You know, I remember dreaming about it at some point.
Yeah, well, that's learning.
Yeah.
It's real repetitions. And look, you thank yourself for doing that, because anyone else could have said, you're not training me, you know, like, what's going on in your market, you're not telling me. But you just sat and did what we told, and we discussed every so often. You have to take credit for that. But just a funny anecdote on that. There's other trades you did. Remember you had this one at minute markers where you would just short it. There was some pattern. Yeah. And you shorted like 2 KB.
Yeah.
And it went so in the money so quickly, you actually panicked that you were making so much money. You were like, so what do I do now? And that was hilarious. So usually it's like you panic because you're losing money. You're like, Greg, I've just made like 5 times the P&L in like 1 minute. I'm like, okay. Anyway, that's a good one. So, all right, what about, so you talk about being studious. Favorite trading book then?
Definitely I don't know if it's necessarily a trading book, but How I Lost $1 Million.
I didn't realize you read that properly.
Yeah, that was when I was really struggling. What I learned losing $1 million.
Yeah.
No, it was the first book that really resonated with me when I
did not know that.
You did know that. I think you.
Because it was certainly mine. It's my favorite one.
No, it's absolutely my favorite one.
Okay, good. Good for you.
I remember I would read it on the way to work on the tube. And I was reading a few around that time because for me, it was a point of inflection. I think it was after this trade, and then the next trade I found it quite difficult to see my place in how I was going to move forward. It was probably in between the discussions of should you move on or should you not, and I wasn't personally there in terms of conducting in the market, you know, talking to creating this like risk.
You didn't know what your identity was going to be in the market.
Exactly. I was just a bit lost for maybe 6 months, I'd say. I was just figuring out what it was that I thought I could bring to the business. So yeah, I sought solace, I guess, in these books, and that one in particular I found really interesting because I've always thought that the majority of trading is 90% psychology. So being able to understand how someone thinks when they're losing money.
So what do you, in a nutshell, what did it say that resonated?
It's always like a comeback story. So he lost the money, yeah, fine. It wasn't necessarily through bad decision making or anything like that.
Well, you said a lot of it was luck, right? And he only realized after the fact that it was luck, and then he started diving into the process and understanding himself, and then came back stronger. Exactly.
So he came back from it, which, I mean, yeah, maybe it's a bit romanticized, but it was the part that I could see in myself as well. I think because I was in a bit of a pit, so I just resonated that if you keep going, you keep trying to develop yourself and how you're trading. A lot of it is synonymous with your own identity, you know. You do something, 10, 12 hours a day, it's going to have your personality in. So yeah, it was a great time for me to find those books, and it's definitely one that stayed with me.
Favorite trading film?
So I quite like margin call, probably because I've seen it most recently, but also I think it gives the reality of trading. Like
Of losing money
the
and being in
depiction
a
of it,
scary scenario.
Yeah, it's a bit dystopian, isn't it? You know, when they all get fired and all these desks are empty and everyone just looks miserable.
Yeah.
So, you know, it's the reality of part of this job. It can be pretty lonely.
It could be over one day, overnight.
Yeah, one bad decision and who knows?
Yeah. Favorite technical indicator?
I don't really like technical
Okay, but
indicators, but
maybe not the defined technical, but like how you look at markets.
I mean, I typically use ATR.
You look
when
at
I'm-
volatility a lot.
Yeah, when I'm constructing any trade plan.
What about
but
when you're market making though?
When I'm market making, I try to envisage how the market's stacked. So, exactly. So, like the last few days, we've had maybe 50 bids on a particular structure, and the only sellers are market makers, and a couple of people that are getting rid of a bit of risk.
Yeah.
Versus other, yeah.
That's the curve and all that. Don't give too much away, but that's cool.
Yeah.
All right. Most important economic. What are you looking for data-wise to be released? Like, what do you pay attention to most consistently?
As in day-to-day, or?
Yeah, as in like, some people would obsess about the production program, like we were saying. Like
I see.
Freight, whatever.
For me, it's all about margins. I love looking at margins.
You do. Yeah, that's a big one for you, right?
Yeah.
Okay. What's one word to describe your trading style?
Ooh.
Kind of
What
said
did
it,
Omar
right?
say?
I think he called himself the Don or something like that. No, I think he was kind of like explaining market making, I think. For
I would say it's decisive. I don't like getting bullied into trading.
Yeah, okay. If you were to have a trading nickname, what would it be? We know that.
Obviously the Queen.
Nice. Anything else?
I
remember saying to you, like, definitely no brokers, and they would never say anything to your face. But the way you have to talk to them, the way you do talk to them, don't think they're not going to be slagging you off, calling you a bitch, calling you whatever. But it's all about how you. But you're going to be called something bad. What bad thing do you like being called? Would you rather be like, oh, she's a nice person, but completely like weak and wet?
Yeah.
Or like, what a bitch, but like strong, never bully her. And that's obviously more your thing, right?
Yeah, absolutely.
Okay, if you weren't a trader, what would you be?
Probably a portfolio manager.
Well, you had JP Morgan, you were going to do that, right? That was your first thing, asset management.
Asset management. So,
But you gave it up, so obviously not.
well, because I didn't know really
You wouldn't
that
have
this
gone
is
back
what
to
a
it.
trading role was.
But let's say trading didn't work, would you have gone back to asset management?
No, I probably would have tried to find trading in something else.
Okay, let's just say you can't do finance then.
Okay. A doctor. I mean, I was very close to.
But you gave that up as well,
know,
so
I
you wouldn't
know.
have been a doctor.
But if finance is totally ruled out, the only reason I didn't
'Cause you
do
found
medicine is because I did finance. So if we weren't able to do that, like now, if I was to, knowing what I know about trading and how my personality is, I think I probably could have gone to be a detective.
What, like crime scene, obviously, and like homicide and...
Or maybe a bit more high level, like MI5.
I think you just watch too much TV, that's what you want to do. But yeah, fair enough. Okay, what about a quote that you live by, right? Not necessarily a specific trading quote, because, I mean, you don't say things like Gartman rules every day in your head, right? So as in like, what governs you? Is it that, it could even just be like, keep going or whatever, or like...
Oh, I see. For me, I probably don't flap. Like, if you've done something before, the idea of having self-doubt is just pointless. You know, you've made the decision, move on.
Or make a decision.
That's
That's
but
good.
the idea of flapping, it's just...
Is there anything, do you think of anyone when you're thinking that, or a quote, or like, does anything work to inspire that?
Not really. So you know where the thing that keeps telling me to do it is my juniors. Sometimes I see them doing really nervous behavior.
And it gives you strength.
And for me, it feels like they're not in control. So I'm like, don't behave like that. You know, how you conduct yourself is almost as important as your body language.
There is a quote from that, which is, there's nothing like someone's fear to give you strength. Because it's a very leadership-driven thing. So you see people flapping, scared, or whatever, and it's like, right, get into protector mode, right? Like, I need to therefore step up.
Yeah.
And if you're feeling a bit flappy, but they are, you can actually get strength from it. So it's ironic. But
Yeah, exactly. So, yeah, there we go.
cool. What's one sporting event that you would go to that you haven't been to yet? That is so random, but I think I asked Omar that, so yeah.
I've been, to be fair, I'm lucky that I've been to quite a lot, but one that's
Or
on
do you even like sport?
I do like sport, yeah. I prefer to play it than to watch it, but I would quite like to go see the darts. I've heard it's quite
Are
fun.
you serious?
Yeah.
You like the basketball, I thought. We've done that already.
Oh, sorry, yeah. My dream would be to go see the NBA, like a final or something, courtside.
All right, brokers out there listening, he's keen. All right,
If not, you can take me to Ali Pali.
Yeah, exactly. So what about an event in general, like a bucket list thing? What about, what's on your bucket list?
I mean, the NBA is pretty bucket list, but aside from sporting, I'm becoming a bit more interested in kind of fashion shows, etc. So maybe going to one of the like high-end fashion shows in Paris, probably.
Just going, or?
Yeah, not walking it, Christ.
Well, yeah, like maybe a VIP back end.
Yeah.
All right, finally then, what's one skill every trader should master?
Just one. Discipline. For sure. Every time.
Of yourself, of the
Everything.
process, of everything.
Of everything. Discipline, adhering to your own belief system, your own trading views, your own tradecraft, your schedule, you know, in anything. You have to have discipline.
Okay. We'll leave it there. Thank you.
Thanks.
Hi everyone, I'm joined with Vincent from Flux Insights. We're going to discuss the major themes in crude this year, 2025, and some of the things maybe going forward. This is about the narratives, the themes, the positioning, some of the more nuances and Brent Dubai, dated Brent, and all the rest of it, and just give a general overview, right? So Vincent, take it away.
For sure, let's get started. So talking about the key crude themes this year, you can't go without talking about the overarching narrative, which is OPEC unwinding their voluntary cuts.
Absolutely.
Which that has, the first tranche has been completed in September, and they're beginning their next tranche, the 9-member voluntary cut and the collective group cut that's supposedly ending by the end of 2026. Of course, that is quite, the market has a bearish interpretation. Whether that's actually bearish for the physical, that's very much up
That's
for
what's
debate.
been up in the air. So I think, coming into this year, they were actively unwinding on paper. They were calling for it. We're working through this kind of volume triangle, whatever you want to call it. We're about here, right? We're starting to get towards the end of this in theory, right? And we're starting to get to the last 2 million. But really, like as Jorge has been going on about, the officials have been going on about, the data is so spurious. The ideas, the talk of the super glut has been, just banded everywhere. Every trade house, every consultancy is looking at their supply and demand balances and saying, on this, in theory, data, this is what the result is, but we just haven't seen any evidence of that in the physical market. In the benchmark pricing. But then we're into that dichotomy of like how are benchmark contracts priced? They're priced by freely available oil and or traded oil, and of course sanctioned oil can build and be oversupplied, but not filter its way into the price. So that would be like, just to like lay it like straight away. This will drive hedge fund narratives. This will drive kind of tourist narratives. The market should come off because OPEC is supplying more. But really, I mean, just immediately from a crude trader myself, it's like, okay, I'm only ever going to position, if I really believe in this, and I really believe there's a lot more supply to come back, I'm only ever going to look at Brent Dubai as a proxy for, is it really happening? Brent Dubai has been negative for majority of the year, certainly weak for the majority of the year, and actually went shockingly low, like -3, -4 levels in the prompt, after they announced the latest cuts. So it really doesn't really add up. But yeah, anything to add on that generically or about the narrative?
No, in terms of the physical market, we haven't really seen that weakness, as you mentioned. And
Well, the physical market, oil and water, like we could get into that, but it's more the physical pricing of the benchmarks. We haven't really seen it.
yeah, and for the Saudis, they have a bit of spare capacity, but other producers, they were overproducing initially, so maybe they are maxed out in terms of their production, as well as Saudi, they're sacrificing their revenues for market share. So that's another big theme as well.
Do you think there's enough information out there, Financial Times, Bloomberg, etc., more generic, bigger media, have they reported enough on the fact that this data seems spurious that could filter into more of the touristy hedge fund narrative?
To be fair, Reuters did come out with a headline mentioning that only 75% of the supply hikes have been actually completed out of the stated amount. So a lot of the hikes is just notional, just the numbers only. Hasn't really. Not many countries can actually have the capacity to raise that output. So it's actually more bullish than stated.
Sure. But as you said, that's been the leading theme. Hedge funds have been shorting all year. CTAs have obviously been going with it. We've got Max short there. I'm sure you'll go into all this. And it has worked, largely speaking, right? We got down to almost, I think it was 60.07 on the very low of Brent. Yes. You've got the price, nice.
So this was in early April, and another big catalyst was the Trump's Liberation Day announcements, which also catalyzed a big sell-off too. So confirming prices down into the $60 range.
So going into, this is April. Yeah. God, it's crazy to think back now it was at that level. But this is the Liberation Day tariffs and the carnage on that day. I know the market was positioned generally bearish as a kind of sentiment, as a kind of a discretionary trade, CTAs, and people holding puts. I think there was quite a lot of interest in holding some of the options, trying to see this like move down throughout the rest of the year. You got really paid aggressively on this move if you were owning puts in particular, because volatility absolutely split out. It's such a big move. Volatility roofed, and the price obviously moved down quite aggressively. So these kind of 60 puts did very well for a time. But what was immediately obvious there when the sell-off happened was when you compare it to other years, other years you're getting negative refinery margins, negative crude differentials, negative time spreads, and it's kind of flat price has to go because it's just a house of cards. It was kind of the complete reverse. Flat price did move, generated by a big like macro sell-off. The weight of the risk-off money in the hedge fund world and all that really kind of drove this down, it seems. But once we got towards the low 60s, the front Brent spreads just wouldn't move. And it was about 30, 35 cents from memory. And it was there. And it made you think, God, flat price moving like almost $10 and it doesn't want to budge. That is like the North Sea traders are really looking to own that time spread, which means they're really confident in the physical and holding the physical. So actually that became a buy. And then when we leveled out, that time spread went all the way back up to $1 positive. And if you're $1 positive on a time spread, that's just, you can't say anything other than that's a strong market. But that's my anecdotal thing there. Anything to add on the general theme being, bearish throughout the year because of OPEC? But is that really why it went down? I mean, who cares for a trader? But is in like all the signals whilst it went down kind of didn't really signal that we're actually oversupplied?
No, it felt like actually previously it was when Brent was trading between 70 and 80, it was always quite tentative, always felt like something was wanting to pressure prices down. And now then OPEC coming out, Trump's liberation day, the cat was out of the bag, gave the macro market really a reason to accept the lower prices when other players most of the market wants to be bullish. They finally accepted this lower narrative. But of course in the physical market wasn't so, didn't really indicate an oversupplied market. So it's more of a reset. Basically. Yeah.
Okay. So you'd be forgiven for retail traders, investors, people who aren't, oil professionals, would just look at that and say, OPEC are producing more, oil prices down is completely logical. But I think our initial review of this is like, it's very much a positioning thing. I'm not really sure it was about anything other than that because nothing followed through on the physical signals. But why don't we go to the next thing?
The next part, another key thing driving the markets, that was in June, the 12-day war between Israel and Iran.
Of course.
Which those attacks saw Brent spike into the 70s, even up to the high 70s for a few days until Trump came out, until a ceasefire was announced between the two countries, which this was a moment where volatility had really spiked. There were a lot of call options being put on, but as has been a theme over the past couple of years, the market really usually intends to sell into these rallies and geopolitical risk when, as soon as it comes out that, as they realize that the disruptions to exports or supply or infrastructure wouldn't be affected, that there wouldn't be a regional spillover in the war. So that's the main key theme. So market really sells into these rallies.
Yeah, there's a time decay to these things. There's high tensions and all the threat, but the tension can remain high geopolitically, but every day that real oil isn't being disrupted is a day further the market is starting to calling bullshit basically. And so you have a kind of natural time decay in moves like this. And then you also have a natural time decay in the options that you're owning. That is real value deterioration. But we were very vocal about this. Like we just said, we had the move down to low 60s. The market was comfortable with that because it aligned up with the OPEC narrative. It was seen as the tightness in the front, I guess, was going to be fleeting. You had consultants and banks, etc., talking about their supply and demand models indicating oversupply, just not yet filtering into the benchmark pricing. So that's when this started to filter. This is when we started to get that narrative slightly shifting. The kind of feeling of, okay, I know you haven't seen it yet, but you will. And then it was like in Q4 is when you'll see the builds. That's when this narrative started to happen. So you still had quite a bit of short positioning here. So in this rally from 65-ish up to the peak, just below 80, because the market wanted to be short, let's say, from a discretionary basis, we said it was massively an options rally, wasn't it? It was a very local to call options is where the majority of the market put that trade on, which if you think about it, made a hell of a lot of sense because options are all about insurance, right? So you're insuring against a huge price spike, but you're positioning for it to go down. So you don't think this is going to last, but you don't know. And when people start talking about closing the Straits of Hormuz, well, that's actually a new thing, as in we've talked about it a million times, but the Iran are actually threatening to do it. You've got Polymarket saying, will they close the straits? And people are betting on it. And there's people in the straits themselves from ships talking about it. It was genuinely a threat. So if you don't believe that oil prices should be high, but of course you recognize some huge event could be likely and cause price spikes, you're going to buy insurance. So it was a massive scramble to buy call options. It was a massive volatility rally. But when it got to its peak, which was kind of like the Sunday night really, and you had weekend trading on IG and you had people like really thinking it was going to go on from here. As you said, that's when the market says, do you know what? They didn't close the straits. They talked about it in government and they said they wanted to close it, but nothing really happened. I think this has reached its peak. I think it's fever pitch. And this is when we got this really aggressive sell-off, which was really a sell-off in volatility if you were looking at the volatility on the options. And then of course the direct price, and that was kind of the end of that, right?
Sure. So it just ended very, very abruptly as well. That was when Iran struck one of the US US military bases in Qatar, and the market treated that as the ending of the war, because as in they allowed Iran to do that to escalate to de-escalate, and then afterwards Trump came out saying that both countries had reached a ceasefire, or he forced a ceasefire on them after the next day actually swearing on TV as well, which made both sides get the point. So then abruptly Brent returned to really normal, and then the market just returned to its old narratives.
You're a fan of Trump and his narratives. You always have been. You always comment on it, make jokes, all that kind of stuff. The point is that the new age thinking, particularly for a younger guy like yourself, is to be very in tune with the temperature of the dialogue. But if you go back, say, 10, 20 years, you're getting official narratives from governments, and you are really, genuinely believing in what the policy statements are and the conditioned narratives. And it's very, I don't know, in retrospect, very organized. These days, people are tweeting like Trump. There's all these threats from Iran. They're sending videos at night with like pictures of bombs, being like, this is it now. My question to you would be, on retrospect, where is the predictability in the chaos? Because like you said, it kind of was, right? Like you're saying, swear on TV, you get these kind of indications and you go, see that, I think that's de-escalation. You're getting a lot of transparency and live visibility into the thinking of these people. Do you see what I'm asking?
Yeah, exactly. Similar to the attack on the air bases, so it was very similar to last year. There was the Israel and Iran also traded attacks to when Iran retaliated against Israel. That was very, very telegraphed. Talked about with intelligence and military, like the US military in advance. So that was when the market interprets this as kind of like a performance. Then it means that both sides have been given an off ramp, and this was the case in the Israel and Iran 12-day war as well. So
is the answer, because when I say where is the predictability in what's seeming chaos?
Yes.
Is it to recognize that it's a drama?
To recognize this, yes. Well, the official narrative would be to recognize that there wouldn't be any disruption to...
recognize that they're all playing games. And if you're comfortable with that, you can start to look for the signals. Whereas someone more, let's say, old school or kind of not, or a bit blind to the game and the agendas, they find it harder, right? They're like, hang on, this is chaos. Like,
yeah, so kind of reading between the lines in that sense.
Yeah. But it's funny because I think particularly the newer generations are finding it very comfortable, in fact, very relatable to see people like Trump, people like even the Iranian generals and these people, the propaganda, they're actually very comfortable with it because it's immediate feedback, and you can kind of weigh up the feedback and people's comments, and the interconnectivity we have around the world it's actually incredible. In an event like that, you've got people on the ground saying, yeah, look, we're trying to get out of Iran right now. I'm blocked up. I'm trying to get my, I've got staff saying, I've got to leave because I've got to try and get my mum to the border and things like that. And you've got information that way, like live. You've then got obviously Twitter, people tweeting like all the time, threatening, we're going to bomb tonight. And then like all this kind of stuff. It's incredible how transparent everything is and playing out in front of you, that someone like me or you, just literally sitting in London, like watching from a phone, can get a very like good sense of what's actually going on, and then we can judge it. You see me? I think your generation is very comfortable with that.
Oh, for sure. They also call OSINT, open source intelligence. So, and especially, for example, the Russia-Ukraine war, just to go on a tangent, there's a lot of military footage, and then often these military analysts online, they can interpret these videos from these various Telegram channels and judge based on like how much progress each side is making. So with this is you just really using the power of the internet and like geolocating things and using that to your advantage. And
so again, if we go back retrospectively to this event, I would say with AI, it's not like it wasn't here this year. So you can't say in the future it might be difficult in these scenarios. It's happening right now. Just to add on to your thing, someone might say, okay, well, if you've got all that open source intelligence, that makes you very vulnerable to a very well done AI video to cause a price spike and all that. We actually haven't seen that, have we? We've seen people take every video and go, I don't know about that. And it's actually quite hard to convince people that something's real until they see the hard evidence. That's quite interesting, isn't it? Like, for example, the Qatar thing you just said. We were getting live streamed. Those the Qatar bums. People were sitting in their balconies in Dubai and going, we're watching. And it's like, people need to see that, don't they? Because of AI, because of recognizing that you can manipulate videos. Is that a fair point?
Yeah, for sure. It's especially with the advent of AI, so many deep fakes can be created, not just of events happening, but also of famous people speaking as well. You really need to verify that. For example, when Trump said at the F-bomb, they were coming out saying that was not AI. He actually said that. So it's very interesting about like verifying information. If people react to supposedly fake news, then that really has an outsized impact on really people's positions, P&Ls.
But I think you said it quite well. The industry or the professionals are looking for this. They love this false peak. They really, I mean, we know one particular trade house, but I'm sure a few trade houses were actually short volatility, did very badly on the way up, doubled down here and then made it all back, which is kind of as you'd expect these guys to do. They get caught out fine, but they recognize what's going on. They stay calm and they're ready to sell off when it happens. So this is where you're getting the dangerous area. If you've obviously maybe just a natural long position and you catch a spike or you kind of buying into this, fine. But when you're coming into, a few days of the crisis and you got people like Andrew Tate saying, I'm buying 1 million barrels of oil because of the crisis, that was more last year actually. But like, that's when you're like, ooh, we're looking peaky here. If Tate's getting long, if people like that getting long, exactly. You're like, it's too in the narrative and not enough has happened for us to believe it can go any further. You're right. That's when the industry's starting to think, okay, what's overpriced here? Because that will be a good risk reward trade. It's scary, but nonetheless. Okay. Let's move on from that then.
So onto a bit of positioning as we've touched on a bit earlier. So onto our Flux Insight CTA model. This is for Brent futures. We've been seeing that recently, particularly recently, CTAs have been close to their max short level. So we can see the rises and falls sort of in line with the price action. So during the 12-day war, there was a brief increase and then positions slowly coming off. But what I wanted to touch on is that recently, as there's been more and more talks of the oil glut narrative, Brent potentially collapsing below 60. There's also a bit of technical analysis on that, but we've been seeing the CTAs were close to being max short. So what this means is there's not that much capacity for them to add new short positions.
It also creates a vulnerable market for spikes every time,
which is what we saw recently in the last couple of days. So.
Exactly. So absolutely bang on. I mean, that's what I would emphasize too. But I think I would just say the theme of 2025 has been a saturation of this information. 2024, this was hot information. This was everyone wants their data. Everyone kind of wants, from Bridgerton or Flux or whatever to be like, where are people actually going to sell this stuff? Sorry, where are the CTAs going to get their sell signals or buy signals? Because it's all relatively transparent. That's why we have these models. There's pre-programmed, momentum signals and data that they trade off. That's the whole point. It's transparent and methodical, so you know what you're kind of trading into, and it's just strict rules. But the point is that whilst that might have been interesting and people trade around it last year, this year everyone seems to have it, right? And everyone is thinking the same way. And this is where it can get a bit dangerous. When there's positioning information out there or when things are too transparent, you're going, oh, well, that's at a maximum low or that's at maximum high. Okay, take the other side or I'm going to avoid hedging because of this, because of that. And it's like, it really can impact market dynamics. Because if I want to go and you want to go and we both stand off, the market can't really function as it's meant to function. A massive like tangent to that, but the same theme, is shale oil hedging in 2022 and end of 2021. There was a great article from the FT, and one of the shale oil producers was saying, I'm not going to hedge. Every single bank is out there saying oil is going to go to 150. Why the hell would I sell side hedge? And you're thinking, yeah, we're bullish too, or whatever. But no, that's terrible news, because if he doesn't sell, there's no liquidity for the market to orderly go up. So what's happening? That natural huge sell side volume we were getting before is now no longer there. So now everyone's just waiting for a price spike. And then when the price spike happens, people are scrambling to take advantage, or when it comes back off, people are scrambling to get the things off. So I would say that's starting to happen. And it kind of happens with any new information, like Genscape, when it first came out way before your time. Genscape preempts the EIAs, right? So the stocks. And so everyone's trading off it, making a load of money. But then everyone wants that information. Everyone gets that information. It's leaked out there. Then everyone's trading off that. And you've just changed the trading paradigm. It basically gets absorbed in. I would say 2025 is the year where this has not become obsolete, but everyone knows it. So don't think it's not priced in or not in people's thinking or whatever else. That would be my take.
Yeah, for sure. The democratization of information, right? When everyone is aware of this, then you kind of need to see new strategies, or to kind of think to when this previously had people thinking 2 steps ahead. Now you need to think 3 steps ahead of what's happening.
That's efficiency. Okay, so let's move to the next one.
Right, just a brief rundown on the technical analysis side of things. So as we can see, this is the chart for Brent futures over the past year, and there's been a lot of support at the $60 level, as we talked about extensively. Very psychological.
Very strong floor, right?
Very strong floor. Yeah. Previously, that was the $70 floor last year, but now that's acted as resistance. But last few days, there's been a lot of narratives about the oil glut, potentially prices falling under 60 when shale gonna be.
And again, the new theme, new narrative. But again, technically, you had that very, very strong support psychologically and technically, I guess. And the blue line is the 200-day moving average?
50. That's a 50-day moving average. And incidentally, that's where we've seen prices sort of see resistance over the past day. So what this means is that a lot of people, and at a time when narratives are driving the market, when there's a lot of algos, when there's a lot of volatility, people will tend to look into the fundamentals the technicals for their day-to-day trading, and these in the market as liquid as Brent futures, these moving averages, the psychological levels really play a huge role in where people buy and sell. And so looking at the moving averages, it potentially gives a signal onto where prices might see resistance in this case, or in other cases, the prices go down where they might find support. So this is just a snapshot of the latest take on where prices are going right now. But of course, overall,
we're very much at that moving average support line. I think that's incredibly important. And again, if it goes too far, we're going, what market regime are we in here? We've just flipped from a really weakening market, an acceptance that the glut is here because of the oil and water being the highest ever or close to the highest ever. The benchmarks are actually starting to feed that in. It's getting weaker and weaker in dated Brent. We've gone negative in the differentials to literally overnight, bosh. Okay. Now we had a bit of a short covering rally in dated Brent. We had, that actually seems like that was nothing to do with the sanctions. And then the sanctions came in. We've just flipped to a 2022, beginnings of a 2022 narrative, which is insane to think about, how you can go from almost max bearish to max bullish. And it's real, and I guess we're in that scenario where, that's why I brought up earlier, the market, I think, is aware, the wider market is aware that there is this dichotomy of freely available traded oil, and that being a market, and physical oil that's sanctioned, that's on water. The market's had to contend with that forever. I mean, the Iranian sanctions have been around for a long, long, long time. And that was always the case. You have these oil and water tankers that are just there. They're just constantly there. And it doesn't mean it weakens oil prices, because they can't affect benchmark prices. So this is like Iran on steroids, right? So I think people are aware of it and they genuinely believe in this. It's psychologically very, very hard to make money here, because if you're directionally trading and you've got into this narrative, people love to say traders shouldn't be emotional and they should be clear thinkers. It's complete and utter shit, right? The humans aren't like that. And also, it's just not true. When they form stories, they form narratives, that they are obviously going to get invested. So if you're so invested and then suddenly news comes out, you've got a hell of a lot of processing to go through to accept that you're in a genuine bullish market and then go, I'll first of all stop out, which is a hard thing to do for a lot of people, and I'm going to get long. You can flip long short if it's short term, but when you've been investing for a whole year in a short position and you've almost got to the break and you've maybe started this huge bear run, 30, 40 cents of Brent spreads to suddenly be highly backwardated, I don't think a lot of people made money there. I think the people who were already long in the North Sea, okay, they've done fantastically well, but that's more luck than anything else or insider information. But for the general market, I think this hasn't been a good thing. Now that we've got this like nice support line here, maybe it's a sign that we could steady for a bit. The market could kind of take a breath. And if this is real, or people are starting to believe this is long-term real, then maybe they can start investing here and there could be some decent money. But we know, obviously, Trump could go, yeah, sanctions over. So anything else on generic technical basis? I mean, has the RSI been useful this year? I mean, what's been useful technically?
I think the most useful thing is psychological levels and the moving averages. Especially if prices diverge too far away from these average lines, then there's bigger potential for a mean reversion. But in the sense that in the very short term, it's a good guideline for price action or for day-to-day trading in terms of informing when to enter or like position sizing, as well as when to stop out. Because if you want to, a lot of people probably may have placed stops just below 60, but we saw there was clear support at this level, and towards the moving average, we might expect prices to stabilize a bit more. So in a time when the markets are so volatile, chaotic, Trump can come in saying anything, reversing sentiment. Technicals are sort of a little a haven of sorts. Not that it's predictive for price action, but really helps with informing or providing a framework for risk management.
I agree. It's been quite effective because even if you look at this market, CTAs have been short all year. Well, they must have done okay. I'm sure it was very hard here because they were max short around here and then they had to cover. But, they're relatively slow to cover and then they were getting short again. And you have generally performed. It'd be amazing if CTAs haven't net done okay in oil this year. And from technical traders, they've probably done okay because if you're absolutely agnostic to the physical, you're not getting blindsided by the physical narratives, the gluts. You go, look, it's trending down. There's some quite nice patterns going on here. And I think it's generally been quite useful. It's traded quite faithfully to some of the core principles here. So yeah, all right, let's do the next one.
Next one, we move on to Brent to buy. So touched on this a bit earlier. This is on an M1 basis, just quite volatile, but it's reached all-time lows.
Incredibly volatile. This is just for your sake. I've been trading Brent Dubai for a long time, right? 13 years, and the range is typically 50 cents being very much the low, really, to plus $4 being the generic kind of high. That's been a very solid range, and it's never really going through that range. It's either in a regime of low Brent Dubai or high Brent Dubai, and then you kind of have a regime shift, which takes a while to reprice, and then you stay there for a while. This has been, these ranges, you're talking about going from $2.50 to $1. So imagine that was 1 to 4. That's a considerable regime shift. But you're doing that from a negative to a small positive. This is like unheard of, right? So it was undeniably volatile, very difficult for the market. And I think the tourist trade, unfortunately for me, because I was always talking in the bull game on this differential, OPEC supply hikes, it was very low. Actually, we can go back here. And then you should expect a long-term rally as the market reprices because OPEC are back. It's pretty generic narrative, but it obviously should hold. What happened? It tubed and it tubed again. And you say, this is the announcement, right? OPEC announced, and then it tubed again. What's happening here? Well, you can say fundamental narratives, you can say physical narratives, and people love to do that. At the end of the day, this unfortunately is what makes trading the prompt very, very difficult, because if you'd held the back end this entire time, it's kind of been exactly what I'm saying, low positive and just kind of stayed there. I think we're max high 1 on the Cal 26, down to minus 20 now roughly. But that's not too bad. That's kind of what you'd expect. In the prompt, you have to stay away a lot of the time, unless you're going to be very, very careful on your position sizing, because literally anything can happen. And the narrative was Chinese SPR buying. We've got all the Chinese buying SPRs. It turns out that was bullshit, right? Of course they're buying the SPR, but they always buy for their SPR. It was a pocket of concentrated buying that trade houses were able to use as an excuse to run all the tourists out of the market. All these massive longs that I think people were building up on this generic OPEC narrative. Bang, like let's just clear them all out, get them to all stop out, and then into the pricing month, just take everyone unawares. To get to -$2, it makes no sense, right? There's no justification. This is all about pricing dynamics and the trade house games. And look, what can you say? That's what they can do. That's how the Platts have set up that benchmark. You have to stay out of it. Easier said than done, and I didn't in some scenarios. But I think that at the end of the day, that's the only real message here. If you expect rationality, it's not going to happen. But just to finish off my ramble, I still think this proxy, this Brent Dubai differential, you can get it on Flux. Even if you're listening to this and you're a retail trader, you can still get Flux for free if you have an account and you're trading with us. Even if you aren't going to trade this differential, you should watch it like a hawk. Because if your leading narrative was OPEC this year, then I'm telling you, you can't short flat price or you can't get mega bearish until Brent Dubai really rallies. Why? Because if OPEC is overproducing, Brent Dubai has to rally because the Dubai has to reflect the weakness. Well, it has to be stronger than fucking negative because that is suggesting quite clearly a very tight Dubai market. So if OPEC are going to bring back all this oil, you have to see that Brent Dubai correct for there to be even the suggestion that there could be oversupply in the physical market and sustainably so into the pricing. If not, and actually that kind of proved right. I was very surprised we were selling off as much as we were when the Brent Dubai wouldn't rally. So it's all been a bit random, and that's kind of like, I'm glad you brought up this chart because it's kind of signifies best the year of trading crude. Why is Brent sold off when you haven't really got any logical moves off the back of it on something like Brent Dubai? The CTAs have all been max short, and the physical traders are probably thinking this doesn't make any sense because the market's really tight. I should buy. It's been chaotic. It's not been aligned. It's not been clear. Like in 2014, we had a Brent Dubai rally. We had the physical diff sell off, we had the time spreads go negative. We had all this happen and Brent selling off. It was a very orderly rally on retrospect. It's been nothing like that this year. It's been inverted.
Yeah, very, very much so. It just goes against the logic that you would usually expect.
Basically, yeah. That's what I'm saying.
And to refer to what you were saying earlier about the Brent Dubai previously trading very high, this seasonal chart from Flux really illustrates that. So the white is from 2025, and since last year, really, prices have been...
This is only for the last 4 or 5 years, but even so, it's still the case, right? Like 2022, which is the real, obviously, ridiculous moves we had. Look, it's so high, and that's with Russia being taken out of the game, right? How are we this negative? How do you create a fundamental justification for Brent Dubai being this negative? The answer is just positioning, just not to repeat myself, but yeah, that's it.
I mean, yeah, people do find fundamental reasons, but overall it is just the buy market has been super tight. Although the last couple of days we did the increased sanctions on Russia, where you would
this is actually a bit more of a logical sell-off. I agree. Is that what you're going to say?
Yes.
Yeah. So this one we kind of gapped down, didn't we, in the prompt? It made sense because, again, back to this freely available oil versus sanctioned oil. So the freely available oil, if you want to trade the Eastern, you buy, Al Shaheen, you buy Murban, you buy the local grades in the Middle East or the Saudi crude. Now, the Indians in particular were buying all this Russian oil. Now the secondary sanctions have come in that they can't even buy, or they don't want to buy that oil anymore. They have to go and buy Al Shaheen or something like that. And Al Shaheen directly prices Dubai benchmark. So that had to create a bullish impact, and Brent Dubai had to sell off, fundamentally made sense to, and I don't think people were going to stay in the way of it this time. So I think there were stop outs here, and I think there was also a lot of belief that you can't stand in the way of that. So I agree with you, and maybe now it can become a bit more logical now. Who knows?
Yeah, sure. So yeah, that's just the Brent Dubai in a nutshell. So against a bit of logic, but recently, as I said, Russia sanctions, more tightness here.
Yeah.
So that's Brent Dubai. Lastly, we'll have a look at the North Sea crude market. So this is just a snapshot of the Data Brent physical differential. As you know, it goes ups and downs depending on the supply and demand dynamics, the trading, the positioning, of the physical guys. Recently, we've seen a big,
It's like a
collapse.
CTA graph.
Almost, yeah, almost. It's just a bit of a seesaw effect going on. Recently, people.
Let's just quickly explain this for people who don't know, right? This is, again, it's not easy information to get. You can get it from us. But this is the physical differential from a Platts perspective, right? From the PRA perspective. This is what they're using to set the price for dated Brent, which in turn will set the price for all the differentials and then ultimately Brent time spreads. So generically speaking, even if you've got no interest in trading some of the dated Brent contracts we have on Flux, etc., you should still look at it to get an indication of what the physical differential is. And that will link very tightly to the Brent time spreads. And the Brent time spreads in turn will give you a good indication if the market is strong or not. So that's why that's so important. Basically look at this like a time spread. Yeah, so we've been going from negative 3 times in the year to incredible spikes. Again, this is what's just nuts. It's like Brent Dubai. It's like you would expect in a typical regime, you're either strong and you're kind of 40 cents to $1.20, let's just say. That's a very healthy, strong physical market in my experience in 13 years.
Yeah.
Then what will happen is it will reprice and the range will be $1 to 40 cents. And that's how it goes. Just like I was saying with Brent Dubai. And you see all the correlations in the wider market. Might be a bit choppy, but ultimately the market's either strong or weak, basically. This year, we've gone from pretty damn weak. 50 cents. It got down to 50 cents again a couple of times more recently. Okay, genuinely a regime of bearishness.
Yeah.
To a flip to unbelievably bullish. It honestly does blow my mind a bit because it just shows you flipping from so bullish to so bearish and flat price kind of nicely trending down didn't really make sense. It just shows the chaos again. We're kind of repeating ourselves, but that's what I get from this graph. What else would you say?
Yeah, it's just lots of ebbing and flowing. It's just more recently in the last 2 months as talks of the oil glut, the increased supply narrative comes back online. As our viewers might recall, for October, November, Brent futures expired. Vitol took on a lot of barrels, and then also so in recent weeks, the physical was quite supported up to $1, and you had headlines coming out from Bloomberg saying, it kind of almost goes against the narrative of a supply glut, but then the physical differentials came off into the last 2 weeks as as the market became a bit more oversupplied, cargoes were struggling to clear. And but then all of a sudden recently we still need to update this, but the physical has been rallying again. It might be a bit of a short covering.
It's on its way up, and you can get an indication from the CFDs, data Brent CFDs, not to be mistaken with retail CFDs. This is the CFDs and data Brent, and they're interesting to track because you can get a forward indication of what the physical differential is going to be, or at least the market's interpretation of what the physical differential is going to be. And that is looking strong. That's looking like it's going to bounce back up, which does make logical sense. But I massively agree with you. The supply gut story has always been here. It was concentrating in the last few weeks. And one of the major reasons was this sell-off here. This sell-off in physical differentials, one down to negative, was the more classic repricing you would expect. And I was really genuinely expecting, right, here we go. This goes down negative. Every time spread in Brent is not deeply backwardated, deeply contango, but meaningfully contango, minus 10, 15 cents, 20 cents a spread. And there was only one spread, or maybe Jan Feb as well, slightly, two spreads to go. And it's over. It's a contango market. We're in a regime. That is what you'd expect. And it did look like Brent Dubai it kind of started to make sense. Brent selling off, Brent Dubai picking up, physical differential selling off, and then bang. Yeah. For fuck's sake. That's why I say I struggle to believe that people made a lot of money on this, because you are looking to trade this repricing and it's all making logical sense. And then you get a black swan event. So you pick up again. The question is going to be, in everyone's mind, do you get long? So to your point, Vitol buying a hell of a lot of cargoes expiry, other trade houses owning oil here, they've gotten super lucky, right? They're gonna do very well. Fine, that's the way the game goes. But having said that, once it prices and you've made your money, are you going to get long again? Are you going to genuinely take on the physical again and expect this market when you know how vulnerable it is to a sell-off? And all you need is to Trump to tweet at 12 p.m. or 12 a.m., whatever, and say, I've agreed to remove sanctions. All that oil and water, like I said, Iran on steroids. Whenever it would be announced back in the day that Iran sanctions were going to be relieved, you knew all that oil was going to go find homes. It was unequivocally a bearish event. It's that so much more. We've got so much oil and water. If you remove the sanctions or a peace deal is made, I mean, it's like 1 billion barrels. I don't see how oil doesn't go negative again, or at least threaten to in a short period of time whilst the market reprices and clears this oil. You might not see oil negative in the benchmark prices, but you will for sure see a lot of people struggling to get rid of the oil and paying people ultimately to get it cleared so we can start again. So honestly, I wouldn't put it past the market to price incredibly strongly in the next few weeks, rest of the year, but then also be vulnerable to an incredible price dump. So, I mean, buy volatility, I guess, is the only thing left to really say on that side of things.
Yeah, for sure. Buying volatility and the post-sanctions trade, there's going to be a lot of adjustments being made. That's for sure.
Yeah, and do you know what? Even as we're saying this, it's a Friday. What's the date? Whatever we are. We're launching next week. This will be online and part of Flux News. Man, think how much could have changed in the next 3 days. So look, just so the audience knows, we were on a Friday, just only a day after the sanctions were announced, or a couple of days after. So we don't know, but it could literally be the weakest market ever or the strongest market ever next week, which is nuts.
No,
but yeah,
for sure. Another really important, some interesting, a bit more niche chart I want to bring your attention to is looking at the actual physical differential versus how the data Brent, how the forward curve was priced a week prior to expiry. So that's for the weeks.
This is data Brent implied. You're looking at the CFD curve, right?
Yep.
CFD curve, the market anticipation of data Brent versus actual. This is a great graph. Yeah, thanks. Sorry, just wanted to make that clear. Go on.
Yeah, so on the left side, that's what was implied on the CFDs, and that's blue bars, and the orange bars was the actual physical differential, how the actual market was priced. And over the period of summer, there was a period where refinery margins were super strong off the back of stronger distillate cracks, gas oil cracks. And so the narrative was that triggered a lot of refinery buying, especially in July and August. So hedging the cargoes on paper. So the paper implied was really high, but when it came to the actual physical pricing,
but when is the snapshot? So is it like 3 weeks forward?
1 week forwards.
1 week forward, but you could even go 3 weeks forward. That would be very interesting as well, because 3 weeks forward, and if you go to like 13, 17 week in October, people were pricing that at plus $1. It priced minus 50. So that's when, again, that's another signal to be like, bosh, the market's cracked.
Oh yeah.
So
yeah,
sure. But your point is what? That it just struggled to actually reach the heights.
Yeah, for sure. So during a full period between July until September, it's if I have the numbers right, the actual physical was weaker than implied for 14 weeks in a row. So in theory, if you were to short the 1 week roll into pricing, every single week would have made money for 3 months straight.
That's a very nice physical signal. Sorry, a bearish signal. I'd be looking at it's really struggling to keep up here. And it just re-emphasizes the same thing we're saying, but this great analysis. Like, I think it's a shame you don't have that week, because I could show that. But other than that, like, you need to get this out more in the reports. Like, people should be clambering over you for this information. It's not easy to obtain, but you'll supply it, won't you, Vincent?
Oh, for sure.
For a cost.
For sure. So lastly, refinery margins looking forward. Of course, it's closely linked to how the demand dynamics in the data Brent market, and margins have been creeping higher since the start of the year. This is the M1, and gasoline cracks, diesel cracks have all been really supported. So, and in line with this, we've seen physical strengthening off the back of the sanctions news, and margins are pretty strong as well. So this makes, at least from my perspective, a bit more bullish going into the winter time, especially refiners coming back out of maintenance. There's going to be a bit of demand coming online, as well as the fact that if margins are in a high environment, then some refiners may be looking to defer their maintenance schedules come spring. So there's a very much a bullish thesis for data going afford if you come.
Well, and as you saw on your previous slide, like you said, the refiners are buying those CFDs to hedge this kind of thing. And you get the indications, it's got real paper impact on the dated, which then impacts the Brent spread. So don't think that that's irrelevant. That's super important. I agree with you. I just wanted to add, going into the year, reasonable margins. This spike, the market's been pricing on a refinery margin basis as if the market has, or the world has, a lack of refinery capacity. And to some extent, that's probably true because of Russia being bombed, maybe that kind of thing. And China probably not running their refiners anywhere near what they're capable of doing, like more like 50%. So it kind of makes sense, but it's also pretty crazy. And I agree with you. It's hard. It's a very bullish signal to have such strong margins. And for them to be up in this is European, remember, not Asia with the sophistication. This is European crappy refiners making a hell of a lot of money. They've all been wanting to sell their refiners for like the last 10 years, but you've held on to them. You would have made money, quite a bit of money. And I think when it's as high as $9, it's so hard to look at that and say, are we actually in a bearish market? And then, but to challenge that a little bit, we were selling off. This sell-off, the latest sell-off from 950 down to close to 7 was happening with the physical diffs coming off. Just to repeat myself, everything was coming in as you'd expect. And the problem with margins is if the demand is relatively healthy, but you've got an oversupply story, then you can justify having low crude prices and high margins because the products just are a bit more sticky, but the crude is getting, so it kind of makes sense. So you justify to yourself, it's okay. It makes sense that margins are high because crude's weak. But the problem is, can you really get a proper sell-off if their demand is still kind of sticky? And we've seen a considerable amount of consumer hedging at every point at every major sell-off. The tariffs, that sell-off we talked about earlier. Do you remember we were talking about in this podcast earlier on in the year? Like insane amount of consumer buying from fuel oil. Then we got to recently with the sell-off when we got close to the 60 figure, the most ever jet fuel consumer buying, people are saying, from a hedging basis, like really, really concentrated buying, like quite unusually so. And that does have a bullish impact on the margins and the overall flat price. So what I'm saying is a real sell-off, if you like, will be completely undeniable on a margin basis and on a flat price basis if there is a demand shock. So that's maybe been the problem, if you like, for the market to not really follow through on this bearish move. I think we've got to see the recession that people are talking about. Yeah, UBS was saying it's like a 93% chance of recession now in the US. Okay, well, if that's the case, then you will get demand destruction and you will see these margins weaken. And once these margins are down into negative territory, it's going to be the complete flip. There's going to be a lot of reasons to sell off and to not hold up, but we're nowhere near that right now.
Yeah, for sure. So very much an oversupply story. That's a narrative of the past year. So demand has been keeping up, but there's just been more supply coming online.
Yeah, but like you say, like when you have shocks and you have maintenance being over and you've got refiners for reasons to buy the paper, it's hard for there not to be a big bullish impact. And then when you have CTAs max short and the market's so short, it creates vulnerability to these market roofers that we've periodically seen. And that's, I mean, I think we've done hopefully a relatively good job there over the course of this podcast to really emphasize when people say it's been a difficult market, this is why. Because you get it a lot. You know, it's been volatile. Surely it's been easy to make money trading. And the CEOs of Gunvor and Vitol and stuff were asked this as well. Like, how's the market been? They say it's just been very difficult. And people generically don't understand what that means. This is why you get this bullish signal versus this bearish signal. You've got oil and water versus very tight free markets. You've got all these things going on. You need kind of, yes, volatility, but volatility around kind of correlated indicators that over time can create a regime shift or a repricing. That's what the market was looking for. It didn't get it. So you're getting winged and wanged everywhere, and it's very difficult.
Yeah, I suppose like the difficult kind of volatility, especially with the US administration comments and stuff as well.
Yeah,
usual
100%.
Yeah, all these changes.
Yeah, cool. So should we finish maybe just quickly? You know, as I said, we are doing this podcast only very recently after the sanctions have been announced, the latest sanctions, and a lot could change. But going into next week, should we put some predictions in place? What do we think is going to happen? How do we think things are going to pan out?
Yeah.
Go on then. So we got the CTAs probably still need a lot to buy back. There's a lot of capacity for them to buy back. We've got refining margins, very strong. We've got the Russian refiners still getting bombed. We've got a lot of bullish reasons, and we've got a big paper unwind from the market being so bearish for so long. the longer these sanctions maintain, the longer the market believes in them, the more time the market has to flip their positioning materially long. So I think it's obviously contingent on that, but I think we can easily go back up to the 70s here, and it could be a very decent bull run. Brent spreads, basically a full bull narrative. That would be my prediction if things are going to stay as they are.
I think so, yeah. But to speak of what might happen on the opposite end, if Putin comes to the table quickly, and US have mentioned publicly that potentially sanctions relief for freezing the front line, all of that as negotiating tools. So if that comes out, these headlines come out, then we could also see a rapid unwind as well. So as to we need to look at, like, the traders need to set stop out levels very cautiously.
I think so, and I think momentum trading could work. But remember, when you get bullish and you get volatile, it's tough.
Yeah,
you get chopped in and out of trades. My take would be trading from the long side, but the higher we go, start to pick up cheap put options. Because there's no, it's like a COVID event, right? If imagine being told COVID could happen. You're like, okay, I'm going to buy some fucking $20 puts, because if it does happen, it's going to really aggressively get there. I think the market is signaling that to us. It's saying, right, trading for the long side. But if Putin makes a deal with Trump and like it's happened overnight, then you really can, with all that oil and water, go from 75, 80, I don't know how high we're going to get, 85. You can genuinely go down to $30 with how much we've got, and how much positioning and how much carnage can happen all at once. So the only trade there is long volatility. So you have to own an option, you have to own an out the money put, and you have to, obviously, when that happens, price in the volatility roofer, maybe at that point, take it off and have a short position, whatever. The point is that could very easily happen. That might become a crowded trade, but basically long outright, the higher we get, the more you're buying out the money puts, will be my thing. And you could do the same with time spreads. You can buy CSOs on Brent spread puts. You can say, as we get to $1, $2 backwardated on Brent, if that's going to happen, you can start to look at the deferred curve that's been dragged up and start to buy, minus 60 or minus 40 put options on the spreads. That would be my take. I wouldn't do it in gas oil, because gas oil has still got that Russia situation. It's still got all that consumer buying. Clearly, there's still demand. But at the same time, if there's a macro sell-off and there is a recession that comes in and all this gold unwind and everything, that kind of stuff, then yeah, you could get washouts everywhere. But that would be my take. Anything else to add?
Yeah, I think with these hypothetical trades, one would be covered on both sides for sure. So you can, like, on the rally, flat price, right, and then if things go the opposite side, then the puts will have you covered.
Yeah, I'm not trying to say buy when the market goes up and sell when it goes down.
No.
I think the market will go up as it is right now.
Yeah.
But because of the shock decision, the best way to trade a shock decision is to have a put option. And actually, if you had them in the tariffs, like I was saying, you got paid very quickly in 2 days, and then you're out of it and you start again. That if you're not in it, you'll lose it. You know what I mean? There won't be time to sell on the way down. It will be too aggressive. So you're going to need that insurance. Great. Vincent, thanks very much. That was very thorough. And thanks again, viewers out there. See you again soon.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined once again by Harry and Julian. This week we're going to take a slightly different approach. We're going to look at benchmarking and why it's important and how you can use the Flux platform to make better informed hedging and procurement decisions. So, I think last week we were talking a lot about diesel and I think it's particularly important for that market, but probably even more so for the biofuels market, where it's particularly opaque and difficult to get an idea of where spot and forward prices are trading. So just if we kind of recap last week, Julian, you gave us a bit of a breakdown of what makes up the price of diesel at the pump. Maybe we'll recap that briefly and then we'll go on to talk about HVO as well. And
Absolutely, Tom. So this pie chart actually you can find on our website if you navigate to Flux Markets /diesel. We're taking government data here and then blending and decomposing that government data to give you this pie chart. And I think one thing that's really important, if you subscribe to Flux Markets, you can dig in and see this value changing in the future, which is really important. Some people are aware and other people aren't aware that the pump price is one thing, that's today's price or the spot price, i.e. for immediate delivery, but actually this price evolves over time, and at the moment actually it's getting cheaper the further forward we look. And in this time of where everyone's very acutely aware of affordability, it's really important. As you say, that's much more difficult to do with biofuels. And actually on this pie chart, there is a sliver there. Let me just see, it's the RTFO costs. That's the cost to be compliant to blend in biofuels. So that yellow sliver there, it looks very thin. It's about 7-8p. It varies. It's been as low as 0 and it's been as high as 12-13p. So it's very variable. It's a substantial amount of the fuel price at the pump. And that is driven by the cost of blending fuels into diesel, and we're going to look a little bit more at that today. So just looking at that pie chart in a different way, in terms of thinking about affordability, that dark blue part is the raw cost of diesel. Then the green part's that renewable transport fuel obligation, the RTFO compliance cost, the cost of blending in the amount of biofuel to meet the RTFO mandate. And it's really important here, B7, when you're filling up your car with diesel, you might have noticed that it says B7. Diesel cannot be more than 7% bio, physically. So the actual RTFO mandate, if you look at it, it's today around about 14-15%, and it's increasing over time. So in terms of affordability, that cost is that yellow sliver is going to increase, right? And that is being driven by pressure, various different pressures, feedstock pressures. We can cover that a little later. It's pushing that cost up.
So that's an important point, actually, just to kind of reiterate. So you're paying for 14% biofuel component, but actually only 7%
is actually going into your car. Yeah, it is a really important point. You're absolutely right to pick that out. But it actually, the grid is decomposed. Well, I view the network, I should say, that's the entire sort of fuel pump network, whether it's physically large bulk fuel being delivered into a bus company's depot, or whether it's a retail person filling up their car, ultimately is decarbonising by about 14%. RTFO, keep those statistics, you can look on their website to see that if you want to, and the history of what actually has been blended in. And we'll come back to that because 7% is the max here. So how on earth do we get to 14%? That's through a different type of biofuel, HVO, which we'll have a look at that in a second. And on the previous slide and on this slide here, we've got these two red bars. Affordability is a key thing at the moment. And if we look at those red bars for the previous slide and for HVO, this is the government tax. This is duty, 53, almost 53p. That bigger bar there on the right-hand side and the bar above it, that's VAT. So VAT and duty together are a substantial amount of the diesel cost. And what we can see here is the UK's UCO, used cooking oil, that stands for HVO. And this HVO has apparently a significant greenhouse gas savings. That is, it's more, a plant was planted over a year ago. It sucks CO2 out of the atmosphere. That plant was planted to produce cooking oil. That cooking oil was used to cook. It's then been collected after being used and fed into a refinery to produce HVO. HVO is very expensive because you imagine picking up a lot of 1 litre bits of used cooking oil everywhere and then bringing it back to a refinery and redistributing is expensive. And what you can see here immediately on that blue bar, the raw cost of HVO, used cooking oil based HVO, is 3 times more expensive than diesel. Okay, now this has got an orange bar on it, and that's because this market is subsidised by the RTFO scheme. So when you buy diesel, that little green sliver we were looking at, green sliver on the previous slide, that 7-8p has been collected. There's billions of litres of diesel being consumed in this country. That's going into a pool at the DFT, and then the DFT are redistributing that pool for people bringing in 100% HVO and other biofuels too, and they are then getting subsidised. And I always say a subsidised market's not ideal. It suggests fundamentally it doesn't really work, right? Possibly, right? Thinking about affordability, this is not a great situation to be in, but however, HVO is the easiest fuel to try and change over to a greener fuel. And I'll say that in inverted commas because I'm not sure how green HVO really is myself. But anyway, so this is expensive. Tom, you want to say?
That was, a valid point. I just wanted to say about HVO versus sort of other biofuels like FAME and Ucomi is that HVO is fully interchangeable with diesel, isn't it? So
yes, it is.
You can run it in a normal diesel car. There's no kind of cap on how much you can blend. Absolutely. And it can also kind of sit there in a reserve tank indefinitely almost without breaking down. So it's quite
absolutely right.
Desirable for things like data centers and things like that for their backup generators.
Back to affordability, you don't need to change any of your pipelines, don't need to warm your tanks. So some biofuels like fatty acid methyl ester, you need to, if you went with a 100% fatty acid methyl ester, it's cheaper, but actually you have to heat your tank, heat the line, and make changes to the vehicle. With this fuel, there's no change. So it's an immediate replacement with no capex, no capital expenditure. So this is considered the fuel to decarbonise this network at scale. And when I say at scale, we're at 14% now. Come 2030, we're at 30% for the EU, and the UK is following that trajectory. So we're going to see more and more of this coming to the pump, and I put this in inverted commas, pump price, because you generally can't buy HVO at the pump at the moment.
Yeah, I was going to say, in terms of demand for HVO, it's still kind of industry, right?
Yes. Yeah.
It's not like a kind of commercially available fuel for retail consumers.
One reason for that is, as we look at this chart, is the expense. It's 3 times more expensive.
That's who would actually buy it?
And it's really companies coming out of COVID that were really, they've got their customer base were very focused on decarbonising. So, just imagine a pizza box from pizza supplier down your road with "we've gone green" on it. This would be one way they'd achieve that ESG focus. But of course, with affordability being so apparent in this country at the moment, tax burden and everything else, this is a real issue, and this is an expensive fuel to change. So, pump price here, this builds up to £1.83 with VAT and duty on, with no supplier margin embedded into that. Whereas today I can buy diesel at £1.40, so it's significantly 50-60p more expensive. It really is. And again, in the context of 50 litres, that may not feel unachievable. It's on affordability on a personal basis, of course. But if your Domino's Pizza is consuming 30 million litres of diesel a year, 60p is now a very big change in cost. Yeah. But you were saying, Tom, we've had a lot of people coming and asking us about benchmarking.
Yes,
absolutely,
yeah, because lots of these companies are using these fuels. They're kind of they're significant purchase of it, but it's very difficult for them to get any transparency over where the market's trading, and particularly particularly to gain access to a forward curve, because they want to hedge their demand going out 1 year, 2 years, and there's whole market's completely opaque, really, isn't it?
Yes, it really is. And maybe that's a good point to go to the next slide here quickly. So if you were a subscriber, and you can get a free trial, so you can check these numbers out. You can log on and see these numbers changing every day. We're marking them every day and live during the course of the day. And, HVO is still a developing, fuel physically and also on a forward market basis. We've striven to put it on here. And what you can see here is This now doesn't include VAT, okay, but we do have duty on these numbers, okay? So you need to add it, and it doesn't include VAT, it doesn't include supplier margin either. So this is the fuel with duty without VAT and supplier margin.
So it's effectively like a kind of wholesale price, isn't it?
Thank you. Yeah, exactly right. Well, yeah, good addition. And what we can see here is actually the BALMO, or spot forward numbers, were £1.52 for HVO. And we've had a few people going, that number's completely wrong. I can buy at £1.30. Why? You're completely wrong on your number. This number is good. And as what we can see with the forward curve here is it's very what we call backwardated. It's getting cheaper and cheaper as we go further forward. And it drops off into 2026 to almost £1.30, £1.31, £1.32-ish. And if we took an average of 26, it'd be around about £1.32 and a half, approximately, right? Comparison to diesel, right? Diesel, ex-rack diesel with duty, no VAT, no supplier margin. That is around about £1.02. So we got £1.32 and we've got £1.02. So we've got about a 30p difference. And if people are often looking at HVO and diesel, both fixed price, this is a really good platform to benchmark what your supplier's offering you, first off. So a real live example, we've had 3 or 4 people in the last week coming into us, your spot number's wrong. We can buy at £1.32 on diesel, £1.33 on HVO. Okay. And we can also buy diesel plus a fixed premium. Just for example, £1.25p. So how would you use this platform to compare floating diesel price plus 25p for HVO? So the HVO is priced on diesel. You'd look at the diesel line on the right hand side here. Look at the 2026 value, about £1.02. Add on your premium 25p, that works out to be £1.27. So you could range your physical floating plus that differential, come on here and hedge on diesel to lock in your HVO supply cost at £1.27. Or you could buy from your physical supplier at £1.32p for the HVO. So the platform's really useful for benchmarking and actually asset checking. Am I getting good value with this fixed price off from the supplier, or should I build it by floating and actually hedge independently?
In both of those examples, I think that the platform just makes it really clear there, isn't it? That's a great deal, and you should absolutely go to your supplier and lock that in. And I think it's worth mentioning as well that the supplier might not be pricing based on spot or where they see forward. They might still be pricing on where they bought the inventory.
And that might have been 2 or 3 months ago. It might have been that they aren't holding inventory, but they've got a contracted price that they arranged 2-3 months ago, at the beginning of the year even, because the volumes of HVO are around about, from memory, it's around about, I need to think this through. It's about 300-400 million litres. Last time I checked, it's probably higher than that now. And it will increase because of the changes you mentioned. And we'll come back to this in a minute. We're going to see more and more HVO coming online, more and more need for people to control and benchmark costs. We think the platform's brilliant for it. And as you say, your supplier's volume turnover, it's not the same as diesel, where they're literally turning their tank over 1 or 2 times a day, right? That's not the same case for HVO at the moment, because the uptick it's a fraction, it's 1% of diesel turnover, right? So it's much smaller turnover, but it's going to increase massively, I think.
Yeah, and then I think, Harry, you were going to give us a bit of an overview of what's been going on in the diesel and HVO markets, actually, which kind of might help to explain a little bit. How those suppliers are able to sell HVO so cheaply, because we've been in a bit of a bull market.
HVO has been in a bull market this whole year, basically. I mean, we'll see some charts in a bit, but there's this chart actually on the screen at the moment is this is the gas oil swap, and since we filmed the show last week, there was a global rally in gas oil prices, which is the benchmark for diesel prices, and this was caused by a number of things. So there were some announcements on kind of further sanctions on Russian companies who supply a lot of the refineries in the east still. So that kind of squeezes the margin on these refineries in the east to procure crude from elsewhere. So we saw gas oil versus we've touched on cracks last week, but the difference between the gas oil product from the refinery and the feedstock crude oil, that differential blew out completely for gas oil this week. And we just saw outright gas oil prices. I think they outperformed Brent by about $8 a barrel.
Yeah, it had a huge day on Wednesday, didn't it? But it was also kind of, I think Tuesday had already started rallying and almost did about $100 a ton, didn't it?
Yeah, it did. Yeah, and again, you never really know. The Russian sanctions, they get announced. It's all a kind of bit of a perception thing because you never really know how it's going to actually materialize. But whatever, the price action was strong. There also was some news of some refinery outages, one in Kuwait, I think one in India as well, where some of the secondary units were offline and took a significant capacity offline. And again, these refineries were big middle distillate producing refineries. So coming into winter, and you've got kind of cold weather as well, coming into winter, it's, the stocks were quite low around the world and the market was kind of primed for shocks to the upside. So when you have this kind of news, it just completely goes hyperbolic.
Because we've been talking about tightness in this market, like even since the summer, right? And I guess the kind of moving into winter, then that you've got this additional like seasonality dimension as well.
Yeah, and it was maybe waiting for a bit of an impetus to move. And when you've got a market kind of primed like that, when you have like a shock, multiple shocks, this kind of thing can happen.
It might be worth saying to some of the listeners just why would India and the Middle East impact the UK? And some people may not realise we hardly refine any diesel in the middle distillate here at all. We import everything, right? More or less.
Europe's an enormous diesel consuming continent, but it's not an enormous diesel producing continent. So it relies heavily on imports. And since the whole Russia war's been going on, the kind of global, Russia was a huge exporter of diesel
to the UK.
It was kind of coming in through other countries, but effectively all of this stuff, any kind of shock to global supply is going to shock Europe as well. So even though it seemed like it was the Singapore contracts and the kind of Asia contracts that were driving it, because they are the kind of purchasers of this Russian crude, and that's where the Q80 refinery supply would likely go as well. But Europe's not immune to it. It's a very import reliant continent. So any of this kind of global supply disruptions is going to massively affect Europe. And we've seen kind of in June as well, when we saw like tightness in like the Middle East and tightness in the US, it was the Europe contract that did a lot of the work. The Europe contract blew out, again, just because of the reliability on imports. Yeah, thanks, Jim. It's good point. And then this chart was just to visualize. So this is the wholesale HVO. This is the dollars per ton price of HVO cargo. And this is just to illustrate kind of since the summer, but we've seen kind of more broadly throughout the whole year, just a really kind of steady, well, sometimes aggressive bull market, and various reasons. But recently, and I'm going to put you on the spot a bit here, Julian, but
that's fine.
But recently, the narrative has been around some of this new EU legislation,
absolutely,
which is kind of squeezing the kind of putting a perceived squeeze on biofuels.
It certainly has. What struck me before I answer that is just what I want to point out. That raw HVO cost here is $2,600 a ton. Mm-hmm. Raw diesel cost is $700 a ton. So it's more than 3 times more expensive, this fuel. Hugely expensive. To your point, your question you were asking me, Harry, there's been a confluence of issues. Close to home, we have, actually went live in May this year, is the RED, Renewable Energy Directive 3. It's the 3rd generation of the RED directive. And this is an EU directive, and a directive means we're directing countries to adopt this and bring it into legislation, and it's up to the countries in the EU how they adopt it. So which makes biofuel trading very complicated as a result, because they all adopt it in different ways. And some have adopted it and some haven't, at different stages, although it was supposed to come in full force in May this year. The key thing about RED 3 is that it is getting rid of double counting. So if you cast your mind, let's quickly go back to that slide for HVO for a second. And see the orange bar there, that's the subsidy. It's discounting the price. And that subsidy is double counted. It's 2 times the subsidy. That double counting is going to disappear, and we're going to use GHG, greenhouse gas savings. The amount of carbon this fuel actually saves will subsidise this fuel cost. So it won't be double counted based on used cooking oil. And subsidies themselves, I always think, I might have said this before, the Indian copper effect. There was this, 200-300 years ago, too many coppers, people getting bitten. So the local sort of councillor said, you know what, I'll put a 1 rupee on every copper's head. And suddenly noticed that more coppers were coming, heads were coming over, because he had an incentive, right? People were now farming coppers to collect the incentive. So there's this perversion of subsidies, and this can absolutely happen with used cooking oil. Used cooking oil can be more expensive than virgin cooking oil. And when that's the case, virgin cooking oil gets classed as used cooking oil, right? So yeah, anyway, the point really to answer your question, RED 3 is getting rid of double counting, and counting will be on a greenhouse gas basis. We could do a whole topic on that. Let's come out of that for a second. So that is going to drive up feedstock demand. So instead of 1 litre of feedstock getting 2 times the subsidy, I now need to bring double the amount of feedstock in, almost effectively, right? So it's put demand on feedstocks. The other thing RED 3 has got rid of is POME. So palm oil mill effluent. It's a really nasty thing, but it's a derivative of palm oil. And lots of people are anti-palm oil in the ESG movement because cut down lots of rainforests to put this in place. Arguments for and against it. Let's not go into that right now. Getting rid of POME, there's a lot of it around. And this now means there's more demand on feedstock. So feedstock prices have gone up, HVO prices have gone up. The other 2 key pieces, actually the other piece that we're missing from this is in the States, the EPA, the Environmental Protection Agency, have just massively expanded their amount of renewable diesel requirement in their to decarbonise their network. So that means no exports from Russia, from the United States, excuse the faux pas, from the United States, leaving the United States because of Trump's tariffs and also the EPA. So there's been a whole confluence of things that have really put massive pressure. And then the other thing is that we've got legislation for SAF coming in for CORSIA, for airlines to decarbonise, for marine to decarbonise.
And that's SAF is Sustainable Aviation Fuel.
Yes, thank you.
There's a lot of acronyms in there.
Lots of acronyms. So it's equivalent, it's the jet fuel equivalent of HVO. So SAF, Sustainable Aviation Fuel, is produced at the same time from the same refinery, part of the refinery that produces HVO, but it comes out lighter end. Okay, and it's blended into jet fuel, maximum 50%. That's gone through the roof as well, along with HVO, because now that we've got this huge focus. So legislation's driving change, driving feedstock change, feedstock cost. There's not enough of these feedstocks around. So in terms of affordability, I can see diesel at the pump getting more expensive. Another reason to come on and look at the platform to fix in your costs, right? And this is not today, tomorrow, but gradually, almost imperceptibly over time, over the course of the next 2-3 years, we'll see diesel going up and that yellow wedge increasing in cost. Bigger element. Okay, the flat price might change, go up, down, but that's going to increase effectively, and we're going to see these costs escalate, I think, as well. Anyway, that's it in a nutshell, I guess.
Cool.
So yeah, I guess then in summary, I think it's just so important, isn't it, having that visibility into the future, being able to see that forward curve, and I guess being able to use that to inform your procurement decisions today, but also secondly having the ability to kind of lock in prices in the future.
Yeah, talking about the backwardation of the HVOs, I think what a lot of people don't understand is, well, if you don't have the visibility on the forward curve, you don't understand how different those values can be in terms of, your spot versus your 12 months out, say. So when you're budgeting or even getting quotes to lock prices in, a lot of people are kind of, your providers are going to be relying on the sort of opaqueness of the market to, to really kind of capitalize on you not knowing how kind of backwardated this market was. You're just taking one price and extrapolating it for the rest of the 12-month period.
100%.
But also if you're budgeting, quite often in backwardated markets, there's a lot more kind of favorable prices to be locked in the future than you might think, being like, well, if the prompt price is £1.50 a litre, just the wholesale price, why would it be like £1.10 a year out? That doesn't make sense. But when you look at the curve, that's kind of like how these markets work, right?
And those prices do tend to roll up, don't they, as they become more prompt?
Yeah, absolutely they do. And I think it's about, you want to compare apples with apples, pears with pears. So you might get one supplier showing you for the same thing, a pear price, an apple price, a pumpkin price, right? But you need to be able to decompose that. So you want tools. You may not be financially hedging, but this will give you those tools to be able to assess value better. And the feedback we've had from 3 major logistic companies is that this was very handy for them to make a decision how they would contract that physical fuel purchase. So not coming here to financially hedge, but to actually engage and work out best value, where to go.
For sure.
Yeah, and I think it's probably, as we've sort of illustrated here, this is a very complicated market to navigate. There's a ton of rules and regulations, a ton of subsidies. Those subsidies are changing all the time. So anything you can use to help give you better visibility is just incredibly valuable. And obviously we're here as well to help our clients as well, and to sort of guide them through the best way to use the platform and kind of how to get the most out of it.
Yeah, absolutely.
Great. Well, I think that's about all for this week. Thank you very much for joining us again. And yeah, we look forward to speaking again soon. Once again, I think as we mentioned last time, if you do have any burning questions or there's any subjects you'd like us to drill into in a bit more detail, please email in, tweet us, and we'd be more than happy to discuss it on the show.
100%.
Great. See you next time.
Nice one.
Thank you.
everyone, welcome to this episode of Flux Insights. I'm Vincent Wu, Research Associate at Flux Insights, and I'm joined by my colleague Martha Dowding, also Research Associate. In today's episode, we talk about various topics in relation to the Russian sanctions, market positioning, technical analysis, deep dives, and a trade idea. Firstly, on the Russian sanctions, this was quite the surprise for the market last week, as it triggered an immensely bullish reaction in the crude markets. Brent rallied by $5 in a week. There was a lot of short covering flows, and it also triggered a huge sell-off in Brent Dubai.
Yeah, I think with the Brent Dubai especially, we saw huge volumes, I think over 26 million barrels traded. But when you look at it with the open interest, there wasn't that huge increase in open interest with that. So we can see there was some, stop outflow probably as the contract kind of crashed. And you can see that in the price action as well. That huge drop is indicative of people closing positions for sure.
The sanctions triggered a massive response because it was two of Russia's biggest oil companies, oil majors, being targeted. Those were Rosneft and Lukoil. Previously, even under the Biden administration, these companies had been left untouched. So market estimates of around 1 million barrels per day of Russian crude exports may have been affected, which would trigger a large reaction in terms of the reshuffling of these flows, and potentially Chinese and Indian refiners are looking elsewhere for the alternative barrels, hence the sell-up in Brent Dubai, also the rally in Dubai structure. But as we can see, prices have recovered into this week as market has sold into this news.
Yeah, there is that kind of healthy skepticism with sanctions, as we've kind of seen, as you said, oil is more diverted, a bit of an increase in prices. But I think just speaking to the officials team, the thing to be keeping an eye out on in the next couple of weeks is the Dubai window. So we've seen a few Indian players buying the Dubai spreads. And so if they were to come out buy side in the Dubai window, which is very, very unusual, then that would be really indicative that they're not taking this Russian crude for their refineries.
Mm-hmm. Right. And on the next slide here, we can see that there's also been a huge rally in the distillate cracks. So over the past week, the front month swaps crack has gone up from around 23 up to highs of nearly $32 per barrel. So a very, very bullish reaction here. Of course, Russia is one of the biggest exporters of diesel in the world, and often the crack is very much correlated to the geopolitical risk, as we can see here. However, again, this past week there's been a bit of selling, perhaps a bit of profit taking, prices falling below $30. So very much it seems that the market has initially reacted bullishly, but now it is correcting lower.
Yeah, I mean, there was also, which isn't helping the strength, well, it is helping the strength, the Al Zour refinery, which is about 615 barrels a day. That's down, coming back. Sorry, what was I saying?
650 kb.
Oh, yeah, of course, sorry. KBD, that should be back in a couple of weeks in November. But this is, of course, putting pressure on the supply side of the market as well. We're looking at this week, API predicted about a 4.4 million barrel draw in the US stocks. So it'll be interesting this afternoon to see if we saw that kind of dip and people will buy in at these really, really high prices. You can see on the screen, compared to historic levels, we're almost at highs in the white graph being 2025. Mm-hmm. And the other thing that's really been, when we look at kind of what's driving the narrative of the market this week, last week especially, there was just so much speculation and so much path tracking for Hurricane Melissa, which is unfortunately a Category 5 hurricane. You can see that was taken this morning. The scale of that, unbelievable. The strength is huge. The pressure different, like the pressure and the size are just catastrophic. Going to be really significant impacts on Jamaica and on Cuba likely. But in terms of oil and gas impact, this has had fairly little impact, but we've got Jamaican's main oil refinery have suspended their operations. It's just about 36,000 barrels a day, but still worth kind of keeping an eye on there. Flights far fewer flights. The airports have been destroyed. But we're coming to the end of the season now. The sea is still very hot, but I think this will probably be it. And the other side of that is there is a cyclone in India. We can see the path up here. There'll be impacts on oil and gas operations on the Bay of Bengal, So Reliance and ONGC, there may be some brief shutdowns there. I think this could grow to be quite strong. And there's also some ports and refineries that could see logistical delays. So that'd be worth keeping an eye on as well for kind of fuels, bitumen, kind of lube oils as well. So that's kind of making landfall today or tomorrow. So we'll keep an eye on that.
For sure. And on the positioning front, Martha, you were looking at the money manager CFTC data for Brent futures, right? It's been particularly bullish in recent weeks.
Bearish.
Sorry, apologies.
It's okay.
Bearish.
Yeah, so there's no data from the CFTC from the States because of the government shutdown. So just looking at the ICE contracts, we can see there's a pretty clear trend of net positioning in Brent futures dropping week on week. This has been dropping for 5 weeks now. And last week we saw 50% of the long positions that money managers held being closed, which is, a really significant amount. We've not seen that kind of percentage move in like a year. And now net positioning is the lowest it's been in a year. And I know that the general theme of the market is this kind of glut, is this kind of oversupply narrative. But when you start seeing this low level of net positioning, you have to kind of be wary of kind of a short squeeze in any market. So that is definitely something to keep an eye on. But looking at the prod market positions as well, those increasing day on day, that also reflects this kind of bearish narrative. And that's what's on the screen now is that's the Brent futures. And now we have there's the gas oil graph as well, which we'll get up. And that's seeing the same pattern, but less extreme. But net positioning is at its lowest since June.
Yeah, it was interesting to see that the outright short positions in Brent crude, that was at an all-time high. That was in the week just before, the day before the sanctions were announced. So really seems that the market had been really buying into this oil glut narrative.
Yeah. And we're seeing such volatility at the moment. And I think there is not a clear narrative outside of the glut that I think people are kind of glomming onto headlines and sticking with it. But we see now that the sanctions, we're back at pre-sanction prices now. So you see people go down, buy, and then we come back up and we're back at that kind of level that people are comfortable trading at. The other side of positioning, the CTA positioning, this is our CTA positioning index. So you can see it's got the red area at the top and the bottom for when we deem these things oversold. So you can see that the two highest contracts are heating oil and gas oil, which is hardly surprising following the huge rally that they've had. And in the middle, we have seen the two contracts that have flattened out the most in terms of buying day on day are TI and Brent, with TI actually seeing a day on day drop today. So we can see there's plenty of room. It's kind of like, this is no help. No, but it is. But for Brent and TI, there's room to buy, there's room to sell, there's plenty. And heating oil and gas oil can keep inching up, but I think that selling we're seeing today is really going to help rebalance the market and leave room for buying at the EIA stats if needed. And if not, we'll leave room for a bit more positioning and rebalancing as the market kind of corrects.
Yeah, you're very right there. There's more room for repositioning. And we had pointed out last week in our research reports that CTA positioning for crude, Brent and WTI, they were at max short. So that would have limited room for further down.
Yeah, you can see prices. That here. There was that good increase. Good call.
But now as players rebalance, there might be more room for a downwards trend should there be more bearish catalysts.
Yeah.
Okay. Looking into the deep dive, which is where we have a weekly reports based on our commitment of traders data, but we look at in-depth case studies on a particular product. And last week we looked at the EBOB crack, the European gasoline benchmark, which was at an all-time seasonal highs, and it continues to climb up as of this week. Prices in the M1 front month contract are trending particularly high during wintertime and are at the same level as they have been over the past summer, so indicating really, really strong demand or a lot of supply tightness concerns. Interesting enough, on the open interest front, the market has been very, very risk on. So a lot of players have been adding risk, adding positions there. Positioning is very overcrowded. This graph is for the November contract, and also for December crack, the open interest is also just below the 5-year high. So positioning is very, very oversaturated. But the fact that there's a lot of players positioning in there means that there's both buy side and sell side flow. Buy side in terms of the speculators, whereas on the sell side there has been a lot of refineries coming in to hedge and attempt to take advantage of stronger margins. Of course, from a entry level price perspective, as we can see from a screenshot from our COT dashboards, because prices are at particularly high levels, if longs are very in the money and they decide to take profits, then this may limit the short-term upside, as is refinery short selling. And going ahead, what this means is that as refineries come out of maintenance in Europe, should Dangote's refinery continue to operate at a reduced level, this may increase the demand for gasoline in Europe, especially from the West African region. And of course, in the short term, this may be quite bullish, but towards the medium term, as refineries lock in their margins and produce more, we may see greater downsides in the crack. But overall, it has been particularly bullish, and we have to highlight with our data, with our positioning, that there has been a lot of market interest in here. Looking at the technical sides, we do a fair bit of technical analysis, and we have a dedicated weekly report for that. And today we want to highlight in Brent crude futures recent movements, which have been very much technically driven at a time where many market players are confused in terms of the volatility, because Martha, as you mentioned previously, the market was quite net short for money managers, and the recent spike in price action may well have been a short covering rally. And at the same time, prices were down to the $60, a very crucial psychological level. But if we want to look at the wider, grander scheme of things, prices remain in a very bearish regime for Brent crude futures. The graph shows that prices are seeing lower highs and also below the Ichimoku cloud, which shows that still prices are in a bearish regime. At the bottom graph, the stochastics indicators also show that there has been a bearish crossover at overbought territory, which indicates that at least in the very, very short term, prices have reached an upside and there has been an exhaustion in bullish momentum. So from a technical perspective, there's concrete reasons for the recent come off in Brent futures.
Yeah, that's a nice reversal candle as well at the top there, that doji with the long upper shadow. That's a good call.
Very true, yeah. Shows market indecision at these high levels, with that Ichimoku cloud as almost artificial resistance.
Yeah, it looks really clear resistance there. My contract this week is quite niche. We're looking at the 3.5 barges crack, which is the high sulfur fuel oil contract for Europe. As you can see, wanted to choose this one because it's got a lovely upward channel, and we're looking into this week. We can see that 100-day moving average has crossed into kind of realistic bounds that we could be trending towards. Looking at prices, we can see that there was pretty strong resistance at that psychological level of -2. People like round numbers like that, and we can see that prices have started to come off. So where do we go from here? Looking at the momentum of the contract, there is that selling momentum by looking at the stochastics. The fast signs cross the slow line in neutral, which shows that selling domination of the buyers, and also the MACD histogram is dropping day on day. It's really, really low. That's technically still bullish, but it dropping day on day shows that kind of lack of momentum. I think I would be bearish here, aiming towards the 100-day moving average and lower bound of the channel, if I were to pick.
Yeah, low bound of the channel looks like a very crucial level here. Okay, onto the crystal ball moments. So this section is where we discuss the fundamentals and the conditions relating to the macro environment, the Brent crude futures, and we have a discussion and debate on what we see are the key factors in the market and where we think prices will go from here in the short term. So there's a couple of main factors right now. You have oil on the left, on the top left chart from Bloomberg, showing that it's at the highest level since the COVID times. Of course, market supply glut narrative, and interestingly, China has announced today that Xi Jinping will meet US President Donald Trump tomorrow. There has been a widely anticipated meeting from the market, which, of course, there was some trade tensions a couple of weeks ago, which triggered a bearish reaction to crude. But because of the fact that they're meeting, there's been some concessions from both sides in the trade negotiations. The wider risk assets markets, especially equities, they are fairly bullish on this.
Yeah, I mean, just talking of trades, kind of concessions that you said, soybeans this morning, I know this sounds pretty random, but we have been keeping an eye on this because it impacts biodiesel, diesel, also gasoline. We initially were like, oh, that's great, for their relations, it's going to be, bullish relations that they've bought this cargo. But in fact, they've not committed to be buying lots of cargoes. They haven't, set up anything, any kind of contracts. They've just bought 120,000 tons, which is like a lot, but also that's kind of indicative of maybe I don't know, I am a skeptic, but I obviously hope that we get lots of, things the tariffs produce and stuff, but that's just me.
Yeah, those are certain, it is a start for sure. Of course, the market is quite focused on the short term, and at least what this means for the narrative is fairly bullish, especially with the FOMC meeting tonight, in which the market has priced in a 25 basis points cut. So that's also another bullish factor for risk assets. But on the other side, you have the global surplus and the oil gluts, and spreads were all in contango just early on last week. So maybe that's become more into focus. But
I think there seems a disconnect though with people reading about this surplus, which they can't really see. But then the things they do see, like the EIA stats every week, we're expected a 4 million draw today. So I think there is kind of a disconnect from people that there is all this oil on transit. When's it going to arrive, I think that would be a pretty significant thing. But I think because we saw all the headlines mainly the week before last, and now it's kind of dropped back into back not into the public's focus so much with this China news, that I think it could, rear its head after this bullish news, and we could see a real crash.
Yeah, so overall, you would say that your view is towards the bearish side?
Well, I think, yeah. What do you think?
On my side, yeah, we've been cautiously bearish here as well. On the Brent forecasts from earlier this week, the explanations were a bit of a technical correction downwards, in which we've already seen, and also the fact that last week there was the rally was very much driven by a lot of panic buying, and looking at the wider price chart, it was more of a mean reversion. But now the market's gone back to its slow downwards grind.
Yeah, that 50-day moving average was such a heavy resistance level that with the momentum we're seeing right now, I completely see how that, was impossible.
That was, quite huge. However, on the North Sea data front, the physical market has been fairly healthy for November structure, especially towards the in the middle part, and then December structure has been pretty well bid, which indicates refinery buying interest, especially coming out of maintenance and trying to take advantage of stronger margins. So from that side, at least, I think the downside will be quite limited in the near term, but more downsides may be coming from later on next year.
Yeah, keep an eye on the spreads. That's really interesting.
Very much. And finally, we have our trade idea based on our reports, Flux Alpha. That's our weekly trade idea report where we discuss our views based on our commitment of traders data, positioning, open interest, technicals, and market fundamentals to create a bespoke trade idea in the swaps markets. And this week, we for one of our trades, we have been discussing going long in the Q1 naphtha crack. Of course, looking at the chart here, the prices have come down quite a bit over the recent month, but the long idea was to expect a bit of a mean reversion. Our naphtha traders would know that in seasonality-wise, Q1 is usually the strongest quarter, especially with the winter heating demand going on. And at the -$5 level, we saw a bit of buying as our positioning data indicated, and prices have since gone up a touch. Our price target is -$440 per barrel. And at the same time, because of the European gasoline supply tightness, and gas snaps have the differential between European gasoline and naphtha. That differential has widened quite a lot, which would be another demand factor for naphtha, and especially because that would be driving a lot of blending demand. So because of that, we saw some good reasons to buy the dip in the Q1 naphtha crack, especially with winter coming in. For the bulls, lower levels would be an attractive buy, hence our basis.
I think it's been so volatile for a Q1 contract, considering we're in October. But I think also we must have seen a bit of pricing in, when we were seeing headlines about, Russia, Ukraine maybe taking it down a bit of pricing in of that Russian naphtha returning, which is hugely impactful in Europe. But obviously, as this kind of continues to elude us, that's probably brought us a really good buying level, as you said, that -5 level. So I think that's, great.
Great. Thank you very much for watching this episode of Flux Insights. Please watch Flux TV for more insightful content.
Hello, welcome. This is the first and only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar, it's all here in the next 30 minutes. Welcome to the UK Energy Show. This week, Donald Trump announces new sanctions on Russian oil companies. There is an immediate effect on global prices, but will it change the cost of petrol and diesel here? One of the companies in the US president's sights, Lukoil, has said it's going to put some of its international assets up for sale. In Europe, it owns refineries in Bulgaria and Romania, and around half of a third one in the Netherlands. Will there be any buyers, though? Also this week, the collapse of Petrofac. The oil company employs about 2,000 people in Scotland. They say their North Sea business will continue to operate as normal. In a statement, they said they had to appoint administrators for its holding company, but that alternative restructuring options were being explored. We'll get into the details. And helping me to understand what's happening are experts. Greg Newman is the chief executive of Onyx Capital Group, and Julian Keats is a senior consultant here at Flux. Let's start with the Donald then. Before he went off to Asia, he did this move. Rosneft and Lukoil are two companies. We'll come on to Lukoil in a sec. What do you think the impact, well, what was the impact of hitting these two companies in particular, Greg?
Hugely significant. I think on the face of it, it was seen as yet just more sanctions, and maybe there was some headline fatigue about that, just saying, what's the big deal? This is huge. The reason why is because in 2022, when the initial sanctions were in place on Russian oil and gas, it was all about directly importing Russian oil into Europe and the US. But what really happened was it just simply circumnavigated around the globe. And we did talk about that a little bit last week or the week before. So that just continued on. So if you like, the big pool of oil, that was the export market, which is freely traded, wasn't really materially impacted. This time, what they've said is we're actually going to directly sanction the producers, Rosneft and Lukoil, who are huge. And not only that, they're going to be a lot more aggressive on the secondary sanctions, which is sanctioning Chinese and Indian companies that were buying the majority of that Russian sanctioned oil. So now it's cut off huge outlets in China and India, in fact, the biggest outlets. And it's also directly sanctioned the producers who are exporting it. So what we're going to have immediately is very similar to the Iran situation we've actually had for quite some time now. And if you go back to Trump's previous term, he had a maximum pressure strategy on Iran, which was saying, let's get their oil revenues as close to zero as we can. And what happened was an enormous buildup of what we call oil and water. So Iran is still producing the oil, they then put it on ships and leave them floating around. This is now pretty much the exact same scenario for Russia. They're producing a lot of oil. It's finding its way out into the oceans and it's sticking there. It got to all-time highs recently, and this was before the sanctions were announced. So already the sanctions were having a big impact. Now you've got these very level up sanctions. It's an incredible two-tiered market. Got a huge amount of sanctioned oil that's going to just build up and up and up. And you're going to have the freely traded market, which is incredibly what we call tight, incredibly lack of oil, because you've just taken out, a huge number of barrels, 5 million barrels per day plus. So that's really significant. So oil prices were on a big downward spiral, long-term trend all year, immediately spiked off the back of it, complete reversal, speculators scrambling, to be honest with you, a lot of money lost, and now trying to gather what's coming up next. A very uncertain market, but look, from the objective look at it, this is incredibly bullish for prices, as we say. And I think, if anything, the market's probably underweighting it right now. And just to finish this off, we were concerned about diesel throughout the whole year because of the reliance we have on Russia exporting a lot of diesel for the world. That's now been exacerbated, 3 or 4-fold, and you are starting to see the prices in diesel as well as global crude prices.
We're seeing that in our headlines again, aren't we? Julian, just remind us of this. They call them shadow ships, don't they? Because these sanctions have been evaded. They've been got round for many, many months. How do they do it?
And well, that's a really good point. I mean, and many analysts argue that is a real risk. So a ship needs a responder that transmits where it's at. If that's switched off, it goes black, dark, shadow ship. It effectively goes off the reporting grid. And that ship now is handling sanctioned goods. It's buying, the ship owner or whoever's renting that ship is effectively paying for that ship in a transaction where they'll get cheap sanctioned oil and sell it to market as unsanctioned oil at real market
And there is a
values.
market for unsanctioned.
I've never been involved in it, but I've heard absolutely there is a market for this.
Can I cut in there?
Yeah, absolutely.
An enormous market. And this is what led to 22 to now a big boom in companies in Dubai in particular, places like Singapore as well, who are okay, at least with the sanctions as they were. It's the thing with commodity trading and oil trading is it's a lot to do with the financing, and it's about the banks. Now, if the banks are comfortable because they see the sanctions as European based or US based, and there's some way you're avoiding those countries and avoiding a fallout, then they will finance it. What's so different now is there's such sweeping sanctions that no bank, I think, really
They're not
in the
gonna
world
touch it.
wants to be anywhere near it. But it's not
Really?
it's not about touching the oil, it's about touching the companies that touch the oil.
Yeah.
And I think they're under so much pressure. And even if Trump was to say, do you know what, we're going to relax the sanctions, they still will be unlikely to be keen to be involved in financing, because what if it switches again? We had a scenario in Sri Lanka even where the oil was coming in, or sorry, I think it was the LNG was coming in, actually liquid natural gas. And by the time it arrived and by the time it was time to pay, they got sanctions. So they couldn't even get paid for what they delivered. It can be that quick. And for a bank, it's a nightmare. The money's trapped and it's lost in transit.
That's a hell of a risk to weigh up, isn't
And
it?
it's guilty before. This is not like normal courts, right? This is guilty until you prove yourself innocent.
Right.
So instant.
I think you raised a really good point there, Greg, and what I wanted to add to it was actually the UK imposed very wide-ranging sanctions on the 15th of October. This is, Trump announced it on the 22nd, 23rd of October last week, right? So the UK had already moved, which I think is a really positive move as well. So these really are wide-ranging sanctions, but it's that second tier that you just mentioned, Greg, that's the real one. Now, the sanctions take full effect on the 21st of November, right? That's when they really take full. So if they really do get policed down to the level, that second level, then the ramifications are very
when you
significant.
say
We're
if
seeing
they
all
really
up to
do-
80 or 90.
I mean, Trump has proven he will.
And I
There's
think
no
you're
doubt
right.
that he'll do
I mean,
it.
India's going to stop buying without a shadow of a
They've
doubt.
already,
They
they've
will
already
back
said,
off.
and we've seen that their big company Reliance that they've already announced themselves they are
totally agree.
switching their buying to the more Abu Dhabi related oil, and that's significant because there's a big thing going on. Like I said, this two-tiered market. Now, the free traded market, if India are turning their buying towards the free traded market, they're adding a hell of a lot of competition to an already highly competitive market. That just causes price increases.
Got to bring it up.
Yeah. So you'll see all this oil in the world, but ironically, that's not setting the price. And that's going to drive people a bit nuts. And there's a lot of pressure from the public probably that will come.
Maybe we should just quickly get a chart. Diesel prices circled there in red. Last week we're about 43p. That's the raw commodity cost of diesel. That builds up to the price that we see at £1.43. You can log onto our website and see this for free. It's on the website. So we've seen prices move 2 pence a litre as a result of sanctions last week. So it has had a direct impact on UK affordability, people that are buying gasoline and diesel for their car, but also an indirect one, because when you order on Amazon, that stuff gets delivered by a truck that's burning diesel. So, and this is true for all your food goods and everything else, consumables, right? So it has an impact on affordability across the board.
On the Lukoil question, and that's a private company, isn't it? Roswell is a sort of nationalised one. Lukoil is in theory a private company, although I think they pretty much
Might argue that,
they have quite a hotline to the Kremlin. Who would want to buy these refineries? Because there's no point in owning a refinery if you can't put crude in the front end, right?
Well, the refineries in Europe, it was more going back, and we saw this in 2022, divesting and optionalities being changed around within contracts and all that in order to stay compliant and it to be majority owned or ran by European-based companies, if not the states directly, like the German states, for example. So this is just an extension of that. I think if they can divest enough to get it down to you can prove control by European companies, then they consider themselves okay. So I think it's the opposite. I think if anything, the fact that it's now open, it's not owned by Russian companies, means those refineries can more freely be available
Could be
to
a plus
operate.
on the upside.
It's an upside in terms of supply and function and operations, not an upside for prices.
I think it's a fire sale as well, so the
Yeah.
price is going to be
So
low.
it's a bargain. If
It's
someone's in
probably going
mind
for a
to
bargain.
buy a refinery,
Yeah.
now's the time to do it.
And running a refinery is not a cheap process as well. So.
And it's not a politically, people don't want refiners. It's not.
Yes.
It's not a good
ESG,
climate for buying
yeah.
refiners. You see Shell, BP, they're all trying to divest their refiners as well. So it's coming at a time where, as you say, it's.
But maybe that's actually reversed. You're right. In 21, 22,
Yeah.
they were trying to divest. Shell was very busy trying to sell it. But now they seem to have pulled back from their green agenda, right?
Well, this is
the last 2 or
it.
3
So
years.
what happens when you have basically these arbitrages available, right? Discounted assets. The private equity guys get involved. So the people who can spot.
There's always a buyer.
There's always a buyer, distressed assets. It's better. It's the companies that are involved in our everyday
And know how to
supply
run it.
benefit from that, and know how to run it. So look, to be honest with you, I hope that BP can change tack and say, right, look at all these cheap assets. Let's buy them up and let's get operating. But they're under a huge amount of pressure as a public company. We've seen that for years. So.
Let's come right back to the North Sea, shall we? Petrofac is another company in trouble, or more correctly, I think, Greg, it is to say it's their holding company, their parent company is in trouble. But these 2,000 job losses coming in Scotland, and actually we've got a clip from the House of Commons. There was an urgent question being asked there. The Tories are pretty angry.
Today, the energy giant Petrofac has entered administration, casting doubt over the future of their 2,000 employees in Scotland, as their global HQ is in Aberdeen, and countless more supported indirectly through the supply chain. This is a company that, as the Minister has said, has had issues for many years. But the hostile environment created by this government in the UK continental shelf has made operating here for far too many companies nigh on impossible. Since the 2024 general election, there have been thousands of redundancies in our offshore energy industry. Harbour Energy completed a new round of redundancies just last month. With depressing regularity, Mr. Speaker, we hear of more job losses in the North Sea. Whether that be at Harbour Energy, Apache, Hunting or Petrofac, each job lost means uncertainty for a family, a mortgage jeopardised, investment fleeing our communities, and our world-class supply chains and skilled workforce pushed towards extinction. Minister, how many more of these will it take for the Secretary of State for Energy to change course? These are political choices. This is a manufactured decline. As a direct result of the hostile trading environment, the close for business sign is hanging over the UK continental shelf.
Well, that was Andrew Bowie, the Shadow Secretary of State for Scotland, giving Labour what for in the House of Commons. Now, there are a particular set of circumstances relating to this. Julian, just fill us in. Why has this happened?
So, yeah, okay. Firstly, I think Andrew is gerrymandering politically there. So the key facts, if we think about Petrofac, they're an oil service provider. They're not a producer. So should they come out of administration, not find a buyer, and it collapses, which would be awful, obviously, for the 2,000 people that work there. Let's just recognise that. But in terms of corporate point of view, we're not going to see a reduction in oil production in the North Sea, right? So that's really important. In actual fact, what Petrofac have said is that that part of the business is profitable. It will continue. So they will find a buyer for that part of the business. And I'm not sure if that part of the business is admin or not. Okay, so that's really important. And actually, why are they here? Directly sort of contradicting what Andrew was saying. This is to do with a court case in 2017 where they were brought to court for anti-bribery, for bribery charges by the Sears Ford office.
And it cost them a lot of money in the end.
And it cost them,
process.
I have the number here, I think it was 77 million. Okay, now they haven't actually made money since 2019. And that bribery case was brought in 2017. It was concluded in 2021. Okay. And during that process, they found it very difficult to get more contracts, because one of the key things when you get a contract is you cannot have any bribery cases. You're not going to get a government contract. So this stops
Doesn't
them.
look great when you're pitching for work, does it?
It means that you're in the oil industry, you're really going to struggle. So actually, they picked a lot of contracts that were very tricky to develop on. And interestingly, one of those was a renewable contract for the Thai oil company, Clean Fuel, that actually Petrofac wasn't a specialist in, took on in 2018, and they couldn't deliver on it. This cost them about 200 or 300 million, and this is what's really pushed them over the edge.
Okay, Greg, let me just ask you, though, about the wider ramifications. Is this going to affect us all? Is it going to affect you and me as consumers?
So maybe not directly, but I think the big thing that's important here, and this highlights, is a bigger political issue, which is We don't seem to understand in Britain that we are responsible for a huge amount of growth and the beginnings of the real freely traded oil market. The price of Brent, which is a UK-based benchmark, and Brent is a physical crude oil that's produced in the UK, that price is 80% of the world. It's a bit like the dollar, everything reserve currency. Imagine that for oil. Brent sets everything. And that's UK based. And the amount of expertise that went into developing those fields, the drilling, the offshore capability that Petrofac do have, this is what it's all about. In Britain, we are so good at this. We're such experts. We've built an entirely financial ecosystem off the back of it, a huge export services foundation off the back of this. And 50 years ago when it started and to now, it's an incredible expertise that people around the world sought after. The commodity talent we have is incredible. Most of the derivative trading, the financial side of things, goes through London. It's a massive hub. So when you're complaining about these companies and how bad it is, you've got to remember it's a bit like that argument against bankers in '08. They get paid too much money and this kind of thing. But London banking is the hub, and they get a lot of bonuses. They pay a lot of income tax, and being the hub is great news for our industry. For our economy. So we've got to highlight that more with the oil market. This company, Petrofac, was exporting their services around the world, particularly Iraq. That's huge for our economy, right? We're exporting our services and killing 2,000 jobs. Deep expertise in Aberdeen that's been built for a long time is a real disaster. And to not only say that it's lost, it's also signifying we're just letting this industry die. We were the pinnacle, and now we're just giving that away, and US companies are coming in and lapping it up, and that's what's really sad to see. And I think that's the wider political point that is very important. And just to finish that off, you could say there's nothing to do with the tax regime. It's nothing to do with UK politics. But it is a bit, right? Because they were not able to be competitive. And this is what economies are all about. Where are you in your global competitiveness? If to produce oil is at 78% tax, and you've got service companies like Petrofac who need to service the companies that are producing at that 78% tax, guess what? They're not going to be competitive. The margins are going to tighten, and they've got to pay the kind of salaries you get in the UK rather than, somewhere cheaper abroad. It's no surprise that it's starting to die out, and there's no support from the government. If anything, it's complete opposite. It's trying to kill an industry of which we're world class at, and that's not nice to see. So I think it's important to mention all that.
I have to come back on that.
Go on then.
So I would say that, from what I can see, that the service industry is viable, so the jobs won't be lost. They're at risk, so they won't be lost, is what I suspect.
You're going to argue the detail, not the principle.
So no. And in terms of principle, I think Petrofac, it's in this position, not because of the UK government, because of its poor governance. And that's different, very, very different.
But that's because you're arguing the detail. As in, at the end of the day, the idea that Britain is a hub for the oil market and it created a lot of what the world uses.
But it isn't UK government, and it's not because they don't want it.
But does it not signify, though, that we are uncompetitive and or losing oil refiners, going from 18 refiners down to 4? That's not this general trend.
I think the bribery case starts it all off. That's what stops them getting more contracts.
So what about the refiners going down then?
But that Petrofac's not a refiner.
I know it's a general principle. I'm saying that our oil and gas capabilities and us as a hub, we're ignoring it and we're letting it go.
All I'm saying is I think Petrofac's nothing to do with the UK government and not ignoring oil investment. That's
Let me
about.
just throw in a decision that has not been made yet, and it is come down to what government do and how it impacts the oil industry. And that is, there's a question about this Rosebank and Jackdaw, 2 oil fields, 2 and gas, I think is involved as well. And I think we've touched on this before, but there's a decision pending because the Tory government said, let's go ahead, let's explore these places, let's see if we can make some money there, let's get some fuel there. And then a Scottish court intervened and said that the proper consideration of the amount of non-clean use of fuel hadn't been taken, so the whole thing got stuck. Now we're still in some kind of weird thing. I was phoning the department only the other day to ask, when are we going to get this decision? They wouldn't say. It just says when everything has been considered. Who's doing the arguments, Julian? What's the Secretary of State got to weigh up here? Whether he says go ahead and drill.
So he has to weigh up the entire carbon emissions, which is why it failed, because they ignored a particular scope of emissions. When an oil field produces, that crude goes to a refinery, and then the ultimate refined product is burnt wherever it's burnt. Yeah. All of those, the global emissions associated with that production, what was ignored was the scope 3. So when that diesel jet fuel gets burnt by a plane, a car, They ignored that in the report. So that's why the Scottish Government threw it out. So they've now rescoped that, or they're in the process of rescoping that. So he's got to look at that and say, is it worth, and to Greg's point earlier, is it worth us investing this, given we've got net zero targets, 2030, 2040, 2050 net zero, and a sloping profile to that, to invest in this, to give jobs, tax revenue, balance the fiscal books, as well as getting to our net zero targets. And actually, I should need to correct the record. Last week when Greg and I were talking, I said I thought in my quick analysis it probably wasn't economic. And I suspect, and again, I don't know Equinor. Equinor is the current stakeholder for this field.
Yeah.
The field is in very deep water.
Norway
It's
state-owned, we should say as well.
Yeah, state-owned. It is 80 miles offshore in the off northwest's Shetland, right in a very difficult location. So this is expensive to produce. So the investment to build the platform is expensive, but actually from the analysis and stuff that is available on the internet, it looks like $13, $14 a barrel. The operating costs, again, looking at Equinor and a couple other and Restart research, probably another $25 a barrel. So we're talking about $38 a barrel. Dated Brent, let's get that price up on the screen now. The dated Brent prices, the forward curve. And when you're in developing a field, it takes 2 or 3 years to develop it. So you need prices 4 or 5 years out. That's the spot price for dated Brent. And dated Brent, just so you're clear, this is on Flux Markets. This is the physical. When you think about Brent, you'll often think about the futures, but this is the real physical assessment you've got on Flux Markets that Onyx trades every single day. And what we've got on the right-hand side there is the forward market. Can we go to the next slide where we just zoom in on those forward numbers? And what we'll see is it's at $65 to $66 a barrel 4 or 5 years out. So that actually, if their cost, my analysis today, which I spend a lot more time on, $38 to invest and operate, dated Brent's at 65, it's economically viable from an economic. So Equinor should be a yes.
So
right?
to your point, we've got all the infrastructure, we've got the expertise we need to get this done. So would you be on a drill, baby, drill phenomenon for that particular
Absolutely.
case?
I think generally always, because I think that we are still using oil and gas a lot as a country. We still import a lot of oil. As I was just saying, the refineries going down more and more, losing all this stuff that was so great and we were such leaders in is just a massive shame. And conversely, like Norway, who we're talking about, these JVs, and they're right next to us in the UK North Shelf. They are also big on renewables. Apparently, they talk a lot about it, but yet they have very well functioning refineries and production, and they're making a hell of a lot of money. And they've got a $2 trillion, what's it called? Fund, sovereign equity fund. So yes, I would obviously be on that side. I think UK should be going more that side. But to answer your original question to Julian, what is he going to be weighing up then? Just Energy Secretary of State. Sorry, the
Secretary of State for
Energy. Is can you handle the political pressure? Because it's not really an argument when it comes to commercial. It's
quite simple, you would say. If you took all the political
more jobs, more tax receipts, more money locally, less carbon emissions, because you're going to have to import carbon emissions if you can't produce it yourself. So it's less. There's no argument. The only argument is because we don't want to be seen. Can you do it politically? Is the public going to have backlash and all that kind of stuff? Cue you to cut.
Yeah, and I would say, what we just need to be cognizant of is that actually the tax receipts are negative initially. There is a massive tax benefit for Equinor to develop this. So instead of getting all the tax receipts on their profits, because there's such a big development cost, HMRC is saying we're not going to tax you at standard corporate rates for the life if you invest in this. The tax receipts will come later.
So Equinor are the ones leading the charge.
Yes, absolutely.
For a UK-based production. Do you not see how crazy that is? So a Norway-based government company would take the risk on a UK production asset.
And you and I and everyone else watching this is taking the risk that if oil prices fall, there's no tax receipt in the future benefit, right? So
but just the irony of the government not wanting to do it, yet a Norway government company will do it.
Yes, that's absolutely ironic from that point of view. Yeah.
It's one to watch. And I'm sure we're going to come back to this when the decision is finally taken. Okay, Julian, while we're looking at charts, let's just check on the latest stats you've got for us on petrol prices and gas and so on. What are the latest charts showing?
Let's just go back to that chart. Can you get the diesel chart up, please? So this is, again, if you're a subscriber to Flux Markets, you can log on and see the ex-rack diesel price. You can also see the pump price as well. The ex-rack diesel price here, you can see the jump up in prices on the 22nd of October. We were talking just now about the US sanctions. Just note, UK sanctioned them on the 15th. You can see no movement in prices there. That kind of says something about how the world reacts to the United States, doesn't it?
Becomes more powerful.
Yes. Potentially, but a really good thing that UK made that statement too, I think, in my personal opinion. So we can really see prices jumping up there.
Can I also say that's not a mistake that it's gapping up. This is the function of the oil market. It closes over the weekend. And so you can just be one price on a Friday night and then you open on a Sunday night and bang, it's higher with no trading in between. So that's why it's dangerous generally.
And then if we just turn to the dated Brent, you can just see here front month dated Brent. And just to remind everyone, this is not a financial contract. This is a financial contract, but it's actually marking physical dated Brent, a cargo with a potential date coming on it into the North Sea. So when we're talking about Rosebank, this is the price that's really relevant, not Brent futures.
But it's very similar to Brent futures.
It is very similar, yeah, absolutely.
Percentages.
I was just going along with this. It's actually really important to see.
Yeah, definitely.
So, and again, you can see here the price is jumping up, those two green bars on the 22nd of October.
All right, we'll keep an eye on those stats week by week. Next, we should abandon the ambition of clean energy by 2030 and focus more on the energy costs faced by consumers. That's just one conclusion of a new report from the think tank, the Tony Blair Institute. The report's author is Toro Langenyan. I spoke to her earlier, asked her why she was proposing a delay to the clean energy ambition.
Yeah, so I think our argument here is multifaceted, but essentially clean and cheaper meant the same for a long time. So renewables was, especially kind of during the gas crisis when this was announced, renewables was the cheapest way of producing power. I think what we're seeing now, though, is that Britain is facing a situation where we have the highest electricity costs in the developed world, and renewables is part of the reason why that is happening. We have not built out the grid at the speed that we need to, and there will be a significant investment that will be needed. So, we have really high additional costs of integrating renewables right now. So we are just saying there is no reason that we need to be sprinting for 2030 right now. We can go a little bit slower, focusing on what's best value for money, how we start lowering energy bills, rather than focus on those small emission reductions that you might see from 2030. And I think that is a more sustainable path, really, to net zero, because firstly, the big challenge in terms of net zero right now is reducing emissions from all the other sectors of the economy where we need to electrify them. And obviously, electrification is easier if you have a lower cost energy. And also, if we want to keep the public on side, frankly, it will be really important that electricity becomes cheaper so that people support the transition as we go along.
So I understand your ambition to try and bring down the consumer's power costs, particularly electricity costs. Well, there are some casualties in your plan. I was interested to read that, for instance, carbon capture. Now, there's been a lot of work done about that, and there are a lot of evangelists who say this is the next big thing. But you suggest that should be parked altogether. Tell me why.
Yeah, I think this is. I think the really important thing that we're saying in the report is that this is just parking CCS for power for the time being. So we're not suggesting that the UK should step away from CCS more generally for industry, for instance, where we have very few alternative ways of reducing emissions. But the reason why we're saying this for the power sector is because we know that CCS for power is going to add significantly to consumer bills. That is because the process of removing emissions, especially where the tech is at in the tech curve right now, from gas-fired generation will be very energy intensive and very costly, which at this stage when the UK is facing such high costs feels like a like a cost that we really can't afford right now, and it's not in the interest of the wider transition. So the few kind of emission reductions you might see from CCS is not worth the additional cost.
You also want to make gas cheaper and argue that's an important imperative in bringing the public around. If Ed Miliband reads your report and does it all, by how much do you think my gas bill might come down?
Well, first of all, your gas bill won't come down on the back of our report. Your electricity bill could, though. We've not done the full work of costing all this, because in reality you have to basically have the kind of central government analysis machine on this, because what we're suggesting are a number of different interventions that could that works in several different ways within the system. However, in terms of the gas intervention specifically, that could probably save you around £20 per consumer per year, which is not a huge amount when you look at it like that. But you could also choose to focus that on lower income households or those struggling the most with energy bills. And as I say, it's only one lever in a bigger part of levers. But look, the reality is reducing the UK's electricity prices is not an easy task. There are no quick fixes, and anyone who tells you there are quick fixes are wrong, frankly.
Yeah, I mean, it was said, wasn't it, I think, in one of the hearings recently, that even if wholesale gas prices come down, the amount of other tariffs that tot up on top of the bill might see electricity bills continue to climb for the foreseeable future. That's not a great bit of politics, is it?
No, absolutely. And I think this is exactly why we have written this report, because our big concern is that we're basically living in a world where electricity bills are set to just increase and increase and increase. And basically what we've seen is decades of policy making. We have not put significant focus on all of those costs that kind of add in together. So what our paper is about, and our intervention is mostly about, is to say, look, we need to stop this upward pressure on bills. That means recalibrating the current energy mission, and it means start addressing these, individual policies that are adding onto costs, which is things like we've already talked about, CCS, gas, etc. But also thinking about putting, for instance, a cost cap on the upcoming auction round to make sure that consumers are getting value for money, and those kind of non-commodity costs that Octopus was talking about don't spiral out of control.
Tora, thank you very much indeed.
Thank you.
Right, well, let's see what Greg and Julian make of that. We should be patient, actually, and tell consumers, let's make your fuel just a little bit cheaper and park that ambition until 2050. Your thoughts?
I think my initial thoughts are it shows the complexity, right? It's very hard to hone in on what precisely we're going to do. I think the way I read it personally is this is more rhetoric coming through to softly kind of allow Labour to shift policy. It's Tony Blair Institute, it's more Labour focused, it's allowing them to have other experts to say, maybe this was a bit of an aggressive transition, we're going to slightly change tack and avoid the public backlash. That's all I can really gain from that, because not a lot was said that is new. But having said that, I welcome personally the pragmatism, right? Trying to target £20 a month, a year, reduction to begin with a year. It's true. I mean, trying to be more basically lowering the bar, saying £300 off a year, like Miliband said, is an incredibly ambitious project whilst you're still got all these levies and renewable obligations and all this kind of stuff. So at least I welcome that. But that's all I can really say on it.
I think, you know what? Yeah, I think you're right. And I think the key thing for viewers is affordability. There's no two ways about it. 20 years ago, power and gas was so much cheaper. Now it's very expensive. Most of those, what I read from that, the Tony Blair Institute takeaway is, I think as long as we have 2050 in mind, we need to be sensible. So I think I agree with this. I don't think we need, 2030 is an arbitrary target, but we do need to think about all of our energy needs, and we need to think about how do we fairly tax people. I've read some comments on Flux Markets' response to this show, saying, what about going to, taxing everyone in the UK? But not everyone has power and gas consumption needs. Some people are just power, some people have solar generation. So you can't just tax everyone that way. What I think is really unfair, having thought about this the last 2 weeks while we've been doing this show, is that actually gas for heating is very cheap. And all of the tariffs have come in to decarbonise, which are needed, into the power price. So my power price is capped at 26p today. Electric price, thank you. Yeah. The electric price is 26p a kilowatt hour, and my gas price is 6. Maybe those two need to be a bit, we need to think about how we bring down power prices and maybe raise the gas price. But for some people that would be unfair, and other people's that would be, and it's difficult to balance.
Well, it's going to be a hot issue for the next few weeks, right up to and through the budget, I'm sure. So we'll get more on that as we'll report on it as it happens. This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets from Onyx Capital Group. Now, we'll talk about social media. What is being talked about on social media? Well, our show has been for a bit. We had some feedback, I think, to edition number 1. And we can show you some Reddit clips, I think, of some feedback that we were given. This is a screen grab we've got from one of the contributors there. And actually, Julian, speaking to your turn, gas sets the price 98% of the time. I don't know if that stat's exactly right, but it influences the electricity price, doesn't it?
Absolutely, it does. And one thing we've got to think about, the gas going into the electricity price, you need 2 units of gas to produce 1 unit of electricity. And also for gas being burnt to produce electricity, there is a carbon tax that comes into it that really inflates the price. So your gas, when you look at your gas price for heating, that doesn't exist. It's 6p. And the power price is 26p because of this fact. You need 2 units of gas. And then on top of that, there's a carbon tax that comes into this. So back to the point earlier, if you were going to make things fairer, maybe you need to redress that balance.
Okay, back to Reddit. And here's a comment from a housing developer in Scotland. Huge infrastructure upgrades are happening, but it's so far behind, unable to deliver to homes because there is not a power capacity to deliver. This is the electrified delivery system, isn't it, as well?
I think this is the fairest point you can make, is that even if you're completely pro what we're all doing in the UK, it's just hard. It's going to take a long time. It's transition. We use that word a lot. And I don't know, was there over promising on how quickly this would be done? You could go back to 2021 and see all the investment that was going in, the companies that were being started, that were being launched and had enormous investment, enormous valuations, because everyone was so pro this movement. Mm-hmm. I don't know how you can put more behind a movement and yet it's still far behind. That just shows you the scale of the challenge. And that's the fairest point I think you can make.
The scale of the challenge is huge.
One final one to look at. Let's have a look at this. Why is the old program lack of investment? Why have companies, energy companies in particular, been continually underinvesting? Because they've been allowed to get away with it. Oh, a regulation question. Have they been lax?
I think that's quite a sweeping comment, obviously, but I would say, generally speaking, if you want people to invest, they need to be looking 10, 20. I mean, look at Onyx, right? We got revenue, we got profits, we got cash piles, and we take a look at the market in a cyclical view. And what do we want to invest in? Where do we see the future going? If it's going more electronic trading, we need to invest more in infrastructure for electronic trading, these kind of things. Companies are just going to do the same thing. Being forced to invest in things, I mean, that's a different type of economic environment, I'd say. So if you want people to invest or companies to invest, you have to provide the incentive. That's pretty basic stuff. And that's what we're going on about. A very high tax regime and a politically shaky landscape. That's what INEOS is going on about, Ratcliffe. I mean, I don't want to invest here because it's so unstable. So if you wanted them to invest in the grid infrastructure, you've got to make it investable. But the idea that it wasn't attractive for renewable investment, that can't be right. The subsidies have been amazing. Like, people have made, Elon Musk built Tesla a lot of the early stages, a lot on subsidies. I know it's the US, it was definitely not a bad environment for investing in grid infrastructure.
No, and renewables have come on in force. You just mentioning earlier off air, 60% production yesterday, 50% of our power needs yesterday was wind yesterday, renewable production. And that that factor is true, and coal now stopped completely a year ago. But in terms of investment, that's why GBE exists. It is an
This
investment.
is Great British Energy.
Great British Energy, yes. So Labour set that up as they came into power, and that is an investment fund that's going to take part, private investment and part of their own investment to put their plans into action, right? It isn't a producer, it's an investment vehicle. And at the same time, they didn't privatise, they nationalised the national grid operators at ESO, National ESO, Electricity Supply Operators.
Because I guess we just generally disagree, I guess, with that comment.
So I think I think I'm agreeing with his comment, saying actually probably the answer is you need to nationalise part of it to really get the vehicle.
But in terms of they're saying a lack of investment and energy companies should have been forced to invest.
Yes, I mean, you can't force them, to your point. It's got to be interesting, but how interesting if they're making a lot of money producing power by burning gas.
But that's what I'm saying. I think I'll challenge the belief that these oil companies and gas companies are making so much money in the UK that they should invest. They're not making any money in the UK. It's a crap environment to be in. We're here as traders because it's the time zone and because we can trade on platforms that exist outside of the UK, right? It's not like we're going, oh, we just love making money out of the UK population. That's not where the money's being made. It's the global market. And if anything, this is the worst physical market. I mean, we're not physical traders, but see my point?
Yeah, yes, I do see your point. And this is particularly about the utility companies and how they're performing, isn't it? Yeah. So, yeah.
We'll leave it there for this week. Thank you very much indeed. Thank you very much indeed for watching. We do read your comments, as you've just been proved to you. So do add your words wherever you're watching this in the comment section underneath. Until next week, bye-bye for now.
Hello and welcome to the official's North Sea window update. Now I had a very busy North Sea window this evening with plenty of bids and we've been waiting a while for that, so let's get straight into it. First off, we had Midland bid by Exxon for 2 cargoes, Petronios and Vitol. Those were significantly higher, as you can see on the screen, than the previous bids for Midland, where we had, like yesterday, day before, just over $1 overdated. Today we had $1.50 overdated, so we're much stronger on Midland. But importantly, we also had bids on Brent for the first time in a while. And that's very important because Brent has been relatively depressed, pulling down the physical differential and the dated curve. But today we had Exxon raising its bid for 11 to 13 November all the way to dated plus 25 cents. So we're expecting to see a significant increase in the physical differential and it will be looking much firmer. Slightly oddly, Phillips put in a bid for the same dates. However, repeatedly lowered that bid to minus 18 cents, so dated minus 18. So slightly unusual behavior there. But Phillips was also bidding for Ecofisk again. And in this, on that cargo for 9 to 11 November, they raised that bid to dated plus $1. Meanwhile, Mercuria entered a 9 to 11 offer for Ecofisk, but never lowered that offer from dated plus 180. And finally, we got another trade in Johan Sverdrup when BP sold to Topsoe at minus 5 cents for 15 to 25 November. So what we're expecting really as the result of today's very busy and quite bid North Sea window is that we'll see a bit of a jump from this negative physical differential, might even get into positive figures. Make sure you stay tuned to the officials X account at Flux Officials for our final assessment of dated and the physical differential. But the story of the North Sea is much stronger, much more bidding across a few important grades. So we're expecting that the physical is much stronger, but also that's reflected in the futures market, where we've had quite a bullish day, really. Brent futures for December Brent futures have reclaimed the $65 handle, and they've been rallying throughout most of the day since kind of, the morning even. We had a bit of a dip before the Asia window. So down here we fell at this point down to around $64. But since 9:30, 9 o'clock, we've been rising pretty consistently. And now we've gained a whole dollar on that front. So pretty bullish on the futures front as well. Likewise, the spread has had a pretty good recovery from the morning dip. And the front spread is back up to 65 cents at the time of this recording. And similarly, the M2 spread has also strengthened to around 50 cents, M2, M3 spread. And that's an important one to look at as we move towards expiry on Friday. So really the story today is of much stronger physical, also stronger futures structure. And one thing to note is that, as you can see, Exxon is really the main bidder in the North Sea, and they were also bidding in CFDs. So we have, Exxon has become this kind of much more active player. They've been pretty consistently bidding Midland here and there, but they became much more aggressive today, particularly with that Brent bid that they raised quite significantly. So a much more bid window, and this is one to watch for the future. Traders have been waiting for a while for the dated Brent complex to strengthen.
Hello, this is Jorge, live from Dubai. We are going to talk about the oil markets, the views that we, the officials, have on what is going on. Number one, oil is around 64.50, is still below 65, and kind of fighting whether it goes up or goes down. The narrative about excess supplies continues, that there is so much oil on the water looking for homes. But to be fair, we don't quite see it that way. We still see strong demand and a lot of impact from the sanctions. Trump has indicated that it will try to do a deal with Xi tomorrow, but he has already placed a lot of encumbrances around. And China is one of the main buyers of Russian oil, and so is India. One of the key things here that all the market agrees is that China will continue to buy Russian oil, that they will not buckle. But it is unclear what India is going to do. Early indications today is that government officials talked to the press and said that they would align themselves regarding Rosneft and Lukoil on the sanctions. And we saw the first indication with Reliance, one of the major Indian refineries, buying some crude oil from Kuwait, who also had some mechanical issues. So things are moving around a lot, but the market as a whole thinks that India will find some ways around the sanctions, and they haven't seen enough buying from the other Indian refineries. So one of the big questions for today and this week is it just Reliance, or is it going to be the whole of India shifting away from Russia? If they do, then it's a market over $70. If they don't, then we're going to be around 65 for a few more days. So what's going to happen tomorrow? Well, that's the big question. Trump is already saying that it's going to be a win for the two countries. In the earlier rhetoric was that he was going to win. So already there's a change in the discussion. And to be fair, China is so big, right? So either you align or you misalign. It's up to you. The US is big, China is big. They have to find a way around together. But the early discussion is that they will. And China is already buying some soybeans from the US. They bought 3 cargos. So that's the kind of indication that they also want to play with the US and be a little bit more friendly. If these things happen, they're good for economic growth in the globe. So if things continue into this direction, later demand will be good. If not, then markets will crash. So we will keep on telling you what's going on. Thank you very much. This is the officials.